And I think as an investor, it's not so much whether or not AI is going to disrupt across sectors, but it's within sectors. And I think coming back to the clear winners and losers, I think that's going to be a very familiar story to investors as this very much becomes more of a stock pickers market, and you can position yourself for the companies that are more willing to adopt and adopt AI early rather than wait for to be disrupted by that.
Yeah. John, I mean, how to juggle this one? Because on the one hand, disruption, or the possibility of disruption across sectors. On the other, the case for a while now has been these sectors are going to see increased productivity and increased profitability.
Yeah, well, Willis Towers Watson's classic argument. I mean, this stock has been, very defensive industry for most of our lifetimes, and now it's gone up, massively in 3 years on a lot of stories about insurance winning the game in the cycle. And so people are looking at this and say, so I just want to get out of the way. I want to shoot and ask questions later about Willis Towers Watson, take those profits off the table. So this is the other thing here is when you've got a stock like this, $292 a share, that probably was $60 a share 3 years ago. I just want to get out of the way and ask questions later because there's so much cloudiness about where the agentic AI is going to play out. And does Willis Towers Watson get it right internally? Did they hire somebody? Or where does that go? And the answer is nobody knows. So just get out of the way, sell it now, take this profit off the table.
Yeah. Stephanie, I want to get your thoughts on all this, especially since you were talking about the goods versus the services just a moment ago. And obviously we've seen a rotation more broadly in the market amid all of this.
Yeah, I think there's something Shauna said that I couldn't agree more with, and I've been thinking for a while now that we are, for the first time in a very long time, more than a decade, we're in a stock pickers market. And I think that's where you are going to see differentiations even within a sector. So even if forget AI, I do think, for example, within the retail space, you're going to have recoveries and you'll have those that, kind of just can't grow. And so that's one other area that we've been thinking about is like who can sort of just recover because they haven't had a great last couple of years. And then the technology can sort of benefit them and make them more efficient. But I definitely think that we're in a stock pickers market and that's not going to end, especially when you have the historic cash cows that just have these consistent businesses, being disrupted and changed by that.
Yeah. Well, Stephanie, John, Shauna, stay with me. We're going to take a short commercial break. And then we're going to talk about that Google debt raise and what to watch with retail sales and consumer news reporting and so much more on the other side of the break. alert. Axios reporting the House Judiciary Committee has issued subpoenas to 8 Affordable Care Act health insurers for documents as part of an investigation of potential fraud among the companies targeted: Elevance, CVS, Centene, Guidewell, Oscar Health, and Kaiser Permanente. You can see a mixed picture right there on your screen here, pre-market. So let's bring our panel back in. On set with me is Shauna Smith of Global X ETFs. Also with us is Robinhood Stephanie Guild and John Blank of Zacks Investment Research. Guys, a lot to cover here in the final minutes of the show. But John, I'll kick this one to you. Just any reaction you have to this notion of healthcare companies being subpoenaed, given what we've seen in the moves in those stocks, and of course, such a focus on affordability from the administration. I think we're having some technical difficulty. So, Shauna, I'll go to you.
I think it's going to be a wait and see. Obviously, a little bit concerning, at least in the immediate term. I think as we do get more development, it's going to be a sector in the trend that we're going to watch.
Yes, we gotcha. Stephanie, your reaction to this and how it speaks to perhaps the fact that Washington has become the epicenter of the world with this intersection of policy and investment.
Yeah, I don't know if I've ever watched the political shows on Sunday as often as I do now.
Me too.
We have an investment theme that is focused. Our theme is called "Keep the Customer Happy," and we think it has to do with affordability issues. And so, what does that mean? It will be thinking about drugs, pharmaceuticals, I should say. And also, the healthcare industry, because that's where some of the biggest costs come for a consumer. And we also think that will probably have an impact on what the future of tariffs might actually be, because we do need to think about how it affects cost. And so we are watching for other places that this could hit, because we think it's something that will not stop, at least until the midterms.
Speaking of affordability, John, I mean, affordability might be an issue on Main Street, but maybe not so much for Wall Street when you look at the ability to access capital in an affordable manner. I mean, case in point, the Alphabet bond sale, $20 billion in biggest U.S. dollar bond sale ever for the company yesterday. It was more than initially expected. And now they're turning to Europe markets, including to the UK, for a 100-year bond here to continue to raise for this CapEx build out.
Yeah, I mean, this is a really interesting situation for Google, because they are the one stock that's led the way and hasn't been sold off in this downstream software space or search space. And the whole idea is that they have the winning app. They have Gemini, and it is taking share from ChatGPT, and they're going to have chips behind it, that their own chips that are going to make their margin hold up. So the question you have to ask Ed is, why are they going for the 100-year bond sale and getting money out of their own company if they're doing that well? And so it's just kind of curious. I mean, I guess their idea is that they want to use the low interest, low spread environment of the bond market right now to take advantage of it, which makes some sense, but it's very conservative for them. And I'm kind of curious that they did it, because I would think they would just invest out of their own cash flow and do it that way.
Want to get your thoughts on this, Shauna, especially since I saw this stat. This was ahead of yesterday. Inflows to U.S. investment-grade bond funds hit a fresh 5-year high in the week prior, and the demand is so high for high-grade corporate debt that it's pushed premiums to their lowest since 1998.
Yeah, that's so interesting that you brought that up, because it's one of the stats that have stuck out to us. And I think just also, as you take a step back, this very much the fact that just using the Alphabet example here shows that the fact that demand is exceeding what the expectations were is that investors are very much willing to fund it at this point. And I think going forward, it's not so much can you build it, but can you fund it, and can you fund it efficiently? And I think looking to the bond market, at least the activity that we saw with Alphabet, what we've seen with Oracle most recently, it's going to be very important as we do gauge just how sustainable some of this AI build out really is.
Yeah, meantime, Stephanie, we're watching for retail sales later this morning. We got jobs, I'll call it Jobs Wednesday tomorrow, CPI on Friday. How does all of this layer into the broader conversation, especially when we're talking about the consumer and the health of the economy overall?
Yeah, I think the consumer will continue to be, resilient in this environment, and that's why we do have a little bit of a focus on retail recovery names. So we think the retail sales period will show to be relatively strong. And we like names that, as I said earlier, should kind of show a recovery in their own business. And that's one of the things we like about it being a stock picker's market. When it comes to inflation, and for example, an example of that is VF Corp. We think they're a company that's focused on really turning their business around. And if you look beyond that, like inflation, there's two thoughts. One is there's a lot of people on the street that think inflation could go higher, because some of the kind of rush to get lower priced product into the economy last year is now dissipated. But then when you look at trueflation, which is another measure, that has been falling. So I think, I'm not sure it's going to be a big issue.
We're going to thank our panel right there. Retail sales, import prices, employment cost index on tap. Squawk Box starts now.
Good morning. Key reads on the U.S. economy on the way. During our show, we're going to get quarterly results from Coca-Cola and CVS Health. Tonight, Ford set to report. And Google parent Alphabet tapping the bond market in a big way and reportedly looking to sell 100-year bonds. And the Trump administration's effort to stop Wall Street firms from snapping up single-family homes running into opposition in Congress. It's Tuesday, February 10th, 2026, and Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We are live from the NASDAQ market site in Times Square. I'm Becky Quick along with Andrew Ross Sorkin. Joe is out today. Take a look at what's happening with the futures this morning. You'll see right now the Dow is indicated up by about 40 points. S&P futures up by 4. The NASDAQ indicated off by 5.5. Yesterday, it was the second day in a row of gains for the S&P 500, the Dow, and the NASDAQ, all of them seeing back-to-back gains. And the Dow actually closed at a record high once again. If you check out what's happening in the Treasury market this morning, yields are a little lower. 10-year sitting at 4.18, and the 2-year is at 3.47.
Meantime, Google parent, and this is fascinating now, Alphabet tapping the U.S. debt market to raise $20 billion as it looks to fund its AI ambitions. Reports say that was up from an expected $15 billion deal. The company reportedly also working on selling sterling and Swiss franc denominated bonds, including a 100-year note in British pounds. The first time a tech company sells a bond with maturity that long since the late 1990s. Last week, Alphabet said that capital expenditures this year could reach up to $185 billion. And it's just another sort of example of where we are in this sort of unique moment in the economy, the spending amounts, and whether we ultimately believe that enough people are going to want to pay for all this.
Yeah, it does go back to the question of what these companies are. Massive growth without having a whole lot of capex that they had to do up to this point. We've talked about that for about a year or so. Definitely has changed what they're doing. And this is a company that had free cash flow of $73 billion. So it's a company that kicks off a lot of cash, but not as much as they're talking about in terms of this investment.
And I think the longer term question that I wonder about is, it doesn't just seem like this is initial upfront spending, meaning there's clearly, obviously, the big spending to get some of these data centers up and running, but this now goes back to the chip piece. If you have to keep buying new chips, if you have to keep upgrading these centers, all of a sudden these are not capital-light businesses at all, and they never become capital-light again.
Yeah, a lot of questions as to what that means. I wonder about that. Like in the case of Amazon, they're definitely ramping up their spending. Amazon has gone through cycles over the course of its entire history where it ramps up to do things like build all of the shipping and fulfillment centers, and then it's able to kind of calm back down and say, okay, now we're going to milk the profits on this. And Jassy himself said that this is a once-in-a-generation opportunity to capture some of these. So you wonder if the spending is going to be quite this high, or if this is a high watermark that then comes back down. But you're right, they're not going back to being completely capital-light businesses.
If they think that they're building data centers in space, the spending is not stopping anytime soon.
That is true. Anyway, we'll keep an eye on it. There's shares of Amazon right now, too. U.S. tech giants, in the meantime, could be in line to get tariff exemptions on imported chips that they are using to build those next-generation data centers. The Financial Times says that the Commerce Department is planning to waive some of the taxes for the so-called hyperscalers on chips that they buy from Taiwan Semiconductor. Under the plan, the FT says that Taiwan Semi would be allowed to pass out exemptions for its U.S. customers for forthcoming tariffs, depending on how much money the Taiwanese chip giant invests in the United States. The Trump administration is looking to onshore chip production and has threatened new tariffs to reach its goals. But in a weekend interview, Taiwan's top tariff negotiator said that Washington's proposal to move 40% of the island's chip supply chain to the United States is, in her words, impossible.
Meanwhile, the Trump administration reportedly wants tech giants to publicly commit that the data centers that they're building won't raise Americans' electricity prices or strain water supplies, and that the companies will pay for the cost of construction. A Politico report now saying that an agreement between the White House and AI giants would be voluntary. It is unclear which companies could be involved, and it's also unclear, at least to me, how these tech companies could effectively pledge that electric bills won't go up, because in so many parts of the country they are not going to be fundamentally responsible for that. So unless they're going to be subsidizing,
unless there's a situation where some regulator comes in and says, hey, if this goes up, it's back on you. I don't care what contracts you've signed to this point. Probably state regulators have some power over those things, but we'll see.
But this would be a voluntary pledge to the White House, so it's not even a state-by-state situation.
But
I don't understand how.
That's a pretty smart thing. The White House has come out and said that they are not in favor of these issues, and they're really mad about it. So basically, the White House is saying, we're going to overrule your contracts. It sounds like that's the case, right?
I don't know how they would overrule the contracts, because ultimately, I mean, there's two types of contracts. There's the ones we've talked about, which are, to me, the ones that are the most problematic. Those are the ones which require effectively 99 points prioritization uptime.
Yeah.
But that doesn't specifically get at the issue of the cost of electricity. You're not going to change the idea that somehow you could change the cost of electricity, meaning that somehow these guys could control it, potentially through subsidization and the like.
That's the only way I think it works.
I'm not sure that that's what they are necessarily saying in this. And then there's
Sounds like they're saying, please leave us alone.
Well, and then there's these other folks who are building their own electric plants, and that are building their own electric plants for their data centers. But those are not even, in some cases, even attached to the grid.
But it doesn't matter if that would keep them from sucking energy from the grid, I guess.
It would keep them from sucking electricity from the grid. But by the way, everything's fungible, so all of this is increasing the cost. It's sort of hard to believe it's not.
All right, let's also talk about shares of SoftBank. They are jumping in Japan after the company's telecom arm raised its full-year profit outlook. It also increased its full-year sales forecast. You can see that stock was up by 10.6%. SoftBank also benefiting from its stake in British chip designer and AI player ARM. Last week, the company posted record quarterly revenue. ARM shares are up 20% in the last 7 days.
Meantime, President Trump's campaign to prevent big Wall Street investors from buying up single-family homes hitting opposition in Congress. The Wall Street Journal reporting that both House and Senate lawmakers have resisted putting the idea in bills making their way through the respective chambers. That reflects some differing ideas among those in Washington on how to get those housing costs under control. The Journal saying that the amendment, any kind of amendment like the one the president has suggested, risks derailing progress on the congressional housing bills. Now, the House passed a version yesterday by a vote of 390 to 9, and will now look to reconcile its bill with the Senate. Later this hour, we're going to talk U.S. housing affordability with Scott Reckler, who's the chairman and CEO of RXR. Also, it's worth pointing out a major lobbying effort going on in Washington by some of the big real estate and private equity companies as we speak. And that, to say they have power, they have power. We've talked about the carried interest issue for a long time.
And you're going to bring it up today with Scott when he's here.
And we will.
Yeah. All right, a news alert for you as well. Axios is reporting that the House Judiciary Committee has issued subpoenas to 8 Affordable Care Act health insurers for documents as part of an investigation of potential fraud. Among the companies that are being targeted, Elevance, CVS Health, Centene, Guidewell, Oscar Health, and Kaiser Permanente. You don't see huge moves down for most of those companies, although Oscar Health is off by about 3.4%. We will continue to watch this, though. for what it means for these stocks as we get closer to the opening bell. All right, have you had enough of winter yet? And
Yeah.
cold?
Yeah. Kind
I'm
of.
reaching my breaking
It's getting
point.
better
It's
though.
just-
It got warmer.
Yeah, the problem with when it gets warmer is that melts a lot of the ice and snow, and if you have an ice dam in your house, it means it comes through your roof.
Oh.
This morning there was,
Sorry to hear that.
earlier in the week there was a leak. This morning there was a burst pipe or something. There was no water. It's impossible to get through the streets here because there's still snow and ice everywhere. I think I've just had my fill. It's so much harder.
Cold. It's not
Everything. Please let spring come soon. All right, when we come back, we're going to talk about, is the software sell-off over? We'll talk much more about tech spending by the Magnificent Seven and whether AI is about to eat all of the smaller firms. By the way, check out crypto prices as we head to a break. They are under pressure once again. Bitcoin is off by about 2.7%. The last tick there, 68,805. We're going to be talking to Michael Saylor later this morning about what's been happening with Strategy, the company formerly known as MicroStrategy, and what his plans are in the wake of this lower Bitcoin price. Stay tuned, you're watching Squawk Box, and this is CNBC. right, welcome back, everybody. Take a look at the futures. Not a ton of movement this morning, but you do see the Dow up another 31 points. By the way, the Dow closed at another record level yesterday after closing above 50,000 for the first time on Monday. S&P futures are indicated up by about 3. The NASDAQ indicated off by 5. And joining us right now is Carrie Firestone, Arias Asset Management co-founder, who is also a CNBC contributor. And Carrie, it's great to see you. It's been a little while since I've gotten to talk to you.
Hi, Becky.
Hi.
Nice to see you.
Let's talk about what we're going to be getting this week. Today we get retail sales. Tomorrow we get the actual official jobs report that was delayed. We get the CPI number that will give us an indication of inflation on Friday. That's a lot of data to digest. How are you feeling ahead of that?
I think the data is going to be fairly good. Retail sales looked good in November. We're going to see December up probably between 0.6 and 1%. So that shows the consumer is still spending money. On the CPI piece, extremely important, of course, we saw that rents were coming down and are still coming down. That is a huge segment of all of CPI. 30% of the total is related to housing. That's what really drove up prices as well as food during the pandemic. So we see some improvement there. It's jobs that we're most worried about because the jobs number has been weak. 4 out of the last 6 months, ADP numbers have shown weakness, real weakness. So we're going to find out. And of course, the Bureau of Labor Statistics has been on pause, not able to provide the numbers. It's unclear what we're really seeing. So people have to take those numbers with a grain of salt. But the unwinding of employment is what we expect because of the huge hiring that we saw during the pandemic. And that is still continuing rather than such weakness in the jobs market, we think.
Okay, let's talk about what the market is still trying to digest from last week. And that is the news of this much higher CapEx spending from the hyperscalers. Was not met with much enthusiasm on Wall Street. You saw those stocks all kind of sell off as they were talking about it. Are you somebody who thinks that the sell-off is a buying opportunity, or do you think that there could potentially be more pain?
Well, the sell-off, it was most affecting the software companies. There was a $640 billion expectation of spending. I mean, that number is so big, it's just hard to fathom. $640 billion for companies are going to spend in 2026 on capital, on data centers, or as we would say in Boston, data centers. And that is way beyond what we had expected. It means that we're taking money that, of course, would have gone elsewhere in terms of free cash flow, net profitability, and moving it to just, spending on chips and what they need to build out AI. The market didn't like it. The market, it felt yesterday had calmed down. Friday was a nice rally, calmed down yesterday. And I think that we will see continued softness in the software companies. The declines of 46 companies in the S&P of 20% or more, that's about 10% of the entire S&P is down 20% or more so far this year. A lot of them are software companies. I mean, if you look at the charts of Salesforce, Microsoft, Adobe, Paycom, Autodesk, you're going to see major declines over the past several months. But this recent weakness has been tremendous, and it might not have bottomed yet. We're expecting that we will see over the next few months a point where the stocks do become attractive, but they're not quite there yet. Their free cash flow is not high enough. It's 5 to 7% yield. We'd like to see that higher. There's still a big concern about what AI will do to disrupt their business. If you look at a company like Alphabet, Google, where they're in the software business to a little extent, but it's search and data centers, storage. We think that what they have told us is that the revenues are up 120 billion over the last 3 years. The number of employees is flat. That means that they are using AI successfully, or it appears the productivity is up. And if you can transfer dollars, which they seem to be doing, from headcount into capital, as long as it doesn't exceed what they would have spent on labor. I suppose the market is willing to accept that, and the market seems to be accepting it with some of the hyperscalers, but perhaps not others.
Yeah, and that's a really interesting point. I mean, Andrew and I were just talking about the idea that they are spending so much more money. Your point on how much more efficient they have become in terms of the headcount is one that we hadn't really considered. But do you see the prospect for how these stocks are viewed or how these companies are viewed changing over the long haul, just in terms of no longer being capital-light companies?
Oh, I think that's definitely true. I mean, if you look at 200 billion, one company, 185 billion with Google, I think 130 with Meta, these are big dollars that they're outlaying for capital. So yes, we're going through this spending boom. In the past, when companies were in capital cycles, often the stocks underperformed because they could not generate the profitability or the cash flow. In this case, that may not be the case. They may still be able to if they have productivity elsewhere. And we will begin to see that. They're generally capital-light businesses. You know, they're ubiquitous. They don't need physical locations. This is all done in the cloud and through people's devices. So it remains to be seen whether capital spending will have the negative effect on how investors view the companies, if they can still generate the profitability.
Okay. Carrie, it's great to see you. Thank you
It's really nice
for being
to
with
see you
us this
today.
morning. And we'll talk to you soon.
Thank you.
Okay, coming up on the other side of this, the Trump administration reportedly looking to take a hatchet to Obama and Biden-era climate rules. We're going to talk about all this. What could it mean for automakers and power producers? That's coming up right after the break. But first, take a look at crude oil. Right now, you can buy by the barrel. WTI, $64.51 is the price tag. The Department of Transportation warning that U.S. flagged ships to stay as far away as possible from Iranian waters when traveling the Straits of Hormuz. This, of course, as tensions remain quite high between the U.S. and Iran. What does it portend? We'll discuss it all after this. Welcome back to Squawk Box. The Trump administration preparing for a big change in U.S. climate policy. The Wall Street Journal now reporting that the administration is getting ready to repeal the government's scientific finding from 2009 that 6 greenhouse gases are a threat to public health in the United States. That ruling paving the way for stricter vehicle fuel economy standards under the Clean Air Act. That's what allowed that to happen. The Journal saying that power plant emissions will still be regulated, but this latest move could be a precursor to those rules also being weakened as well. So a big move potentially by the administration could open up all sorts of more opportunity to create energy, but for those who have concerns about climate change or also just where money is going to be routed in terms of which energy sources are going to be used, here's where we are.
Yeah, and I think the biggest issue with this is to have wild swings every 4 years, depending on who's in the White House. It's impossible to set up long-term plans that cost a lot of money and a lot of capex to go into it.
Well, look,
under those situations.
My view is we need more energy.
Yeah.
To power all this stuff.
All sources, right.
But I think my view is all sources, all in, everything.
Yeah.
That means whether you want to get it from fossil fuels, great. But if you want to get it from wind or solar, I think you got to get it from all these places.
I think the big question, though, is what the government should be expected to fund. And like in the past, a lot of these things have made sense because the government was heavily subsidizing them. Even Tesla, the reason that it was able to take off was heavy government subsidization. And when you have swings in what the government will or won't subsidize, that also sets huge changes in place. Like we saw, who was it this week that just had the huge write-off? Oh, Stellantis, right? Because of the EV things that they were adopting so much more quickly. GM had to write off some of those things earlier too. Just big swings and big changes and things that really take a long time for these companies to develop and a lot of money to put into and follow. All right, when we come back, one of the hottest fintechs in the world reportedly getting a big valuation bump. Squawk Box, we'll be right back. Good morning, everybody, and welcome back to Squawk Box. We are live from the NASDAQ market site in Times Square. If you take a look at the futures this morning, you'll see right now that the Dow futures are indicated up another 43 points after the Dow closed at yet another record yesterday. Remember, it closed above 50,000 for the first time ever on Friday. Those gains are continuing to build. S&P futures are up by about 4 points, and the NASDAQ is flat at this point. Treasury yields have been a little lower this morning. Right now, it looks like the 10-year is sitting at 4.18. The 2-year is below 3.5% at 3.47. And we're also watching gold and silver. Gold has pulled back some, but it's still sitting above $50,000 or $5,000 an ounce at $5,070 right now. Silver down by less than 1%, and it is still above 81 cents this morning.
Meantime, reports say that payment company Stripe working on a tender offer now that would value the company at $140 billion or more. That would be a jump of more than $30 billion from Stripe's last reported valuation. The fall Stripe has been watched closely as a high-profile IPO candidate, and this has been one that's been up and been down, but it seems like everything is up and to the right at the moment. When we come back, a lot more on Squawk this morning. I'll look at the state of housing in America. In New York City, could President Trump's call to ban big investors from buying houses help first-time owners, homeowners? We're going to take a look at that very question when we return. You don't want to miss this conversation. Welcome back to Squawk Box. Joining us on set with a look at real estate, New York City politics, and so much more. Scott Reckler is the chairman and CEO of RXR. He's also a director of the board of the New York Fed. and there's a whole lot to get to. I want to get to the politics in New York and everything else, but let's just start on the housing issue because everyone's talking about affordability, affordability, affordability. President's been quite public about his ideas that, you know, he doesn't say it, but folks like Blackstone and other big firms shouldn't be buying up, you know, single-family homes, and there's now a whole debate and fight happening in Washington. Tell us, A, what you know about what's happening behind the scenes on the fight and what you think the right answer is.
Yeah, actually, I think the concept of not having institutions buy homes is sort of a marginal impact right now. I think the real issue is supply, right? If you, whoever you talk to, there's a supply gap somewhere between 4 to 7 million homes in this country. So the only way you're going to create more affordability, more availability, is creating more homes. And one of the biggest challenges is access to cheap capital, right? So interest rates got to come down. The regional banks that we've spoken about before, you know, are not lending today to the regional builders. So the regional builders are somewhat paralyzed.
Scott, can I just stop you right there? Just in terms of the interest rates. Interest rates are higher than they were, but they are historically nowhere near the highs that we've seen even in my lifetime.
Yeah, so it's interesting.
And to have a system that only works if interest rates are
right. But we're in this really weird spot right now, right? Because you really have this bifurcated economy. Right? Look, where's the growth that's driving this macro economy? It's the digital economy. That was like 90% of the growth, not including the wealth effect. You then go and look at the real economy, the people that are trying to buy their first home, the people that have to live on credit cards, small businesses, they're suffering, right? That's, you know, it's probably like...
Since when does the Fed lowering interest rates fix all of the
well,
problems?
Again, I'm not saying this is the Fed lowering interest, I'm saying lower interest rates, right? So if you had low...
But
you have this...
usually brings a,
you
if it's not a Fed that's doing that, then it's an economy that stinks.
Well, or you have an economy that right now is being driven by a very concentrated part of the economy, the digital economy, and the real economy isn't be driving at that same pace, right? So you have this two-speed economy, and that's, you know, the K-shaped economy. It's more complex, but it's got to be...
Can we just go back, though, to this Trump idea for just a second? I hear you, this idea that you're saying it's on the margins, but part of what the president's trying to get at is the issue of supply, right? And you're saying, well, this doesn't really affect supply. It doesn't affect the physical supply. It affects the competition for that supply. And so, by default, you could argue actually it creates supply in its own way because you the homeowner, the citizen of America, are no longer competing to buy that asset from somebody else, that's some bigger institution that might actually, by the way, also have different economics behind what they're able to do. The biggest being that they can depreciate the property and you can't.
Right.
And so the question is whether that is a good or, from a public policy question in this country, whether it is a good or bad thing to have these big firms buying up these properties or not.
Right. So my personal assessment would be it's not a good thing from the macroeconomic standpoint. I think the president's right on that. I think it may have been a good thing coming out of the financial crisis when we had excess homes that were built that needed to be absorbed and then money invested and put back in the market. I do think the nuance of where developers are building and then renting homes to people that they can ultimately buy is a good concept that will actually help facilitate new supply, new home ownership. So I think there's nuances to it. So I think there is something to it, but it's not, well, the reason I say it's marginal is they're not really doing a lot of that right now. Most of them are focused on build to rent versus buying inventory that people would be competing to own.
Right, so it seems to me we have two issues. One is how do we actually just physically grow the supply? That's a long-term problem that will take multiple years to solve and maybe a decade or two to solve in terms of just the physical nature of creating the supply. So then the question is, while that's happening, if you think you can, you know, walk and chew gum at the same time, what are the policy choices we can make that effectively frees up supply or makes whatever supply is available more available than it would otherwise be? From that perspective, what are the things that you would do to effectuate that?
So again, I'm going to go back to capital, right? If you can create lower cost capital, that will create supply. And by the way, you can do targeted capital. Like they've done this with infrastructure where they create infrastructure banks. So you can create targeted capital for home builders that are building homes that have a price point that people can afford to buy, $400,000, $500,000 in certain markets. That will then free up home builders that used to go to regional banks that don't have that access to the capital or appropriately priced capital.
So, but you think it's a construction story, it's not trying to free up. So, for example, I sometimes think about, you heard Scott Besson, in fact, people gave him a hard time for it. He said that there's retirees who own, you know, 5 or 6 properties. There are retirees who own 5 or 6 properties. There's not most Americans, but there are. And there's always been a question to me about whether we should change the tax policy. A lot of those people are holding on to those homes because they've taken the depreciation off of the rent that they, the rental that they've had for sometimes 25 years, and then feel stuck that they can't actually sell the property. They would much prefer to pass it on to their heirs, right?
Yeah.
So that then they get it stepped up.
So you're saying so step up the basis so they.
I would potentially step up the basis or get rid of the tax or get rid of the tax for for a 3 to 5 year window, let's say.
And there are policies like
for
that.
people over 70 years old. I would literally set it so that people at a certain age, so that those properties can get into the market, even if you think it's a windfall in the moment to some of those wealthier retirees.
That's a fair policy. Another one like that is that the number of people around the country locked in low mortgage rates,
right,
and they can't move, so they don't sell their home.
Make it portable.
Right, and so make it portable, so they can actually move that if
Make
that's
it
possible.
portable, but how? I mean, I know that used to be a case when, interest rates were 18% back in the 80s. That was a big deal if you had a mortgage that you could bring with you. But to make that retroactive, you're changing the terms of the deal. I've also heard people say, look, you should be able to allow someone else to assume your loan. But that's kind of crazy if you're a bank that has lending standards to say that anybody who walks in.
This is not a simple fix, right?
Yeah.
I'm not disagreeing.
I understand with making those from this point on, saying let's get you caught up for something that you can take with you. But I would assume that that's a different risk perspective for the mortgage lender.
Yeah, and the government's going to have to backstop it because that's not going to. The market can solve it.
Taxpayers are going to have to backstop to say that if you no longer pay.
Listen, we have an affordability crisis, particularly on housing, right? And this is, we've lent $4 billion to housing this past year. We're going to do $10 billion next year. It needs capital because the regional banks aren't there today to provide that capital.
What happened to the regional banks?
As we've spoken before, coming out of the savings and loan crisis. I'm sorry, coming out of the.
Just fewer of them. They've gotten more.
Yeah, they can't afford to compete with the big banks. They can't afford to make sure they insure the deposits the way there are. And so they don't have the capacity to be able to be lenders.
But you think that's a huge problem in the housing affordability crisis?
I think it is, because if you think about the top 20 home builders, they don't need regional banks, right? They got their own balance sheet. They're very margin focused. They're laid out. When you go to beyond that, these are the local home builders that understand their market, that play on thinner margins, that can build where there's actually real demand. They're frozen out of that market right now. They don't have capacity right now.
Okay, I want to talk New York City politics for a moment. I want to talk taxes, and then I want to talk weather. We'll talk about the weather in a second. On the tax front, I interviewed Mayor Mamdani, it's maybe 2 weeks ago now, and he is, committed, as you know, to raising taxes on the wealthy. He's also committed to the corporate tax, raising the corporate tax. What have you seen in truth, in reality, right now? Meaning, are there tenants that are not taking rentals because they're saying they need to get out of the city? Are there people leaving? Are there people not coming? Or is nothing happening and that this is all a threat without teeth?
Right. So if you remember, right after the primary, I was here, we were talking about it. I said 3 things you got to look at. You got to look at, drown out the noise and look at the facts on the ground. You got to look at what they're actually doing, right, in terms of what he's actually doing in terms of policy and what the governor's doing. Those are the 3 things.
Yes.
From on the noise side, what you're seeing is the opposite, right? We've had the strongest office market that we've had since 2019. It was one of the top 3 in the last 2 decades. So companies are growing, taking space. They're not just committing for this year, they're committing for 28, 30, 32. Ken Griffin just announced that he's buying, the 350 Park interest. So people are committing to New York. Housing, right? If you look at rental housing, a 1.5% vacancy rate. This is where people are coming to live. Luxury housing, we have had 30% higher levels of sales of luxury housing in Manhattan than we've had before. So the facts are saying people and companies believe in New York, investing in New York, and aren't afraid.
In other words, he may be making a fool, though, of all of the people who said, look, we're leaving New York in droves, right? Like, and by the way, I was interviewing him last week or 2 weeks ago saying, are you worried that people are going to leave? And he was saying, no. But we heard religiously from people for months that, look at California, the people are leaving. Look, they're all going to go to Miami and New York. Why has that not happened yet, if that's the case?
Right. So I think that New York is this magnet of people wanting to be here for a lot of reasons, which we talk about. But as it relates to the mayor, the big thing is ultimately execution. The other point I raised when we were here is my concern about experience. And you brought up the weather. One example of where this lack of experience has been an issue is these homeless encampments. You know, over the last 4 years in New York, if you had homeless encampments, you call the NYPD, they'd come with sanitation, social workers, clear it out the same day. There was a ideological policy change in Mayor Mamdani's administration that they wanted the Department of Homeland Services to come do this. We've had homeless encampments come up in our buildings, people are doing drugs, lighting fires on the street. We call the NYPD, they can't do anything. I call the mayor's office, they say there's this new policy.
That's happened in the last few weeks?
This happened 3 weeks ago, I called the mayor's office, this is happening right now.
Yeah.
And my point to you on the weather is, why do you think 18 people died, right? So here was I think a well-intentioned ideological policy, which is the view of they've had homeless services bring them in, they're less likely to maybe end up back on the street. Right. But the execution of it was very poor, because you got to realize that you need to think through, how do you do it in the past, how do you phase it in, how do you get that done?
They want Department of Homeland Security doing it.
The homeless services.
Oh, Department of Homeless Services.
Last piece. Do you give him credit? Do you give him blame? What do you do about not the weather itself, but this whole snow situation? I say it because I think people gave him credit in the day or two about clearing the situation, and then obviously it's been a tough road for the past 2 weeks. I also accept that the weather has been colder than it's ever been in the city for a very long time, so I don't know if it's his doing or somebody else is doing, or whether he gets a pass on this.
Yeah, I mean, I would give him a B-, right? I think that, you know, like you said, these are really unprecedented conditions, but garbage is piling up, right? So these things happen, and to your point of why people aren't leaving, you know, New York's success isn't preordained. These things don't happen overnight, and so you need to really be acutely focused on changing dynamics, right? And that's where this ultimately will play itself out. And, you know, if the streets aren't clean, aren't safe, people are going to worry.
All right. Scott, thank you for coming in. It's a great conversation. Appreciate you.
All right, let's tell you about CVS Health out with quarterly results. The earnings came in at $1.09 a share. That was 10 cents better than expectations. Revenue of $105.7 billion, also beating estimates. For the full year, CVS says that they see earnings in the range of $7 to $7.20 a share. That compares to the street's expectations of $7.17, so the street was at the high end of that range. You can see the stock is off by about 3.6%. CVS is maintaining its revenue guidance, but it's cutting its guidance for cash flow from operations, and some of the big numbers that they saw in the fourth quarter would include same-store sales up 16%, but the front of the store sales were only up by 0.5%. It was the pharmacy same-store sales that were up by 19.3%. They said that that was because of some fourth quarter healthcare benefits segment revenue was up because of increases in government business, because of the impact of the Inflation Reduction Act. But I think it did impact profitability numbers. It was not as profitable, even though revenue went up. When we come back, we're going to talk about shares of oil giant BP. They're getting hit as the company suspends its share buyback plan. We've got the details on that story right after a quick break. But first, the AccuWeather forecast with meteorologist Bernie Rayno.
Warmer air on the move on your Tuesday, your AccuWeather exclusive forecast. How about 75 degrees in Nashville today, 45 in Chicago, 35 in New York City. Little bit of snow, though, in northern New England, New York State, and toward Boston, according to an inch of snow later today. And much needed rain from San Francisco toward Los Angeles, where there will be some travel delays there across much of the Northeast and Midwest. The only delays around Boston due to the snow later today. To help you make the best decisions and be more in the know, download the AccuWeather app today.
Check out shares of oil giant BP. The company is suspending share buybacks as it looks to shore up its balance sheet amid pressure on oil prices. BP reported a 2025 net profit just shy of $7.5 billion. That was below expectations of $7.58 billion. So coming in close to $1 billion light. In 2024, the company earned almost $9 billion.
CNBC Cures is focusing on rare diseases. This is a new initiative to bring you insights about the biggest stories impacting the rare disease community and highlighting the research that's being done that will change the way we think about modern medicine for everyone. There's a new episode of my CNBC Cures podcast, The Path, out today. My guest this week is Florida State Representative Adam Anderson. He lost his son, Drew, to Tay-Sachs disease, which is a rare and devastating progressive disorder. Adam's next chapter was as a state lawmaker, leading the nation and offering full genetic screening to all newborns in Florida, potentially saving lives.
People are always so surprised to learn that it could take 4 to 5 years on average, sometimes 7 or 8 years, to diagnose a child with a rare disease. They might spend 7, 10, even more. There's research that just came out that suggests it takes 17 trips to doctors to diagnose a child with a rare disease.
That even sounds low.
And so that's an average, right? I wanted to solve that. So what we did is we set up a state-funded newborn screening program to offer children whole genome sequencing at birth, free of charge.
You can hear more of the Andersons family story in The Path, which is available in our Squawk Pod feed wherever you listen to podcasts. Full video casts are up on YouTube as well. Please join this community that we're building at CNBC Cures. You can subscribe to the weekly newsletter, or you can join us in person at the inaugural CNBC Cures Summit that's taking place March 3rd in New York City.
Okay, coming up, what will Fed Chair Jay Powell and the rest of the central bank make of this week's jobs and inflation data? The delayed January employment report just a little more than 24 hours away. We're going to talk about all this next when Squawk Box returns.
Delayed January jobs data is due out tomorrow. We're going to be getting CPI numbers on Friday. Our next guest joins us to weigh in on the implications for the Fed. Joining us right now is former Atlanta Fed President Dennis Lockhart. He is now a professor at Georgia Tech. And Dennis, what's your overall read on where the economy is right now? Because we've got the big jobs report, we've got inflation data, we've got retail sales all coming. What's your guess at where we stand?
Well, I think the headline is the strong top-line growth in the economy, which can cover up a lot of sins, of course. And under that, we're seeing, and we've heard this from Jay Powell in his press conferences, elevated inflation readings, which are probably going to continue. We'll see that, I think, on Friday. And a slowing labor market that is not yet falling off a cliff, so low hire, low fire kind of environment. It's a real good time for them to wait and see, but I think they'll be watching this data to see if they need to worry more about some near-term deterioration.
What worries you more, the idea of the labor market deteriorating or the idea of inflation being stubbornly persistent here?
Well, I think probably the labor market is the more fragile of the two. The inflation rate has been elevated, but it really hasn't been badly accelerating. So I think we can live with a few more months in a wait-and-see mode on inflation. But I'm going to be watching tomorrow's report, and of course I paid attention to the JOLTS report last week to see if we're at some kind of inflection point in terms of the labor market where things are really going to get worse fast. That would change, I believe, would change the posture of the committee.
Yeah, the JOLTS number last week was concerning just in terms of the big decline between November and December. The jobless claims number was concerning, and then Challenger Grain Christmas had that number. It was the highest monthly reading that they had seen on corporate layoffs since like 2009. What does that feel like to you? What do you think is really happening with the jobs market?
Well, I'm still prepared to view the layoffs as company-specific circumstances that companies are facing, as opposed to kind of a widespread feel that we're headed toward a recession. And you know, and historically we've seen situations where the business community begins to believe a recession is coming, and they start to adjust their staffing levels, and that creates widespread layoffs. I don't think we're in that situation. I don't think we've seen that quite yet, but you have to be concerned that for some reason the layoffs, let's just say, widen in their in the markets, and I don't think that is the case. So I think we'll look at this data and just take it under advisement and see how things continue to develop through the spring.
Dennis, we just had Scott Reckler of RXR Real Estate talking to us about the affordability issue and the housing issue, and I wonder how much responsibility or how much how much of a role you think the Fed can and should play in trying to find more affordability in the housing market. I know that this is a supply and demand issue. You know, Scott was saying we need 4 to 7 million more homes. I've heard numbers as low as 3 million, but you're still talking about as millions of homes that we need to make up the ground. His point is that with interest rates at these levels, with mortgages at these levels, you are not going to find builders who are more willing to build or home buyers who can get into those homes. What can or should the Fed do about that?
Fed can't do much about that, Becky, other than simply try to create good economic conditions in general and hope that the markets address supply requirements in specific markets like real estate and housing. It's just not the role, in my opinion, of monetary policy to target a particular sector or to target a particular population group. And the Fed doesn't have the tools really to do that. Maybe some of the purchases of mortgage-backed securities on balance affects long-term rates, but to do that in a continuing widespread kind of way doesn't make sense.
Yeah, kind of artificially props up the market. Dennis, thank you very much, Dennis Lockhart.
Thank you so much, Becky.
It is just past 7 a.m. on the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Ross, working along with Becky Quick. Joe is off today. Let's take a quick check on the markets and the futures right now ahead of the open. Still got about 2.5 hours to go. But right now, you're looking, well, you got the treasuries up there, but let's show you what fair value looks like. Dow looks like it would open up higher, about 32 points higher. The NASDAQ up about 28 points. The S&P 500 up about 10 points. Treasuries, if we show you the 10-year and the 2-year, you're looking at 4.182 on the 10, the 2 at 3.479. And then take a look at gold. This has been sort of our risk-on, risk-off asset of sorts. We're at $5,000. Call it flat for now. We also have fourth quarter results just coming out from Coca-Cola. Earnings of 58 cents a share. That's 2 cents better than estimates. Their revenue of $11.8 billion. That's below expectations. And then there's this unit case volume growing 1% during the quarter, led by growth in Brazil. The U.S. and Japan pricing was also up 1% for the full year. Coca-Cola sees organic revenue growth of 4 to 5%. I want to get you some of the expectations because you're looking at the stock down now on the back of that news. Of course, not so much volume since we're not open yet, but 2.5% off right about now.
And some news just out from retailer Target. The company announcing some leadership changes under the new CEO, Michael Fidelki. It's named Kara Sylvester Chief Merchandising Officer. She previously served as Chief Guest Experience Officer. And Lisa Roth is going to be taking over Fidelki's prior position of Chief Operating Officer. She was previously the Chief Merchandising Officer of Food, Essentials, and Beauty. At the same time, Target says that it's reaffirming its fourth quarter sales and full year earnings, that they would be in line with their prior guidance. Yesterday, Target told employees that it was stepping up staffing at its stores, but eliminating 400 jobs at distribution centers and 100 jobs at regional offices. It said the move, in its words, would elevate the shopping experience for customers. That stock right now down by about 6 cents. Okay, let's get over to Contessa Brewer. She's got a look at this morning's market movers. Contessa, good morning.
Becky, good morning to you. Let's kick it off here with France-listed shares of Gucci owner Kering surging after its fourth quarter sales. It beat estimates here. Look at the stock is up almost 11%. Gucci saw lower sales losses than estimated. Yves Saint Laurent sales were flat, and that was better than what the street had expected, which would be a loss. Analysts at Bernstein said those results point to a slight improvement across the board for the Kering brand portfolio. We'll keep an eye on those shares today. Let's take a look here at Spotify shares popping this morning after a strong profit beat in Q4. Those shares up 11.5%. The guidance was better than expected. Monthly active users also came in at about 6.5 million, higher than consensus. That's a trend Spotify expects to continue in the current quarter. If this move holds today, this would be the stock's best day since February of last year. I mean, this is music to the ears of investors, so to speak. On semi shares, falling this morning after a mixed Q4 yesterday afternoon, revenue below estimates now. You can see those are off by 5%. The current quarter guidance, roughly at expectations for both profit and revenue, but it may not have been strong enough just to outweigh what we saw as an overall revenue miss. And that's your wrap up of your pre-market movers. Andrew?
Thank you. Meantime, we're going to talk a little crypto because the crypto market's seeing its fair share of volatility over the past month. Mackenzie Sagalos is here. She joins us with a look at the trading action. Where's our Bitcoin this morning? I mean,
68. Lower.
68. Yeah. We're still under 70.
Yeah.
What do you think's happening?
So Ethereum dropping below 2,000 as well. In early European trading, Bitcoin has now round-tripped all the way back to where it was the day before Donald Trump was reelected, even after the crypto industry got virtually everything that it asked for, not just from Washington, but from Wall Street as well. So the sell-off we're seeing year to date comes down to three things. First, the ETFs that were consistently buying for virtually 2 straight years are now selling. $5 billion net out of spot Bitcoin ETFs over the past 3 months. And on average, those Bitcoin fund holders are underwater with a cost basis around 90K. Ether ETF holders are down even more, about 31% according to 10x research. And when existing holders are sitting on losses like that, it's hard to bring in new money. Second, the Treasury trade is breaking. Strategy, Bitcoin's largest corporate holder, posted a $17 billion plus unrealized loss when they reported earnings last week. The stock now trades below the value of its Bitcoin. So the flywheel that fueled this rally, issue stock, buy more, grow the premium, it's not working. And third, Bitcoin is trading like a liquidity asset, not a hedge. So when risk off hits, it's a release valve, a 24/7 market that investors can tap for cash with no counterparty. So whether it was the October tariff shock or the Warsh nomination that set off this latest sell-off 10 days ago, Bitcoin was one of the first things that sold off. Fed Governor Waller summed it up yesterday. The post-election crypto euphoria is fading, and as firms cut risk, they're trimming crypto first.
So, for those who are long Bitcoin, what would be, in this moment, the argument?
Oh, Bernstein summed it up yesterday in a note. They said that there's nothing fundamental to the sell-off beside souring sentiment, but to me, that provides little comfort. This all goes back to October 10th.
But isn't this a sentiment? This is a sentiment asset if it's that.
Well, I mean, they would argue that fundamentals haven't changed, 21 million max issuance, but at the end of the day, there are so many more ways to repurpose that same Bitcoin, whether you're looking at the derivatives market or these leveraged ETFs. So that same one Bitcoin is being repurposed multiple times over. And what's concerning to me is that the industry has not recovered from that October 10th record liquidation event. $19 billion in 24 hours, 70% of that carnage happening in 40 minutes, and the industry doesn't know what happened. And so one theory is that a US dollar peg stablecoin, USDE, lost its peg. It had to do with leverage being offered on Binance to the tune of 12%, and it was a washout in a day. Market makers were taken out. They haven't come back online.
And therefore, at $68,000, the smart money says what?
Well, at this point, retail is out of the trade. They've turned to prediction markets. A lot of them got burned in October 10th. They're not coming back in. So when we talk about where smart money is, it's institutional money in two different camps. The digital asset treasury companies, all underwater. I mean, we talked about strategy a minute ago, BitMine.
We're going to talk to Michael Saylor in a little bit. Yep.
And then the second part of that are the ETF holders, and they're staying on the sidelines. Everybody's underwater on their position. And part of the problem why you're seeing these outsized moves is the fact that it's shallow liquidity when we lost those market makers. So any kind of movement in either direction is bringing it up. The only reason we are hovering in that 60K range is because there's a floor priced in at 60.
But that's the question. So this floor that's priced in at 60, who is supporting that floor?
So basically $60,000 is what it costs to produce a Bitcoin. And so you've got the Bitcoin miners who, below that 60K point, they go out of business.
Right.
And so they are applying most of the marginal selling pressure. So once you get them out of the market, then suddenly you hit this floor, and also 60K.
So you're talking about actual supply and demand.
Exactly, and like to that point, 60K is the point at which the percentage of Bitcoin in profit, it drops below the percentage of Bitcoin at a loss, and so that's why it keeps bouncing off of that 60 floor.
That's really, I mean, that you can look at it the same way you would look at oil prices. When you consider it that way.
Yes, it's trading exactly like a commodity. Like we're just seeing forced selling pressure to these liquidation events. We're not seeing fundamentals driving the moves in the crypto market.
Does that mean it could never really drop below 60?
At this point where it is, especially with retail being out of the trade and being so heavily indexed toward institutional, there is a stable floor there at this point. And I mean, you were having a conversation with Anthony Pompliano yesterday, and he made the point that this bear market is the best one that we've seen. Usually we see a drawdown of 70 to 80% from the market peak. That would be in the 40K range. So we're still doing better. Last week when it was down to 60, it was 50.
What happens if it goes under 60 for real? And how long does it have to stay under 60 to be a problem?
Oh, the first thing I'd look at is what's happening to your digital asset treasury names. At this point, strategy, you can ask Michael Saylor about this later. They're not just underwater on their Bitcoin position. They need, their cost basis is 76,000.
Right.
They're a major driver of sentiment. To your point earlier, Andrew, like that is so much of what's driving the trade. So their long dated debt starts to come due next year, and they have a cash reserve that's meant to support dividend payments. But if there's an erosion of confidence with strategy, that's a problem.
And then they start selling, and then you have a are any of the miners trying to prop up the price right now?
Well, the problem is they can't, right? A lot of them are just selling the Bitcoin that they mine immediately to service debt and to keep their production facilities online. And that's, I mean, others have just pivoted to being to serving AI customers instead, becoming hyperscalers in their own right.
the whole thing, I know, one second. The whole, I'm not saying 1 second to you, I'm saying 1 second to a producer. The whole thing gets super complicated though. If you are under $60,000, it's not just that people stop mining the Bitcoin, it's that the network becomes more complicated itself because you need all the miners to continue to effectively mine, literally for the whole thing to work.
Well, exactly, and also that was one of the core fundamentals of Bitcoin's use case, the fact that there's a decentralized network, and to have a decentralized network, so you need miners online around the world.
Right.
And when you start to see so many fold, or like a consolidation through M&A, then suddenly you've got a concentration of mining happening in one particular place or with a handful of companies.
This is eye-opening. Thank you. Appreciate it. Thank you, Mackenzie. We got a programming note. Strategy Executive Chairman Michael Saylor is going to join us at 8 a.m. Eastern Time this morning. His firm adding more Bitcoin to the company's stockpile. We'll talk to him about that after this.
All right, when we come back, former San Jose mayor turned Silicon Valley congressman, Representative Sam Liccardo, on the AI boom and the risks to slowing down innovation. And we have an exclusive interview with Kalshi's co-founder and CEO, Tarek Mansour. The prediction site scoring big with the Super Bowl. Squawk Box will be right back. Welcome back, everybody. Silicon Valley Congressman Sam Liccardo says that there are risks to slowing down AI innovation. In a Wall Street Journal op-ed, the congressman writes that calls for a moratorium are wrong-headed. Congressman Liccardo joins us this morning, and sir, thank you for being with us. Just to be very pointed about this, you say the calls, thank you, the calls that are coming from this that are wrong-headed are coming from your colleague, Bernie Sanders. You're in the same party. And I don't think you particularly like what anybody is proposing here, whether they be a Democrat or a Republican. Why don't you explain your views?
Well, whatever solution we come to is going to need to be bipartisan. That's the way it works here, particularly given the rules that operate in filibuster in the Senate. We're going to need to find enough folks in the middle that can move at the pace this industry needs to move and leverage the resources, the massive resources of the AI hyperscalers to accomplish what we want to accomplish. As Democrats, we should be concerned about the fact that we critically need to invest in human capital to upskill at a time when we know there's going to be a lot of disruption in jobs. And we also need massive investment in our grid and in renewables and batteries and all the things that we know are critical to move us away from fossil fuels into the future. We have an opportunity to leverage the urgency and the massive resources of this industry to get what we want if we're willing to move at their speed.
I know you represent Silicon Valley, and that might make people skeptical to just say, hey, are you in the pockets of some of these companies that want to see AI move as quickly as possible? What would you tell them in terms of legislation that you're working on to try and regulate AI? What limitations would you put on these companies?
Well, of course, there should be sensible regulations. But the reality is that if we think we're going to stop AI in one way or another and put the toothpaste back in the tube, we should be reminded that we're in a global competition. And we might be able to stop our own companies from moving forward. But we know DeepSeek and Tencent and a lot of Chinese companies will be moving forward very aggressively. And this is going to be the most transformative, and already is, the most powerful technology on the planet. If we are going to allow China to seize the lead, we'll be playing by China's rules in the next century. So what I'm working on are a series of initiatives to see how we can incentivize this industry to align with what we all want. For example, we know there's going to be disruption in jobs. So let's make sure we're encouraging companies to invest in our local community colleges, our state universities, to provide skills that will upskill and enable workers to transition in a meaningful way in this new economy.
That makes sense, but again, what regulations would you have over the AI companies or the hyperscalers? Are you in favor of making our chips available to Chinese companies that are competing with us, making those chip sales available?
Well, we shouldn't be providing the latest chips, that's clear. We already know, though, that China, and particularly Huawei, is right behind us in terms of chip technology. And so the fact that they have third or second generation chips should not be as great of concern to us, because we know they're going to get there anyway. What I do think in terms of limitations is we ought to be providing a means for companies to reach, to achieve the basic standards around protection of things like privacy and data security and so forth that are critically important. And the way we can do that is essentially allowing companies, if they satisfy basic federal standards, to be able to enjoy preemption from 50 different state rules and regulations if they reach federal standards that are sufficiently high enough to protect our consumers, protect our country.
I agree with all of those things, but what are those standards, those federal standards? Because right now they don't exist.
Exactly. And what we do know is that, and this has come out certainly under the Biden administration, with a series of essentially verticals that we should be focused on in terms of protection. What I would propose is that we have an independent commission that identifies what are the best practices in the industry, and let those best practices define what is the standard that all companies must reach if they want to enjoy preemption, essentially to allow a race to the top rather than what we see now, which is really essentially Wild West.
So that I think I understand that, but just to be clear, I mean, we've been talking this week about how long it takes Congress to do anything, even when there's bipartisan agreement on something that seems like it makes perfect sense. Your expectation would be that the 50 states can go ahead and set their own rules unless and until there is this federal framework that's set up to preempt that?
That's correct. There shouldn't be preemption until there is actually a federal safety standard. And hopefully that will motivate everyone in the industry and Congress to move together to get there. But look, I appreciate your frustration. We've been waiting 30 years for a data privacy bill from Congress. Right. We've been waiting that long, certainly, for child safety protections under Section 230. We're not going to get it out of Congress, and that's why I think you need to have an independent commission that understands the industry, understands the technology, that can set those standards, and have Congress say, look, we're going to define what we believe is safe by the very best practices that exist in this industry. We know that they're out there. We just need to say that is the bar. We need everyone to get to that bar.
All right, let's talk about affordability, because that is not only a running discussion on this show, but obviously a running discussion around the nation. What can and should be done? And I'd ask for specifics as much as you can possibly give us. If there's an idea or two that you think would actually make things more affordable for Americans, and so does some of the political speak that we hear all too frequently tossed around by the parties, what would you do?
Well, I think there's a real concern, for example, around spiking utility bills with a massive amount of energy that's going to be consumed by data centers, and chips and chip factories and so forth. And I think this is an opportunity for us. We know that delay is the enemy of this industry. We have a huge sense of urgency coming from the outside. What we need to do is to provide them a pathway to get a permit quickly, if in fact they're willing to build, for example, a microgrid or substantially upgrade both generation and transmission infrastructure that will enable every ratepayer to be essentially held harmless. That is, so that nobody in a particular area is paying more for their utilities as a result of a new data center coming in next door. By essentially allowing for a federal preemption over all permitting and ensuring there's one simple process that everyone can see, and really encouraging strongly the industry to be able to invest as they need to in order to get that kind of speed.
But also paying for it and shouldering a big part of the burden that it will take to
That's right.
beef up the system.
It's going to require a massive amount. It's going to require a massive amount of investment in infrastructure. Look, we already know they've got commitments of more than $600 billion from AI hyperscalers this year alone. This is an opportunity for us to leverage that, to dramatically upgrade our grid, to provide for renewables and batteries in microgrids that we critically need anyway if we're going to transition away from a fossil fuel economy. This is our opportunity to really leverage this moment if we're willing to give the industry the speed they want. The point is, let's not use a brake, let's not use an accelerator, let's use a steering wheel.
Novel idea. Congressman Liccardo, thank you for joining us. We appreciate it.
Thank you. Great to be with you, Becky.
Okay, coming up, a check on the big tech names pouring billions into the AI boom and if they can keep the spending pace apace. We'll discuss that after this.
Welcome back, everybody. Google parent Alphabet tapping the U.S. debt market to raise $20 billion as it looks to fund its AI ambitions. Reports say that was up from an expected $15 billion deal. The company also reportedly working on selling sterling and Swiss franc denominated bonds, including a 100-year note in British pounds. It would be the first time that a tech company sells a bond with a maturity that long since the late 1990s, which of course leads me back to wonder who that was in the late 1990s. Had to be one of the big CapEx spending companies, right? Like a Lucent or a Cisco or something.
Yeah, I was going to say Cisco.
Yeah,
I don't know. We got to go back and
That's
look.
our trivia question of the day. We're going to figure it out.
Okay.
There's our Aflac trivia question.
Join us right now with more on AI and tech. Gene Munster, he's Deepwater Asset Management Managing Partner. Good morning to you. Weigh in on all of this because we had a wild ride, obviously, with the hyperscalers last week. It seemed like things were going badly, then things seemed to turn around. We've had this sort of ongoing debate all morning about whether these companies, which historically were capital-light companies, are now going to be capital-heavy and capital-heavy permanently.
So the headlines, and even with this bond or this debt raise by Google, kind of injects this new uncertainty to how these companies are operating, like you talked about, kind of increasing debt. That's the headlines. I think that misses the underlying story here, which is these are the most competent companies in the world when it comes to understanding AI. Some of them, Meta and Google, are seeing profound impacts in terms of their growth rate. Meta guided to revenue growth in March of 35%. They just did 22%. But the story behind all this, the substance, is that these companies are feeling increasingly confident that AI's utility will ultimately deliver a return on investment. Of course, that's been a big open part of the conversation, is this profitless prosperity. But I think that's the underappreciated piece. We saw these big companies sell off on this big CapEx news. Certainly, from my perspective, it misses the point. I'll just get to the punchline here, Andrew, is I think we're at the doorstep of what will be a breakthrough in terms of the utility of AI. When I talk about doorstep, I talk about 6 months, maybe 12 months away. Typically, people who guess about the timing of these will give 3-year, 5-year estimates of when things will break out because it's a comfortable time away. But I do think we're much closer, in particular, what's going on with the CapEx, but also what we saw with Claude Code and this open claw initiative. It's just remarkable in terms of the utility. And so I think we are at a breakthrough point. I think the market is having a really difficult time of kind of making sense about what it ultimately means. But I just want to mark the moment that this is some pretty big news over the past 3 weeks.
So, Gene, I don't disagree with you in terms of just how quickly AI is ascending and changing our lives, and maybe there's going to be a new inflection point in terms of just what that productivity looks like. I think on the flip side, there's a question just about how much spending is taking place and whether this is one-off spending or whether we should start to think about this more as a very long-term spending plan. Meaning over the next decade, if you believe that people are building data centers in space, that quarter after quarter, year after year, you're not going to see these CapEx numbers go down.
The bottom line is I think we are in for 5-10 years of elevated CapEx, in part because of the utility is starting to present itself and there's motivation for these companies to build this. There's also an upgrade cycle that will come. Of course, these have 5-year lives on it, so we'll get to that. But I just want to kind of put some a little bit perspective in terms of, how can this happen? How can we continue to have elevated CapEx? Investors are wrestling with what CapEx is going to be next year, but I'm talking about elevated CapEx for the next decade. How can that be possible? And the answer is that this concept of training versus inference. Jensen's talked a little bit about it, but at the basic core is that AI is not training. AI is thinking, and thinking is synonymous with inference. We believe that inference can be tens or hundreds of thousands of times bigger than what we're seeing and spending in the infrastructure and the energy use around what's going on with training, which is still about half of what AI is being built for today, is that training piece. And so if you adapt the view that utility will come and this will eventually humans will understand that they need to embrace these tools, you can build a strong case that a company like NVIDIA can grow in kind of a steady case at 15% for many years out.
So my question is, we got to run, but put NVIDIA aside. Obviously, the hardware players, they're going to win because everyone needs to buy the hardware. My question is, what you think what kind of margin compression takes place long term to the hyperscalers themselves?
So the hyperscalers, the biggest companies, I think the majority of them are going to be in a great place. Specifically Apple, Google, I see margin expansion with them. This personalized AI, this open cloud, what we're seeing glimpses of, Apple, Google have big opportunities that should be positive for their margins. It's not universally positive, but I think the companies that have platforms will ultimately deliver higher margins.
Okay, Jim, we're going to leave the conversation there. Thank you. Appreciate it.
Thank you.
When we come back, a lot more right here on Squawk Box right after this. Coming up, a Super Bowl winner, prediction market site Kalshi, breaking records with big game bets this year. An exclusive interview with Kalshi's co-founder in just a moment when we return. Welcome back to Squawk Box. A big weekend for sports betting. The total volume traded on Kalshi on the Super Bowl Sunday was more than 1 billion, a daily record for the platform and an increase of 2,700% year over year. But it was not without some glitches, as the high traffic caused some deposits to be delayed. Joining us right now in an exclusive interview is Kalshi's co-founder and CEO, Tarek Mansouri. Good morning to you. A wild Sunday. Before we even get into it, because I know we got some news this morning, what was Super Bowl Sunday like for you, and how does it all work from behind the scenes?
I mean, it was an incredible weekend, and you know, Kalshi was the biggest brand of the Super Bowl this year, without running a Super Bowl ad. And you know, the way we achieved that is the product. I mean, it really was a situation where everybody was on Kalshi this weekend. And if you look at the App Store charts, the top 3 apps on the App Store were ways to engage with the Super Bowl. It was Peacock, it was NBC, and it was Kalshi. And so you could find on Kalshi essentially live stats, live plays, live trades, and live chatter. And so really everything was an all-in-one place where you could engage with the Super Bowl this year.
And how do you think about what you're doing relative to all of the sports books? I mean, this is the big debate that's playing out in the country right now, in various states and the like, in terms of what's happening with the quote-unquote prediction market versus sports gambling, if you will, even though I think a lot of people think underneath it all, it's the same thing.
Well, underneath it all, it's not the same thing at all. You know, prediction markets are much broader. So for example, you know, you quoted that we did over $1 billion in the Super Bowl. You know, our cultural markets were huge this weekend. You know, what Bad Bunny was going to perform was over $100 million in trading. The second thing is it's a market where people are trading against each other. There's no house. And, you know, the reason why people are flocking to prediction markets, especially Kalshi, is that, you know, our incentive as a company, we win when the customers win. We don't win when the customers lose. And that's a huge difference in the model. We're regulated at the federal level by the CFTC, our federal regulator. And yes, you know, there are some entrenched interests that, you know, are feeling some, you know, pressure from, you know, this new innovation technology that's coming to market. And it's an age-old, you know, story where the entrenched interests come out and say, you know, they want a piece of it. And, you know, they claim that this is sort of unregulated or other things, but, you know, it is regulated at the federal level. We're focused on the right sort of set of measures. And it's growing. The American people are loving it, and the numbers are showing it.
What are the most unique kind of bets that people were making over the weekend? And by the way, what bets won't you allow?
Well, you know, what Bad Bunny was going to perform, the first song was a huge market. You know, it did over $100 million of trading volume. But you know, as a federally regulated marketplace, and it's a great question because there's been a lot of, I would say, confusion around our industry. Because there are, you know, regulated players and there are unregulated players. You know, the regulated players are American onshore, the unregulated players are crypto-based offshore. And there's a huge distinction because the regulated players, you know, ban certain set of markets, you know, like war, terrorism, assassination, things that could have reverse incentives. They ban insider trading, so you cannot do insider trading on Kalshi. And they ban all the usual bad sort of fraud practices and bad trade violations that you would see in offshore markets. And that's a key distinction.
Hey, Tarek, let me just follow up on that a little bit. I mean, it's such a weird thing to have bets on what Bad Bunny's first song would be or what Brian Armstrong might say at the top of the Coinbase conference call. I mean, if you're looking at sports gambling, sports players are not allowed to ever gamble or be involved in these markets because they control the outcome. Just like Brian Armstrong said, he noticed on one of the prediction markets that, you know, people wondered how many times he was going to say these certain words and then listed them all off. Bad Bunny, by the same level, could see what's happening with this and then change his lineup on what he's going to do in the first thing. How are you making sure that as a marketplace, you are limiting the impact of a person who has control over the bet that you're placing or that you're offering, doesn't manipulate it, either for their own gain by being able to place bets or being able to tell their friends and family what would go along with those lines. It's bizarre to me to be able to bet on these things and have someone who completely controls the outcome and you don't know if they're betting or if their friends and family are betting on it.
Well, the insider trading risk is very real for a stock market as well and has been real since the stock market has begun.
But I feel like we control that and we can trace it. The SEC can very quickly find out who profits, by how much, and they shut that down. Do you do the same thing on Kalshi?
We do the exact same thing on Kalshi. So as a regulated financial market by the CFTC, we have the same rules as the NASDAQ and the NYSE, and we have the same mechanism of enforcement. So the example you just made is amazing. I mean, we KYC our customers, so we know who the customers are when they onboard to Kalshi. Like when you onboard to a brokerage, we know their name, their address, their social security, oftentimes their ID. We know exactly who they are, and then we detect. We have systems that detect any weird patterns, suspicious trades, just like the NASDAQ does. Then it goes to surveillance. We have an investigation staff that runs an investigation and checks who was behind the trade and what they were doing. And if they were doing something wrong and there was insider trading, the punishment goes from fines to referral to the CFTC for criminal prosecution. So the same exact rules, same exact mechanism. And actually, just last week, we beefed up our mechanism of surveillance. We just announced our new head of enforcement, Bobby. We hired Brian Nelson, who was the former Undersecretary of Financial Intelligence, and created an audit committee that is going to oversee a lot of our measures around insider trading.
So, Tarek, here's a question for you, though. I'm going to give you a really complicated one. It's going to be fun, though. It's a fun, philosophical, but maybe practical question. Okay, so let's say you're a dancer for Bad Bunny, and you knew what the situation is, and then you made a bet. It sounds like that would be considered insider trading, right?
So that's a great question, and it is a little bit of a philosophical question. What is information and what is insider information, right? If you go park in front of a Walmart and count the number of people going in and out to estimate their sales, that's information. It's not insider information, right? If you're an executive at Walmart and have the numbers beforehand and you trade on that, that is insider information, material non-public information. Same exact rules apply to a regulated exchange like Kalshi, right? So if you did research and you were in SF and you were, running around the stadium to try to get information about what song was going to get played, that's information. It's fair game to trade. If you had access to information that you're not supposed to reveal to the public, material non-public information, you cannot trade on that.
This is not regulated the same way.
But this is why I wanted to raise the question with you, because most business executives recognize
what they can against
what's confidential,
right,
what's not confidential, and therefore they keep it within a very close circle. In the context of Bad Bunny, for example, the dancer may know the information, and whether that's or whether they're right.
Trees at the
all of those people. But what I was going to say is, let's say there's a cameraman who was happens to be in the stadium during the rehearsals 2 hours early, and by the way, they have nothing to. They're not associated personally with the Bad Bunny scenario. That would be, you could argue, that would be like somebody at a hotel who sees a rehearsal of a CEO giving a presentation prior. Those guys would have normally probably had to sign NDAs by the company because they would be worried about these issues. But in the context of this, they probably wouldn't. And therefore, so how do you think about that?
But just to add another layer to that context, what if it's his manager who knows the lineup and tells his girlfriend who tells her hair salonist? You can't go after his manager for sharing public information that's not, not something that needs to be regulated. You guys are the ones that are making bets.
It's either one of two cases. Either this information can be public, and that's okay, or it's information that cannot be public beforehand, and that's communicated to the staff, right? The cameraman or the dancer, the reason why you don't know what song is going to be played first is either that's not public and not everybody knows beforehand. It's a little bit of a surprise Super Bowl.
Yeah, but it's not non-material. It's not material information that can't be shared. You're making it that by putting it on this betting platform, but they have no obligation to say we're not going to tell anybody our opening lineup because there might be money made on this other place that's now betting on this. That's not the responsibility is not on them.
Well, the question here is basically, either, for example, if you're, at work at the Fed, you're clearly not allowed to basically reveal the information beforehand. And
but this is not material. This is not information they can't. This is not crucial to a company that you say you've got to release this to everybody at the same time. My lineup, I can tell whoever I want what my lineup's going to be or which story I'm going to do the rest of these things. And you can't come back at me and come after me for that.
Well, if that's the position that people are basically.
It's not material information.
If that's the position that people are taking, which is essentially this is not material, it's not material non-public information. It's basically, it's okay to actually talk about which song is going to be played, or it's okay to be, to divulge a series of information beforehand. Then that it's okay and it's totally fair game. And I agree with you in that case, right? And if
that just doesn't seem like a fair market trade. Like that seems like there's an advantage to people who have this information that there's no way you could go after them because this is not material information.
This has been an age-old question for all types of financial markets, right? Should the farmers be able to trade on grain futures, because they have more information about the crops? And we have answers to questions in the
But
Commodities
you're
Exchange
never going to be
Act.
able to tell Bad Bunny he can't tell people what his lineup is because some unrelated entity is making bets on this that he has no relationship
Well, but
with.
if he can
has
tell,
no-
and if he can tell people what the lineup is, and that he wants to divulge that beforehand, that's fair game, and that's part of what the risk in the market is. Basically, people are buying into, right? I think the important thing, and maybe just to kind of close that line, is essentially like we as a company have always been we spent 4 years getting regulated ahead of time, to launch this marketplace.
I give you guys credit. You're in a better position, but.
And as we engage with policymakers and regulators, there is, I think, over time work that we're doing, and the CFTC chairman just talked about this, about promulgating new sets of rules around these types of markets to make it clear to the general public, like what is kind of fair game, what is not, how do we kind of consider what's insider information and so on. And this is something that Kalshi is very pro. Richard Torres came out with a ban on insider trading a few weeks ago, and we came out pro that bill. And as a company, we want to work with, I'm here in DC, we want to work with policymakers and regulators to get that right.
Two related things. Brian Armstrong's made a very interesting point that he actually thinks, in terms of signal and the noise, that you actually want to have insiders trading. Now, that's not necessarily about the trading itself, but about the signal that comes from the trading, to the extent that there's sort of an interesting component part of what you're doing. You're providing a very valuable signal, if you will, to the marketplace about what's happening. That's a different element of, a different way to think about this, but how do you think about that?
That's a great question, and it's beauty, as an industry that's becoming so big and consumers are adopting it, there's some disagreements within the industry, and I disagree here. So I think that same line of thinking could apply to the stock market. You could say, well, you should allow insider trading in the stock market because that would make it more efficient and pricing would be more real time, and that would be true. The problem in practice is, if there is insider trading that is happening in the stock market or on prediction markets, people lose trust in the system. And if people lose trust in the system, they stop trading, which means volume dries up and liquidity dries up, and that's a bad thing.
Tarek, you guys are announcing a deal this morning, a new partnership, and I wanted to talk about that a little bit. Can you tell the audience about it?
So we're very excited about this announcement. We're announcing a partnership with a company called GamePoint, which specializes in sports insurance. And so what they do is they sell insurance to sports teams on a variety of different things that usually impact sports teams. And one key use case that we're starting to work on with GamePoint is on compensation, on compensation for coaches and others, where oftentimes when teams win a championship, there's a big bonus package that teams have to pay out. And usually what they do is they insure it through traditional reinsurers, companies like Lloyd's, Munich Re, Swiss Re, and others. And that's the beauty of a marketplace-based mechanism. Now we have a better way to basically hedge and insure those risks, which is Kalshi, because the pricing is better and it's more transparent. And there's going to be a whole kind of series of hedges that we're going to be putting out over the next few weeks.
Can I ask a larger question about hedging? And it's interesting, I know a number of investors who are now using your platform and others to quote-unquote hedge their bets, not necessarily in the sports context, but I think actually in the market context, meaning they buy a stock in the stock market and they hedge their risk by making a bet on the other end that is representative of the opposite in some way or shape or form. Having said that, if that is the case, do you have any concern that it perverts the signal, if you will, about what the ultimate outcome is going to be? So if somebody's hedging their risk by betting on a political outcome, for example, but they actually are betting against somebody, not because they think they're going to lose, but because it's a hedge against something else that they're doing, what that says, therefore, about the signal that we all receive?
That's a great question. So the general answer is no. I mean, I think the beautiful part of markets is you need hedgers and you need speculators, and that's when they come together, it brings a liquid, efficient, transparent marketplace. And so yes, when a hedger comes in and wants to offload some degree of risk and transfer it to another party, it could move the price a little bit. But that's why you need the other parties on the other side, because the other party will find price inefficiencies, like in the traditional financial markets. And those price inefficiencies means an opportunity for the other party, the speculators, to make money off of that hedge. And that's why the interplay has been so neat in our markets, in our type of markets. Is like, the farmers are offloading some risk, and then the hedge funds or other speculators on the other side come and take that risk, and they provide liquidity to the marketplace. So overall the market self-calibrates. That's why it's so efficient. It just sort of like there's a mechanism to self-calibrate as people kind of price out the inefficiencies.
Tarek, it is a longer conversation. I know I'm personally fascinated by prediction markets and what you're all doing, and we appreciate it and hope to see you again very, very soon.
Thanks for having me.
We should mention, by the way, that CNBC and Kalshi have a commercial relationship that includes CNBC having a minority investment in Kalshi. Squawk Box talks about Kalshi and some of the Kalshi numbers often. We'll talk about more of this in Welcome back to Squawk Box. It may be the dead of winter, but you may want to start thinking about your summer vacation, especially if you want to rent in the Hamptons this year. Robert Frank joins us with the story that only Robert Frank can bring us.
It's getting started early this year, Andrew. That's because sales prices in the Hamptons just hit an all-time record. The median sales price in the fourth quarter topping $2.3 million. That is up 34% from a year ago. That's according to a new report from Douglas Elliman and Miller Samuel. Now, the average price soaring to $3.8 million. Brokers and analysts saying that the top end of the market is now dominating sales, which pushes up that median. Last year's big deals included a $115 million sale in Amagansett and a $67 million sale in East Hampton. Brokers say the wealthy New Yorkers who moved to Florida after the pandemic are now buying in the Hamptons to spend their summers, and they're also seeing a lot more buyers from California.
California? What's going on?
Well, you've
Weather's
got
too hot over there?
taxes there. A lot of people, it's taxes, high cost of living. Inventory in the Hamptons also low, especially on the water. Summer rentals already starting to go fast. Gary DePersha telling me he just rented a waterfront home for close to $1 million for the summer.
Why are you showing my place? I didn't want that on TV.
There it is.
I told the
There
producers
it is. There's
not to
Andrew
put my
there
place on the
lounging
air
with
like this.
his drink. But DePersha said
thing for me.
he still does have a few, including
That's a
this
joke.
oceanfront 9-bedroom home that Andrew's going to look at right now, available for any 2 weeks this summer, any 2 weeks for a mere $700,000. Now, for more on the high-end real estate market and where the wealthy are buying and selling, you can sign up for the new Inside Wealth newsletter at cbc.com/InsideWealth. So, Andrew, you must be talking to a lot of these people that spend summers there. It's interesting because last year, it seems a long time ago, the first half of last year was terrible in the Hamptons. For sales, the rental market as of May was down 30%, and even the beginning of the summer was the worst rental market in the Hamptons that many brokers had seen for years.
Right. And now they think it's going to be the best.
And now they're saying it's.
So here's the wildest part about this to
Yes.
me.
Yes.
We went through the whole fall having, fantastic debates about capitalism, socialism, and New York City and the hub of capitalism turning into a socialist city, and how everybody was going to race for the exits. They were going to leave the state. They were all going to get out of here. For the Hamptons to be successful, you actually ultimately, I think, have to believe that New York City is successful. Maybe you disagree with that now that it's people coming from all over. But we just had Scott Reckler on from RXR this morning talking about just sort of what's happening in the city. And he says more people are coming to the city, there are more offices, more this, more that. And I don't know what you think that says about sort of the politics of the moment, and whether maybe that's a bet that none of these things that the mayor wants to do are going to happen, or maybe it's a bet that it doesn't matter.
It's a bet that for New York City to be successful, for the Hamptons to be successful, financial markets and Wall Street has to be successful. And that is what is driving everything right now. Is you've got 3 years of double-digit returns in the stock market, continued strength this year, and the balance sheets at the high end, we've seen it in this K-shaped economy, are so strong that despite the tariff concerns that started out the first half of last year, now it's all about the money. And there's so much of it driven by Wall Street.
It's probably also that the mayor doesn't have control over raising taxes like the governor of California does, where you actually do see some of these high net worth individuals looking for new places, including word that Mark Zuckerberg and Priscilla Chan are buying a place in Miami.
That's right.
Or outside of Miami.
Yeah, that's right.
Robert, thank you.
Thank you, guys.
Appreciate it. Meantime, we're going to get to the big story of the morning, Bitcoin. Prices remaining pretty volatile. We are still under 70,000 right now. Strategy, though, is buying more, adding about $90 million worth to its stockpile. Joining us right now is Michael Saylor, Strategy Executive Chairman and Founder. Doubling down, sir, at a time when others have gotten pretty nervous about what's going on. Want to get into your business and so much more, but just speak to the way you think the price action and movement has taken place. A lot of people trying to come up with an explanation, and I'm curious what yours is.
I think the key to keep in mind is that Bitcoin is digital capital. It's going to be 2 to 4 times as volatile as traditional capital like gold or equity or real estate. It's got 2 to 4 times the performance this decade of traditional capital. It's the most useful global capital asset in the world. You can put more leverage on it. You can trade it in more ways than any other kind of capital asset. So the volatility is the bug, but the volatility is the feature. And we believe that digital capital, because it's so much more performance, is the basis for an entirely new set of financial instruments that we call digital credit.
Is there any argument to be made, though, and given that that Bitcoin has sort of done a round trip since the beginning of this administration, that we are now finally getting to some kind of price discovery moment that's fundamentally different? That in the past, Bitcoin, because it wasn't in ETFs, because it wasn't as broad-based, that there wasn't the kind of price discovery that's now available today, and maybe these prices are more realistic than what had been the case before.
Well, there's no doubt the asset is seasoning, and that's a good thing. We just had an all-time high, Andrew, 4 months ago, October 6th, I believe. So if you've got a time horizon of less than 4 years, you're not really a capital investor, you're a trader. and the traders are having a field day with the volatility. Good for them. But the capital investors are looking out 4 years, and if you look at a 4-year time frame, Bitcoin is 2 to 3x the performance of the alternative capital assets, and anything built on Bitcoin over a 4-year or more time frame is going to outperform for the same reason.
The concern, as you know, about strategy itself, to the extent that there are worries within the Bitcoin community, is that, you know, if Bitcoin continues to fall, and I know you've made the argument that you have enough cash on hand to handle this for the next 2 years, that there could be a moment at which you have to sell, not buy.
Yeah, that's an unfounded concern. The truth is our net leverage ratio is half the typical investment grade company. We've got 50 years worth of dividends in Bitcoin. We've got 2.5 years worth of dividends just in cash on our balance sheet. So we're not going to be selling. We're going to be buying Bitcoin. I expect we'll be buying Bitcoin every quarter forever.
Just so we all understand, what is the price at which this story gets much more complicated for you and therefore the rest of the Bitcoin community? I think there's a sense that, given how large a player you are, if the price of Bitcoin were to fall to a place and continue to stay there for 2.5 years from now, and you were forced into a selling position, that unto itself could create a cascading problem.
Andrew, if Bitcoin falls 90% for the next 4 years, we'll refinance the debt.
Refinance where, Michael?
We'll just roll it forward. I mean, again.
But you think banks would lend to you at that point?
Yeah, because the volatility of Bitcoin is such that there's always going to be value. Look, you're at 68,000 right now. Literally has to fall to 8,000, then we just refinance the debt. If you think it's going to zero, then we'll deal with that. But I don't think it's going to zero, and I don't think it's going to 8,000 either. But the credit risk is de minimis at this point.
I guess the bigger question is, I know you have a stock of cash that you can use to continue to pay out the dividends and beyond. How long does that carry you through?
2.5 years, Becky.
I thought you had some.
We've got 2.5 years of cash. We wouldn't have to raise any money.
Okay, so that includes the debt. That includes the debt due next year as well.
We have 2.5 years of dividend coverage and debt coverage in cash. We raised $4 billion this year so far. We raised $25 billion last year. There isn't credit risk to the company. The story here is that the digital credit, STRC, is the most popular credit instrument of the decade. It's trading 100 times as much as traditional preferred stocks, and it generates 2 to 4 times the cash flow of any other fixed income instrument. So that's the revolution taking place. There isn't any credit risk in the balance sheet of the company.
Why do you think the stock's down 60% over the last year?
The company's engineered to be amplified Bitcoin. So when Bitcoin goes up, we go up faster. When Bitcoin falls, our volatility is higher. We've created an asset that's got an 80 vol, and so the stock falls because Bitcoin's been in a bear market for the past 4 months. There's been an extreme drawdown. But at the same time, you know, the other day we had a 25% increase in the stock price in a single day. Our stock is more liquid, you know, on a market cap basis than any of the Mag 7 stocks by a factor of 2, 3, 4. The open interest is the greatest open interest of any of the major stocks in the market. So that volatility creates interest, creates liquidity, creates the opportunity for us to issue the digital credit.
Michael, can you help us with one thing? There's some folks in the community, the Bitcoin community, that believe that there's a floor on Bitcoin at around $60,000 because that is the average price that is effectively or cost, I should say, for miners, and that as a result, the arbitrage will always be around that price. I don't know if you think that's true or not, or whether you think there's a possibility you could fall below that, in which case, what happens to those miners? Obviously, for Bitcoin to be successful in this sort of decentralized world, you need the miners to be mining. Otherwise, the whole thing doesn't work properly.
If you're focused on the price dynamics of Bitcoin, I think it's much more interesting to look at what the banks do, because as the large banks roll out credit against BTC, and you see a lot of enthusiasm from Citi, from Schwab, from JP Morgan, from BNY Mellon, et cetera. As they roll out credit, they're going to negate the miners' influence by a factor of 10. Also, the embrace of large Wall Street firms, the rollout of the next BlackRock Bitcoin income fund is going to have a big impact. And of course, the growth of digital credit that we're issuing. We sold $7 billion last year. We sold $400 million in a few weeks this year. So the issuance of credit on top of that network is going to be 10x the price impact of anything that the miners do or don't do. They're really a third order effect at this point in the future of the network.
Real quick, if you were to make a prediction about where Bitcoin is, call it 12 months from now, what do you think?
You know, I don't really make predictions over 12 months. I think the Bitcoin is going to double to triple the performance of the S&P over the next 4 to 8 years, and I think that's the only thing we need to know.
Michael Saylor, always good to talk to you. Thank you, sir.
Thank you.
Appreciate it.
All right, let's take a look at shares of Coca-Cola this morning. That stock is under pressure. It's off by about 4.1% after earnings came in better than expected, but revenue did fall short of expectations. Global unit case volumes were up by 1%. They were led by the U.S., Japan, and Brazil, and it comes despite price hikes of 4% in North America and 1% globally. Joining us right now to break down the numbers is Bank of America Securities Senior Food and Beverage Analyst Peter Galbo. And Peter, thanks for coming in.
Yeah, thanks for having me.
Look, disappointing numbers. The revenue growth was smaller than had been anticipated. It's a pretty big drop in the stock, too. Before the news this morning, the stock had been up over 20% over the last 12 months. What do you think's happening here?
So, best start for staple stocks in 30 years. Coke kind of being the bellwether amongst them. The organic revenue numbers were actually pretty good. You're up about 5%. Most of the revenue miss that you saw was all FX driven, so kind of not within Coke's control. And that unit case number that we talked about at the beginning, you know, very good. Like, we're seeing consumption growth on the back of price growth. You can't really say that across any other staple.
Super concerned.
Not at all.
The currency issue is a big one for all these global companies. Just the idea with the weaker dollar, it doesn't translate into higher profits like it used to.
So for the multinational staples companies, it's going to be a tailwind actually this year, particularly for Coke, who generates 80% of its profits outside of the U.S.
Right.
Again, they hedge currency, but for a lot of the multinational staples companies, it's been a pretty nice tailwind.
Why do you think this is an overreaction in the stock drop today, or do you think this is a reflection of how far the stock has run?
Yeah, conference calls at 8:30. There's going to be, I think, a lot of questions around actually the price mix number. And Coke talked a little bit about mix impact headwinds in Europe and in Asia in particular. That's where we're hearing a little bit of the concern this morning, but we're going to find out, is that just one time to the quarter, or is that something that we're worried about for 26?
You know, it's a big question in general for some of these consumer products companies, whether they can continue with the price increases they've seen to this point. Just last week, Pepsi talked about how it's lowering prices on some of its key snacks, I think like Lay's and Doritos, because it seems like consumers have said enough with the price hikes that they've been dealing with. Do you think that's an issue for Coca-Cola and others as well?
I think for Coke, in the U.S., it's probably, you're going to see less pricing than you are around the rest of the world. In places like Latin America, Mexico, there's a new excise tax going in place. So most of the pricing for Coke at an aggregated level over the next year probably going to come from outside of the U.S. versus in.
The other issue was that it seemed like there was a little bit of weakness in demand for sugary sodas. Probably not new, probably not a news flash. When you look at GLP-1s, healthier lifestyles, all of these things that are out there, how is Coke positioned? How's Pepsi positioned? How's the rest of your universe kind of positioned?
Yeah, and I think in the quarter you saw Coke Zero Sugar in the U.S. up something like double digits. Yeah. So again, that demand is coming. But I think when you look at beverages as a whole, it's a different need state. You're offering caffeine as opposed to calories, and so it's a different lift for folks. For Coke in particular, they offer kind of the full array, whether it be waters, juices, or the big one going to be for this year, Fairlife and Core Power, right? As GLP-1 consumers are taking more protein in, you know, they're starting up a new plant in upstate New York that's coming online this year. So.
Very quickly, you buy this stock with the pullback today?
Yes.
Pepsi?
We're neutral on Pepsi. Again, a bit of the weakness in Frito-Lay. We're kind of waiting for a turn there, and so far the data hasn't really supported that at this point.
Peter, thanks for coming in.
Thank you. Appreciate it.
Yeah.
Thanks.
When we come back, the clock is ticking toward yet another partial shutdown of the government. Senator Ron Johnson will join us right after this break. Squawk Box will be right back.
Welcome back to Squawk Box. Department of Homeland Security funding set to expire later this week, and Congress remains at a standstill over a deal. Joining us right now is Wisconsin Republican Senator Ron Johnson. Good morning to you, Senator. Where do you think things really sit right now? Is there a chance that we're going to go over the waterfall again?
Good morning. Well, Democrats want to defund ICE, and they want to defund DHS just like they want to defund police. But last year, Department of Homeland Security provided Congress a tally of the number of illegal immigrants with criminal records that were at large, that were non-detained, 650,000. And of that 650,000, there were 15,000 people, illegal immigrants convicted of homicide, 20,000 convicted of rape, of sexual assault. So that's the enormous mess that the Department of Homeland Security, Customs and Border Patrol, ICE is trying to clean up. And Democrats and sanctuary cities, people like Governor Walz and Mayor Fry, not only don't want to cooperate, but they are actively resisting them and putting those agents at risk. So that's what Democrats are pushing right now. That they want to defund ICE. They want to make it almost impossible for ICE to do its job. Of the 10 demands, probably the most obnoxious is they want to require judicial warrants, which is completely unworkable. Our immigration laws have always been enforced by the executive branch through administrative law judges. We have, again, literally millions of cases that need to be adjudicated. Our Article 3 courts simply can't handle that, and Democrats know it. That's their sneaky way of basically neutering ICE.
Let me ask you a question. I think that you can think two things at the same time. I think you can say to yourself, we have a problem with immigration or illegal immigration in this country that needs to be solved, and ICE is a component part, hopefully, of solving that, or largely the big component part of solving that. At the same time, I think there are a lot of Americans who believe that, who also look at what happened in Minneapolis and look at ICE agents wearing masks, ripping people out of their homes and the like, and say to themselves, that's not what they signed up for either. And so the question is how you square that circle. And do you believe that a circle needs to be squared at all?
You know, in Central America, if you become a police chief, the drug cartel sends you a DVD with a video of your family going to church or going to school. You know, as basically a complete a threat. Leave us alone. Don't touch us. How would you like to be a law enforcement official where you have a murky organization that is training activists to impede and obstruct your enforcement actions, where you have elected officials managing a signal chat showing where your enforcement actions are going to be so that these trained activists can show up. Your colleagues have been shot at, they've been rammed, their vehicles have been rammed, their vehicles have had rocks thrown at them. We now know that one of the protesters showed up with a semi-automatic pistol with additional clips of ammunition. That's what ICE agents are facing, where you have cooperation between the state and local governments.
I don't disagree with you. I do not disagree with you at all that ICE agents have a very challenging job. I also believe, I imagine you do, First Amendment, that these people are allowed to protest if they want to protest. Now, we can debate whether those protests go over the line, and then the question is how those people are dealt with. And they should be prosecuted, by the way. I think both of us would agree. They should absolutely be prosecuted if they do something that is illegal, that ultimately impedes the work of ICE in a meaningful, illegal manner. But the question, the secondary effect of that is, do you believe that the ICE officers, for example, have the right training to deal not just with apprehending illegal immigrants, which is their job, but to deal with protesters, which has become part of their job but may not have been part of the training?
They probably haven't been trained to deal with trained activists. They're showing up with semi-automatic pistols with additional ammunition clips. So again, you have to understand, Democrats are trying to neuter ICE's ability to enforce our immigration laws. That is the Democrat position here. They wanted open borders. They threw the borders wide open. We've got millions of people flooding in here, including 650,000 immigrants convicted of crimes, including murder and homicide. And I have a great deal of sympathy for anybody trying to clean up that mess. Democrats want to make sure that ICE can't use masks. Why is that? Because they want their activists to be able to dox them and put their families at risk. That's what's happening. That is the reality, and you have to accept that reality.
Senator, we're going to disagree on this in that I don't believe, but maybe I'm wrong, I don't believe that it's an effort to end ICE because they want the officers to be doxxed. I think that there's a sense.
Why would they do that?
Otherwise, I think there's a question whether police around the country should all wear masks because they could be doxxed too.
That's exactly what Democrats want. Again, we see what has happened. They've been shot at. They've had their vehicles rammed. They have been doxxed. Why would they want to remove their masks? Because they want these officers exposed. They want them afraid. They don't want them to carry out their enforcement actions. They want judicial warrants, again, which would completely neuter ICE's ability to apprehend the 650,000 criminals that Biden led into this country. Again, you have to look at the actual reality situation. Don't listen to what Democrats say. Again, they're trying to be they're sneakily trying to neuter ICE here.
Senator, when you saw Alex Preddy killed,
it was
what did you think? Because that seemed to be a Rorschach test for people.
So what ended up happening is the people who organized this, the elected officials who are encouraging this, they encouraged Alex Preddy to put himself into harm's way. So they knew that those people were endangered, and they got their martyrs, didn't they? They got their martyrs. No, it's a tragedy. I think it's sick. I think it's sick that elected officials would encourage their supporters, their trained activists, to put themselves into harm's way to impede and obstruct legal law enforcement actions. That is exactly what's happening. You have to face that reality. It's a sick reality.
Senator, to the extent that you believe in law and order, how do you hold law and order and and law officers, including ICE, accountable if they're wearing masks and in a system in which it appears, for example, even state investigators, state prosecutors are not allowed to engage in even investigations and the like?
Well, again, it'd be nice if you didn't have the trained activists impeding, obstructing, and threatening ICE officers. That's what they're threatening ICE officers. Now,
and those people, by the way, should be prosecuted. We should prosecute those people. Let's prosecute people who do that.
DHS is happy to have body cams, but now Democrats are kind of backing away from that because what generally happens with body cams, it proves that the law enforcement officers were acting properly in the face of threats to themselves and their own personal safety. So again, I'm all for body cams, but I completely understand why ICE officers would like to continue to wear face masks, particularly when it's cold, because they don't want to be doxxed and threatened by these trained activists.
Senator, it is a longer debate. I enjoy having that debate with you, and I enjoy the fact that you're always willing to engage with us, and we appreciate it very, very much. I do wonder where we're going to get by the end of this week on this very front. Do you think we're going to have a shutdown in the end?
Well, I hope they'll at least do another continuing resolution. The report last week from the negotiations is Democrats really weren't being particularly reasonable. So we'll see what ends up happening here. But if they defund DHS, they defund FEMA, they defund TSA, they're really playing with fire here.
Senator, always enjoy talking to you. Look forward to it again soon. Thanks. Appreciate it.
All right, when we come back, December's retail sales data and the employment cost index. Let's check out the futures ahead of those numbers. Dow futures off by close to 40. S&P futures down by 5. The NASDAQ off by 22. Squawk Box will be right back. right, folks, here we go. We are just seconds away from retail sales data, import prices, the fourth quarter employment cost index, a lot of big numbers that lead us up to the jobs report tomorrow, and then the CPI number that's coming on Friday. Ahead of that, you can see the futures are slightly lower. Dow futures down by 27, S&P futures off by 5, the NASDAQ off by about 23 points. Rick Santelli is standing by at the CME in Chicago. Rick, the numbers, please.
Yes, let's start out with the employment cost index. We're expecting a fourth quarter number to end up around up 0.8%. Comes in 1/10 light, up 0.7, up 0.7%. How does that rate? Actually, that would be the smallest quarterly price movement since going all the way back to the second quarter of 21. The second quarter of 21, where it equals 0.7, you have to go back to the third quarter of 20 to find a smaller number, up 0.5%. So that is indeed good news. Retail sales, these are December numbers. Headline, expected up 0.4, comes in light. Only 0, goose egg, unchanged. That would equal where we were. Well, actually, to find a lower number, you're going all the way back to May of last year when it was down 0.8. That's the last negative number we had. So that's unchanged. If you strip out autos, it remains unchanged. And if you strip out autos and gas, it also remains unchanged. The control group, or the core retail sales, comes in at down 0.1%. Down 0.1% would be the weakest since September of last year when it was down 0.2%. So not good news on retail sales. And if you look at the rear view mirror, X autos downgraded from 0.5% to 0.4. X autos and gas last look from 0.4 to 0.3. And the core number, the control number, our last look was up 0.4. It gets shaved in half to up 0.2. Now let's look at import prices. Month over month, up 0.1 for December. Strip out petroleum, it's up 0.4. 0.4 would be the warmest going back to April of 24. So April of 24, that's something to pay attention to. Those are month over month. Let's look at import prices year over year. We are expecting a number on the year over year to be roughly up 0.1. It comes in unchanged. Month over month export prices, up 0.3. That's triple the up 0.1 we're looking for. That would be the warmest going back to June of last year. And finally, on a year-over-year perspective, Becky, for export prices, up 3.1%, 0.1, hotter than we were expecting, but a little cooler than the 3.3 in the rearview mirror. And how does that relate? 3.1 would be the smallest going back to July of last year when it was 2.4. So a real mixed bag. The market did a nice job of divining all the information, but we see yields moving a bit lower. 416, it's about where they were, but that's minus 3 basis points on the session for 10s. And if we look at the 2-year, 345, it was at 346. 345 is down 4 basis points. We have auctions this week. Today, tomorrow, the next day, and that's 3s, 10s, and 30s respectively. Today's 58 billion 3-year notes to be auctioned at 1 Eastern. Becky, back to you.
Rick, you said the market did a great job of divining all this information. So did you. As always, we appreciate it. And you always give these Treasury auctions a grade, whether it be an A, a B, a C. What grade would you give this mixed bag of data today?
I think the mixed bag of data today would come in around a C. I like seeing some moderation in some of these prices. Employment cost index, retail sales being flat was a little bit disappointing, though, and I think we need to take that into consideration.
Okay, Rick, thank you, and we will see you later today. We'll be watching that auction, too. In the meantime, I want to bring in Kamal Srikumar, who is president of Srikumar Global Strategies. And covering the equity angle for us this morning is Sylvia Jablonski. She's Chief Investment Officer of Defiance ETFs. Very quickly, Sylvia, just looking at the futures, they pared their losses modestly. I mean, we were down 25, now we're down about 4 or 5, so not a big move. But this is pretty important data, and it's just the kickoff of what we're getting this week.
Yeah, absolutely. I think it is a very big week for data, and we had that big pullback off of the AI software story in equities, and now I think a lot of what comes out this week will impact where equities go from here, at least in the short term. So this retail number was a little bit cooler than we expected, right? We thought we were going to get 0.4% there, but it's not dramatic. It still kind of feels like it's in that Goldilocks, era to me, and I think
Goldilocks meaning that the inflation's not The economy's not so hot that you're not going to see the Fed put in the penalty box for forever, but not so bad that it necessarily mandates some emergency.
Correct. Maybe they stay on track for those two cuts that the market has priced in right now. So I think for now we're kind of par for the course in terms of the market. I think we are going to get that recovery from the pullback in AI, but what happens with the jobs data this week will be telling because jolts weren't great, right? The latest job data is showing some softening. So I think that we kind of want to see stability in that number, and that will impact what the Fed does. I think more so than the retail sales number.
Sri, how about you?
I'm not surprised that the retail sales number showed no change, Becky. We had a very strong November, 0.6, and more often than not, you need to look at 2 or 3 months together. So if you take November and December together, it was not a bad retail sales number at all. That's the first part. Second is when you have seasonal effects like buying before Christmas, it doesn't all show up in December. It shows up in November. And we had that. And I wouldn't make a big deal about the inflation number that Rick talked about being somewhat lighter than expected. January, I think, is going to be a pickup. If you look at the past years, every year, January has been a big inflation month compared with November and December because the seasonal factors are not perfect in terms of correction for it.
Okay.
So expect January to be, again, another strong month as far as inflation is concerned. And then looking further ahead, you have a Kevin Walsh chairmanship.
Right.
Hopefully, maybe, in May, assuming that the investigation of Powell comes to an end and all the judicial side comes to an end. And I don't think he will be able to do what President Trump wants at all. He either has to be a sycophant and keep cutting interest rates, in which case you're going to see the yield curve steepen, or alternately, he would have to play the game where he does not comply with it and he is going to be criticized exactly that Powell was in recent years. So if you look for
Can I just interrupt on that point? My guess is that Kevin Walsh will take the playbook that he's been laying out for a while, which is that even though inflation may run a little hotter, he thinks that the Fed can go ahead and continue to cut rates, or at least not raise rates, just as Alan Greenspan did in the 90s when we had our last big tech revolution that was really helping productivity.
Again, go back to the 1999 and go back to the Alan Greenspan era. You had the expectation that inflation was banished and productivity growth due to dot-com boom was going to give you permanent growth. We didn't have that. 2000, we had a stock market crash.
Oh, we also had 2001.
2001 was a
9/11.
recession.
Yeah, and that was the pullback of the dot-com, I want to call it AI, but that was the pullback of the dot-com prices that had really gotten out of control when you saw these prices for the stocks move up so substantially without even earnings to back up any of the numbers. This time
Exactly.
around we have earnings.
But now Kevin Walsh is saying, look at AI, and that is the panacea. That is going to give you no lack of inflation. I don't think that's going to be a successful move any more than dot-com was abolished inflation. So my expectation is it will come back. Inflation will be higher than he expects. And he has to either increase interest rates, and if he's going to also limit the balance sheet as he's saying he will do or threatening he will do, you're going to have one more cash shortage problem like September 2019, regional banking crisis of March 23. And whenever that happens, the Fed reverses course and then goes back to quantitative easing.
We have to run, but Sylvia, very quickly, what do equity markets want? Do they want, as Sri puts it, the sycophant Kevin Walsh, or do they want the one who is criticized by the president for not doing what he wants?
I think that they want the Kevin Walsh that continues with pro-growth and rate cuts, and I think that investors are highly interested in, and you see the flows going into things like quantum computing and AI infrastructure. Lower rates help that cause.
It's going to be interesting to see how this plays out. Sylvia, Sri, thank you both for joining us.
Thank you very much, Becky.
All right, up next, House Democrats are looking to force a vote on the president's Canada tariffs. We have the details next. Squawk Box, we'll be right back. Welcome back, everybody. House Democrats are aiming to force a vote on President Donald Trump's Canada tariffs as early as Wednesday. Emily Wilkins joins us right now with more. Emily, good morning.
Good morning, Becky. Well, look, the House lawmakers, they are gearing up for a showdown over tariffs that's going to really start today. You've got Democrats, as you mentioned, they're going to set to force a vote on overturning Trump's tariffs on Canada. And they're going to do that, of course, by trying to end that national emergency that Trump declared last year that allowed him to impose the tariffs. And given some Republicans also oppose these tariffs, it could pass not just the House, but also the Senate. They just need a simple majority, and that would be the strongest rebuke of Trump's tariffs that we have seen from Congress so far. However, Republican leadership, they're pushing back. Speaker Mike Johnson is going to try today a procedural maneuver to prevent Democrats from bringing up the tariffs for a vote. Obviously, that's a difficult vote for many of his members. Johnson's going to argue that Congress should not act until the Supreme Court goes ahead and weighs in on the legality of using that national emergency to levy tariffs. Now, the ruling is expected soon, but it's not known exactly when. But still, given the frustrations with tariffs from farmers and other impacted industries, Johnson might not have the votes today to block what is likely going to be, again, a difficult vote for many of his members. In addition to challenging the tariffs on Canada, House Democrats, led by Congressman Gregory Meeks, they're also planning to force votes this month and next to end tariffs on Mexico, Brazil, and across the globe. But of course, we're going to have to see what happens today. If Johnson can't block the vote from coming up, Democrats are hoping that lawmakers are going to be forced to weigh in on those Canadian tariffs as soon as tomorrow. And both of those, today and tomorrow, going to be some very interesting votes to watch. Becky?
Emily, we know that the U.S. government is set up as a system of checks and balances on each other. The idea that the Supreme Court's going to be weighing in on tariffs, we've already had lots of people tell us that even if the Supreme Court rules to overturn some of those tariffs based on the emergency reasons that were called in, that there would be workarounds. Secretary Bessent, the Treasury Secretary, has said that the administration would be able to do a lot of these very same tariffs by just changing the way they do it. If Congress gets these votes to come through, would that be a stronger check than the Supreme Court might actually be in terms of stopping some of these tariffs and changing what the White House, what the executive office can and can't do?
I mean, Becky, it would certainly send a message for members of Trump's own party to speak up through their votes and say, hey, we're not actually supportive of the tariffs the administration are doing. Now, to be honest, even if the House and Senate did wind up passing this, Trump still has a final veto there. It's not expected that Congress would have the votes to overcome a veto. So in that case, it's not as big of a check. But look, we've watched so closely this dynamic play out between Congress and between the White House, between Republicans and Trump. And I think it's just particularly notable that when it comes to the issue of tariffs, it really has stood out to me on the Hill as one of the few where you are seeing a number of Republicans raise concerns about it. Now, Mike Johnson's, again, he's going to tell his members, hey, if we can hold off until the Supreme Court weighs in, we'll see if that's an effective argument today, or if members are going to say, look, enough is enough, and I want to have my say on these tariffs.
Yeah, it's such an interesting ongoing evolution in terms of executive powers, the checks and balances on them. And we're going to watch this play out in the coming days, weeks, and months. Emily, thank you very much. All right, still to come this morning, we will talk about the Fed's rate path and much more with Nick Timmeros of the Wall Street Journal. First, though, as we head to a break, take a look at the S&P pre-market winners and losers. Datadog is in the lead. It's up by 14.5%. Stick around. Squawk Box. We'll be right back. CNBC Cures is focusing on rare diseases. This is a new initiative to bring you insights about the biggest stories impacting the rare disease community and highlighting the research that's being done that hopefully will change the way we think about modern medicine for everyone. There's a new episode of my CNBC Cures podcast, The Path, out today. My guest this week is Florida State Representative Adam Anderson. He lost his son, Drew, to Tay-Sachs disease. It's a rare and devastating progressive disorder. Adam's next chapter was as a state lawmaker in Florida, leading the nation in offering full genetic screening to all newborns in the state and potentially saving lives.
Surprised to learn that it could take 4 to 5 years on average, sometimes 7 or 8 years, to diagnose a child with a rare disease. They might spend 7, 10, even more. There's research that just came out that suggests it takes 17 trips to doctors to diagnose a child with a rare disease.
That even sounds low.
And so that's an average, right? I wanted to solve that. So what we did is we set up a state-funded newborn screening program to offer children whole genome sequencing at birth, free of charge.
You can hear more of the Anderson family's story in The Path. It's available on our Squawk Pod feed wherever you listen to podcasts, and the full video casts are up on YouTube as well. Please join this community that we're building at CNBC Cures. You can subscribe to the weekly newsletter, or you can join us in person at the inaugural CNBC Cures Summit on March 3rd in New York City. Up next, the Wall Street Journal's Nick Timiraos on the Fed, the economy, and much more. Squawk Box will be right back. All right, welcome back, everybody. Joining us right now to talk about the recent Fed speak, the Warsh nomination for Fed chair, and much more is Nick Timiraos. He is the Wall Street Journal's chief economics correspondent. And Nick, I'll ask you very quickly, the data we got this morning with the retail sales being a little lower, labor costs, import costs, I think being a little softer as well. Add that up with what we've seen from the job market with those numbers last week and what we're expected to get tomorrow. How do you think things stand just in terms of how the Fed sees its potential path of action from here?
Well, the Fed is waiting to be shoved, really, by the data telling them that they're in the wrong place. So everybody's been talking over the last week and a half, you know, the Warsh Fed, is he going to be able to get the rate cuts that the president wants? His first meeting is going to be the June meeting. There's two before then. And I really think, Becky, on the near-term outlook, the labor market is going to decide this probably more than whoever is leading the Fed. And so whether Kevin Warsh is able to deliver rate cuts at that first meeting, or if the Fed has to do something before then at one of Jay Powell's last two meetings, it really depends on the unemployment rate and the labor market situation over the next few months.
Yeah, we had Dennis Lockhart, the former Atlanta Fed president, on earlier. He agreed with that assessment that really the labor market's going to be the more important indicator of what the Fed does next. Nick, let's talk about Warsh's nomination. You've written about this, about the incredible kind of fine line that he's going to have to walk in this situation. First of all, do you think the nomination makes it through the Senate or even to the Senate floor? Does it make it out of committee?
Yeah, I don't think there's any question about, at this point, you know, the opposition that you're hearing from Tom Tillis is not at all specific to Kevin Warsh, the individual. No. This is really about using leverage here to try to get this DOJ probe against the Powell Fed drop. So I don't really think there's any question at this point about whether Warsh gets confirmed. It's really how do you sequence these things to get him into the position. And then I think you start to have real questions.
Do you think there is the criminal investigation is dropped at some point along the way as a result of it, of his nomination getting pushed forward?
Well, someone's going to have to back down here, right? Either Tom Tillis, who's been, you know, he was on your program, I think, last week, pretty strong stand he's taking here, or the president and the DOJ. You know, something's going to have to give here. You haven't heard anybody, as Tillis said last week, you haven't heard anybody who was in that Senate hearing say they think that they're not pointing to any statement that Powell made saying he clearly lied about this. He knowingly lied to the committee. So, yeah, the confirmation doesn't really seem like the issue here. It's really how do you sequence that DOJ issue.
Okay, and I'm sorry I interrupted you. Your thoughts about how this progresses from here?
Well, you know, Kevin Warsh has talked a lot. He invokes the 1964 Reagan speech of a time for choosing. And I think Kevin Warsh is going to face his own time for choosing at some point between the institution he's going to serve and the president who appointed him. Now, if the labor market unspools here and it's clear that you need to cut interest rates, maybe that's a little bit easier for him. But Trump expects rate cuts, and the committee that he's going to lead does not seem to be in any mood to cut interest rates. And you know, some of his colleagues on the committee have watched him with some pretty aggressive criticisms over the last year, over the last 15 years. So the coalition that got him the job, which is the president's confidence and establishment credibility, is not necessarily the same coalition he's going to need to actually run the Fed successfully. And all the political savvy that I think he used to get the job, he's going to have to call on that to navigate the first 6 to 9 months.
And do you think President Trump will get what he wants in his second Fed chair nominee? You know, he nominated Jay Powell and then pretty quickly decided he was not thrilled with his choice. Do you think he will be in a position of being happier with his choice this time around? Because Kevin Warsh is somebody who has always been seen as rather hawkish on whether the Fed should be cutting rates.
Well, I think Warsh is a little bit of an enigma because of how he campaigned for the job over the last year. He's adopted the story that Secretary Bessent's been telling, that you have an AI productivity boom that's going to allow for disinflation and more rate cuts. But to answer your question, Becky, you know, I think of the great monetary policy scholar Forrest Gump, who said life is like a box of chocolates. You never know what you're going to get. And picking a new Fed chair is like that. I mean, we've had two presidents who picked two Fed chairs, Truman and Carter, and they were not happy with their picks. So, you know, we'll see if history's kinder to Donald Trump here.
I don't think Kevin Warsh is necessarily Nick Burns, but Nick, thank you very much. I appreciate it. We'll see you soon.
Thanks for having me.
In the meantime, let's get a quick look at the movers this morning. Contessa Brewer is here once again. Contessa, hi.
Hi, Becky. Let's kick off with shares of Google owner Alphabet moving slightly lower. CNBC reported yesterday that it plans to raise $20 billion from a bond sale that includes a 100-year bond. According to people familiar with that matter, it looks as Google looks to fund its massive AI capex spending for 2026, those shares down 0.5% in the pre-market. Target ticking higher. The retail giant affirmed its Q4 sales and profit guidance. Target's also making some real organizational changes here, cutting about 500 leadership roles, really focusing on its customers, and Coca-Cola lower after missing revenue expectations for the first time in 5 years. Those shares off 2.5%. For more on the quarter, Coca-Cola CEO James Quincy joins Squawk on the Street today at 10 Eastern. Those are your movers, Becky.
Contessa, thank you very much. All right, folks, that does it for us today. Make sure you join us tomorrow. Right now, it's time for Squawk on the Street.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Mike Santoli and David Faber at Post 9 of the New York Stock Exchange. Kramer has the morning off. Futures a bit soft after a decent start to the week on Monday. Today, mostly on this disappointing retail sales print. It's the worst ex-autos since May. 10-year goes to 415. That's about a one-month low ahead of the jobs number tomorrow. Our roadmap begins with this tech rebound as the S&P scores back-to-back gains and the Dow hits new highs.
Plus, Alphabet's massive debt raise fueling expectations for a record year in corporate bond sales. We're keeping an eye on shares of Coca-Cola. They're under a bit of pressure. This after the company missed revenue estimates. It did forecast modest growth. And Bank of America kicking off its financial services conference in Miami. We're going to have an exclusive with CEO Brian Moynihan. That's just a few moments from now.
Let's begin with the markets. Obviously going to be a busy one with a lot of eco data, retail sales today, jobs tomorrow, CPI Friday. But this is kind of an across-the-board miss on retail sales.
It is, yeah. Miss on retail sales. You can look at the control group, which tries to get to the core trend, and it was also a bit of a shortfall. This is December numbers. It's definitely going to mute the fourth quarter GDP estimate, so maybe we didn't come into the year with quite as much of a head of steam as we thought. Bonds have definitely responded, and also treasuries have been, you know, pretty sensitive to any of these downbeat economic hints, such as the talking down of the labor market data and things like that. So we're now pricing it a little more Fed. We may, you know, get to pricing in 3 cuts. We'll see how that settles out once we get a lot more data. We get the non-farm payrolls and all the rest of it. And so far, it's happening in a way where labor seems to be still the soft point within the economy. I think the markets are okay with that general notion because that's what the Fed's going to take its cue from. And if corporate spending carries the rest of the economy and earnings are still holding up, we can live with that. I do think it's potentially a challenge for how people are positioned coming into this year, though, because it was such a popular trade to say buy cyclicals, and we're going to be off to the races and we're going to run it hot. And anything that kind of clashes with that is going to challenge, I think, the sort of the way the market is postured going into this next period.
Guys, I did want to step in here just to update new news involving the battle for Warner Brothers Discovery from Paramount. They have not raised the overall consideration of $30 all cash that they're paying, but they have answered at least some of the concerns that have been expressed by Warner Brothers board in terms of, let's call it, enhancing and or tightening up the contract as it currently exists. And so we've just learned from Paramount that they, for example, in the $2.8 billion breakup fee where there had been concern about whether it really would be paid or not, or come out of the $5.8 billion reverse termination fee, they say, we're going to make it a separate payment. We're clearing up any lack of clarity around that. That is a separate payment that will be paid the minute you say no longer to Netflix and that deal. And by the way, the $5.8 billion reverse termination fee, should Paramount fail, for example, to actually get to the finish line, would still be paid in full. Paramount will also, and this was another concern raised by Warner Brothers board, eliminate the potential $1.5 billion financing costs. They'll cover that, essentially, is what they're saying, for the exchange offer that's going to take place for the spun-off entity that is the global networks of Warner Brothers Discovery. And they go on from there to also say there's this $15 billion bridge financing. If JP Morgan doesn't step up and provide it, we will find alternative sources. So Paramount this morning coming out, perhaps not unexpectedly, with enhancements to its current deal. By the way, that also includes a so-called ticking fee. In other words, if Paramount were unable to get its deal closed with Warner Brothers, by the end of this year, every quarter from then on, you'd increase the consideration by 25 cents, about $650 million each quarter. So a ticking fee is also added. Will this be enough to actually get the Warner Brothers board to say, okay, we will talk to you, we believe this would lead to a superior offer? Very much unclear at this point. But one thing it may do is enhance their argument with the still influential proxy advisory firms that are going to be important in terms of the upcoming vote of Warner Brothers shareholders to vote on the Netflix deal. And by the way, we did get a date on that. Now, it's preliminary. They filed a preliminary proxy yesterday, another one, an updated one, Warner Brothers did, and we got March 12th as potential date on the proxy card at least. So we can work with that, saying it's about a month away. Paramount now has enhanced its offer. Those are the words it's trying to use here, or is using here to say that. And we'll see what, if any, response they get from Warner Brothers board, but importantly, it also is something that will be a key for shareholders of Warner Brothers to decide as they vote on the Netflix deal on the 12th. And by the way, to that note, this gets somewhat complex, but I did want to quickly share as well. In that proxy, they do for the first time give us at least a range of the debt, not just the debt on the spun-off entity, which is going to be as much as $17 billion, but say it could be reduced by between nothing and $2 billion. And remember, for every dollar of debt that goes back to studio and streaming, Netflix reduces the value of its bid. With 2.6 billion shares outstanding, in other words, if you were to take down $2 billion more in debt on the studio and streaming, well, you'd reduce the overall consideration. How low could it get? Well, if you took all $17 billion in debt off of the spun-off entity of Global Networks, you'd get to a price of $21.23 from the current $27.75 a share, all in cash, that Netflix has a deal to acquire Warner Brothers at. Going to have more later in the program. I'll be joined by Jerry Cardinal, of course, founder, Redbird, also part of the group here, him and Paramount, that are trying to buy Warner Brothers Discovery. Don't want to miss that.
Where do you think it leaves some who have called for 32, 33, 34, including someone who normally sits with us right here?
Yeah, I think you know, Paramount does not say this is best and final, and so I think they want to see what response they get from the Warner Brothers board. My guess is it may not be what they're looking for, and then it puts pressure, though, on the proxy advisory firms potentially to go their way. And as you get closer to a vote, if in fact Warner Brothers doesn't think it can get its approval, then we start to get really interesting. So I don't know is the answer, and certainly I'll be asking Jerry Cardinal about what, if any, money is behind this eventually.
Meantime, busy day for banks. A lot of CEOs on the tape. B of A is holding its annual financial services conference in Miami. Our Leslie Picker's here at Post 9 this morning and has a special guest. Good morning, LP.
Good morning, Carl. Thank you. And thank you to Brian Moynihan, the chairman and CEO of Bank of America, joining us from that financial services conference. I believe it's your 34th annual financial services conference there in Miami. So we appreciate your time this morning. I want to start on the topic of software and some of the digestion that the market has been undergoing as it relates to that. You, of course, work with clients across your various businesses, debt capital markets, equity capital markets, advisory, many more. What are you hearing from the industry as it pertains to the potential for AI to disintermediate it?
Well, look, I think the best perspective I can give you, Leslie, and thanks for having us on and supporting our conference, is to think about us as a major consumer of those activities. So if you think about the great software providers, you know, we spend a lot of money with them, and what we're challenging them to do is to embed the AI capabilities within their platforms, and that's not called software AI, it's their platforms, and bring it, and they're all actively doing that. So I think the debate about what happens to the great software companies with AI being able to do the coding and AI being able to do the data gathering and manipulation and things like that is a strong question. You see it playing out in the market, but on the other hand, I think it assumes that the companies that provide these services aren't making progress and doing great things also. So I think, you know, let's see it play out, but at the end of the day, we'll be spending more money on technology at Bank of America, and we'll be spending with the companies that can help us do a great job for our clients and customers. And I think large companies like ourselves think that way.
Yeah, you spent $13 billion last year on technology, and I'm curious, just with Bank of America as kind of a microcosm of this trend, are you seeing more of that spend going toward AI providers and away from software, or has that not yet happened? Do you expect that to happen as you ramp up spending in the future?
So think of a case in point there. We've enabled all our teammates across the world on the 365 pilot with product of Microsoft with Copilot, and embedded in that, and Microsoft will continue to develop those capabilities for AI into the package, and that goes to what I'm saying. So Microsoft is saying, I've got to have an offering which allows you to use AI on your email and your communications and your data manipulation and work with Excel, et cetera, et cetera, et cetera. So they're bringing that product. So yes, you'll see us continue to invest in that. If you look in like the areas of investment banking, pitch book preparation, now we're using a capability in AI that is more single purpose for that, a specialized model built for that. If you look in the markets business, we have products that are going out and delivering to our customers market information based on our data every morning. It used to take lots of people getting up early in the morning. They still got up early in the morning to check it, but they don't have to prepare it because it's pulling that data in. And so I think you're seeing that across the board, that we're continuing to spend a lot on technology, 13 billion plus, growing significantly. And then in all the areas, you're seeing embedded AI, either embedded or standalone, depending on business. And remember, in Erica, we have one of the few scaled consumer-facing financial services AI products of 20 million consumers using it, that you see, that we developed ourselves. Because 10 years ago, if I'd have talked to you, Leslie, about a model that could answer all these questions, you'd look at me like, why don't you just use a search engine? Well, it didn't work. And that Erica we built, and then Erica enabled us to do alerts, and you're seeing billions of times a quarter the interaction of a model telling a customer your transaction went through the tie, or do you need a question answered? Here you go. So I think it's coming at us all different ways. I think the market will swing back and forth based on people's views of that. But those great software companies, as I said, and our ability to build out the 13 billion just continues to grow.
Yeah, Erica is a perfect case study there. As you look at your own balance sheet, I believe you do break out software exposure, say $15 billion in exposure, which is a drop in the bucket, of course, for Bank of America. But how do you think about just the overall reaction to these concerns about software as you look at your own balance sheet, as you talk to clients, as you think about your own technology spend? Do you think that the market has been overreacting at this point in time?
Look, that's, in our case, that's a capitalized software. That's people who develop products, both external products and integrating our systems, and internal products. So I think if you look at it, that's across $3.5 trillion. It's not it amortizes down pretty quickly, et cetera, et cetera. So I would, and there's capitalized capabilities in that. Look, the debate will rage because the other day you have a very new technology. It's very disruptive to the current software providers, and they're working on it. So if you listen to the people, I think they'll play out. I've got plenty of experts, and we can, then the research function, the best research team in the world, they'll have opinions about that. But as a person who spends a lot of money, we need all of it.
All right, let's talk a little bit more about kind of where the money is being spent in the economy right now. The market, of course, this week is awaiting key data on payrolls and inflation. Based on what you're seeing in terms of your 68 million consumer customers and 3 million businesses that you serve, do you think we're at an inflection point in either of those key data points?
Look, I see that there's a lot of talk about the retail sales number for December. It's mid-February. Let me tell you that in the month of January, we saw our retail consumers, the 68 million you said, move 5% more money in the economy than they did last January. That's very consistent with a strong economic growth environment. And that number has stabilized and been pretty strong. Fourth quarter about the same. This quarter strong. December sales are a little bit affected if you looked in our data by how the holiday season fell and things like that. But overall, the consumer is spending. And if you look at it by cohorts of low, middle, and higher earning people, all are growing. They're just growing at different rates, and that's part of the K economy, affordability, and all the discussion going on. But the consumer is spending money and continues to put money in the economy. And if you think about it, as we have said for many years, Leslie, talking to you, look what they do, not what they say they're going to do. And if you look at what they're spending on in January, they're spending on trips, they're spending on things. Some of the big ticket items came down a little bit, but the amount they're spending went up in the aggregate. So there's a story there which says the consumers are employed, earning money, and are being careful when they can be careful, but are also making sure they protect for their family the ability to take the vacation and things like that.
Yeah, it being more choiceful. There's a lot, of course, also going on in DC that could impact the banking industry specifically. Some perceived as a potential positive, such as overhauling supervisory functions, potential capital reform. Some perceived as negative, though, such as credit card interest rate caps, stablecoin yields, debanking noise. Net-net, would you characterize all of these positives as favorable, or all these policies as being favorable or unfavorable, as you kind of pull them all together?
Overall, the industry is going to reflect the economy, and that's favorable, and it's going to reflect the regulatory balance being put back in. So starting after the financial crisis, we had to build up a regulatory activity which was justified based on getting people in the tent during the financial crisis, fixing capital liquidity and all those stress testing, which has been consistently run. It just never stopped, and it should have, because frankly, once you get to a certain point, you got to let the banking system do what it does, which is support the economy, and it didn't stop. So that pendulum is swinging back, and we want it to be swung back in the middle on very sound foundation, so it will stick to the ribs going forward. I think the other major, so that's capital liquidity. The other major thing is focus on materiality. And at the end of the day, these enterprises are running huge amounts of activity, and at a Six Sigma level, you're going to have a couple mistakes. And if it's not material and you have the systems and controls and data protection, why should it be a matter of significant import if you have one error out of 10 million or something like that? And I think getting that balance back is also critical to the people who operate, so we put more money into helping the economy, helping the technology, applying technology, helping customer satisfaction grow, and less into writing paperwork about something that was not material by definition. So that's going on. On the other issues, I think they'll be neutral and fine for the banking industry, because at the end of the day, what we do is we help translate America, companies and consumers to the market and vice versa. And I think that role is one of the strongest industry in the world. The world envies what we have in our financial services system with all its diversity and all its capabilities, from private capital to bank loans to all the different things that happen to different types of payment systems. And so the competition will win out, and I think it'll all be positive in the end of the day. But underlying that, getting that regulatory pendulum to swing and sit in the middle is important, because swinging it back and forth makes it very hard to operate a company for the benefit of our customers and clients.
Yeah, no, that makes sense on the capital and supervisory functions, but you wouldn't be as concerned about a credit card interest rate cap? Because I know previously you've said that could be detrimental for credit access across the United States and beyond, as well as stablecoin yield, which many in the banking industry have essentially lobbied against, arguing that it could push deposits potentially toward the crypto industry without the normal protections, FDIC and the like.
So I think on those issues, I talked about them, and you quoted what I said, Leslie, is look, I think a credit card cap has aspects of limiting credit availability and maybe shrinking lines and stuff that will not be good even in the near term for the economy. And I think people have laid out all those arguments, and I think that's why you're seeing people trying to think. We're all for affordability. The way we run our consumer business has a series of capabilities for consumers, for affordable credit, for affordable account structures. No overdraft fees accounts. Our overdraft fees are down 90% over the last 15 years. A $5 loan product where you can borrow up to $500 for $5, no interest rate, and pay it back in 90 days. About 8 million customers, if I remember, have taken advantage of that. 40% of our customers open the non-overdraft accounts. We have a no-frills credit card. It's not that low, but it's low. And no rewards, because rewards fit into this and are very sought after by our customers, not only Bank of America rewards, but also our affinity partners. So it's a much more complex discussion. And what you don't want to do is limit credit availability at a time when Americans are in good household balance sheets are in good shape. And you want them to feel and keep spending. That 5% in January is critical to the growth of the economy, because in the end of the day, our consumer spending economy is as big as any other economy in the world on its own. So you don't want to disable that, and limiting would happen. On the deposit flight, it's not me. The Treasury has written their view is that up to $6 trillion, the Treasury Department could move out of the banking system, which then would be constrained to only being in cash at the Federal Reserve or the bank or treasuries. that money won't be able to be lent to small businesses and medium-sized business. We'll be fine. We have great competitors. We'll have the products and capabilities. When I think about my colleagues that are here at our conference presenting the 4,000 banks in America, we have to be careful because they're the backbone. We're the largest small business lender in the country, and we're one of the largest middle market lenders. We know that business, and you need deposits to make it work, to keep credit costs down for those borrowers. And if you raise the cost of deposits, the cost of credit's going to go up, completely against the idea of lowering rates and lowering cost of credit for small and medium-sized businesses.
Right, an additional challenge for the small community banks that are out there, and of course at your conference as well. Brian Moynihan, thank you very much for joining us today from Miami at your Financial Services Conference, 34th Annual. Appreciate it.
Thank you.
And Leslie, you'll keep us posted on Goldman, I think, today, and Wells also presenting?
Yeah, some headlines out of Solomon. David Solomon, CEO, they're also talking about this software issue and some concerns. The fact that they're monitoring, he says that obviously not all software is the same, and so they're basically monitoring their own exposure, which you can kind of see across the banking and private credit industry.
We'll talk often today. Leslie Picker watching the bank's big story this morning. Also, take a look at the futures here. Big basket of broad earnings to look at as well. CVS, Spotify, Datadog, Harley, Coke, Marriott, as futures go green. Stay with us. Got some movers to work with on the NDX today. Datadog with some upside guidance on revenue. Shopify gets an upgrade over at Moffitt. Marriott with a slight miss, although RevPAR was solid. We'll get to all of these after the break. Opening bell in a few moments, and don't forget, you can catch us anytime, anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast. JP Morgan this morning weighs in on the slump in software names. Firms out with a note saying, quote, software has undergone the largest non-recessionary 12-month drawdown in over 30 years, down 34%. Given the positioning flush, we believe the balance of risks is increasingly skewed towards a rebound, and we recommend investors add exposure. This is Dubrovko writing today. Mike, pretty solid defense of the space right now.
I think everybody has sort of surveyed the wreckage, and you've said this is a massive statistical outlier event, that something so radical and imminent has to change about the fundamentals in order for there not to be some value being created here. I think it's a little bit tricky when it comes to behavioral issues and getting people to believe that they're willing to kind of restore the valuations to this group. One of the things you're seeing is an absolute extreme divergence between positioning in semis versus software, not just the stock performance, but everybody believes that the only kind of reliable, high conviction place to be is in the hardware piece of this. So it's going to take some convincing. I think everyone also understands it's company by company, it's which business models work. I am mindful, though, of the idea that once the market has decided that you have to be suspect about the long-term durability of a business model, you're going to have to show it. You're going to have to prove it, and probably they don't get to be as highly valued as they did before, but you know, I'm sure there is value there. And I think it's what's fascinating is how that really did accelerate and intensify this positioning shock that we had. And so you're selling software, you're selling stuff that's adjacent to software, you're selling data and information services, you're selling anything that seems like it's disruptible by AI in order to buy, you know, ag products, railroads, banks, consumer staples, right? All that stuff had these vertical moves, and it wasn't just because people said, hey, economy's going to be great, they've been down enough last year. It really was kind of a repositioning shock. And now the whole question is it through? And I always say, it's like all the different hurricane models. You know, oh, this one says it's going to go out to sea. This one says it's got risk to make landfall. And I think that's where we are in terms of handicapping how it goes from here.
Yeah, I mean, the decline in these stocks, such as this one here, is nothing short of stunning.
Remarkable, yeah.
Especially given the performance that they've had for years prior. But I guess, look, when will we know? I mean, it could be years, right, before you can either prove one way or the other.
For sure, no doubt about it. I mean, obviously, every quarter there's probably going to be incremental clues. I think what happens here too is growth investors leave, value investors aren't quite ready. You know, and so that's part of it. It's like you have to kind of, this has to change hands into a different type of investor. Now you have Salesforce under 15 times. You got value investors who never thought they could buy Salesforce, plausibly, according to their strategy. And now they're going to have to, you know, take a look. And what's fascinating to me, again, I mentioned the adjacent parts this morning. S&P Global, the big index and credit rating provider, had a downbeat guidance. This stock has already been smoked along with Moody's. Last week it was part of that whole thing, and in this notion that these companies that charge a lot for kind of authoritative proprietary data, they have kind of an oligopoly type structure, and the stock just got killed. It's indicated down by another 10% because the guidance was sort of short of their prior guidance from a December investor meeting, you know, in ways that the market didn't quite expect. So I do think that that's going to be an area that is, you're not getting the benefit of the doubt for a while. And in part it's because these companies used to be considered to be such bulletproof, you know, business models that there was a complacent investor base that said, these are compounders, you buy them and never sell them. Buffett owns Moody's, why wouldn't I?
Let's get a look at the opening bell here on the CNBC Real-Time Exchange with the big board. It's Boyd Group Services, operator of Collision Repair Centers in North America, celebrating a recent listing over the NASDAQ. It's Huntington Bankshares celebrating its 160th anniversary as we continue to flirt yet again, 25 points shy of 7K.
So yesterday was the 12th session out of the last 23 trading days when the high of the S&P was above 6950, and we've not yet closed at 7,000. So it's acting as a bit of a ceiling. It'd be unusual if we didn't really make a poke over it, given the fact that market breadth has been good, the advanced decline line's made a new high, the equal-weighted S&P's made a new high. So it'd be weird if the benchmark index didn't at least make a lunge for it. But so far, it's been very muted, and so it's been this kind of day-by-day question of whether the mega cap heavyweights of the index are going to carry. You know, we talked about a little bit of the downbeat economic numbers, yields coming down. Maybe that takes some air out of the cyclical trade, and all of a sudden you can hand it back over to the big NASDAQ names. I still think, for as much as everyone loves the broadening and the industrial renaissance story and the reacceleration of the economy, it feels crowded to me. And I feel as if too many people have been too satisfied with how the market has actually behaved this year for it to continue exactly this way. But, you know, I've been wrong so far.
Yeah, and to add to that energy, where the forward
sure.
PE's at like a 5-year high.
Yeah, I mean, look, I guess you could argue that, you know, the market's going to anticipate an improvement in earnings, and it's going on in materials too, and this is global commodity trade, this real asset binge that's going on everywhere. And, you know, again, it's sort of like, what is the farthest away from AI disruption? And it's taking oil and gas out of the ground and selling it. It's big physical assets. I think it's simplistic to say that, but it's kind of the way money has moved in the last few weeks. And then, you know, you see things like Coca-Cola selling off a little, I guess, you know, selling off a little bit on the numbers today, but it was up so much. And it was up so much because the group was up so much. And so it was kind of like non-tech blue chips had done so well for so long. So you look at Coke relative to the staples sector. I mean, look at the vertical move in the last couple of weeks in Coke. So it's just going to kind of give back a tiny portion of that. And, you know, there was a little bit of moderation in the outlook, and clearly it's not a cheap stock anymore. There you go. So basically, it's just sort of an echo of the staples move.
Yeah, case volume up 1, organic 5, basically in line. I think we're going to talk to Quincy later this morning, but, you know, that retail sales, some of the internals on that, furniture, clothing, restaurants, none of them were that good.
No. Again, December, not good. You know, I think there's a sense out there, everyone is, again, fixated on tax refunds, going to be bigger this year, but you've also had a lower savings rate going into this period, so maybe it's going to come out in the wash. And by the way, it's not too far before, in a month or two, everyone's going to say, it was a huge year in the stock market last year. Some stocks were up a tremendous amount, and all of a sudden people are going to have to sell to pay the capital gains taxes. That happens every year in some measure. So I don't think those are necessarily the big swing factors, but it's a little more of a mixed picture than just, you know, you have 0.5% of disposable income going into people's pockets, 0.5% of annual disposable income in incremental tax refunds, and therefore, you know, the economy's going to hum.
Guys, did want to get to a couple of earnings movers, or at least one this morning that I've been watching, which is Spotify. To Mike's point about stocks that have pulled back, this is certainly one of them, but it is getting a significant bounce this morning after earnings did come in perhaps a bit above what had been anticipated by the analysts and investors who follow the company. Guidance also seemed to be good. You can see there in that headline as well, Daniel Ek, the founder, obviously kind of a new role, but specific to the numbers themselves, total monthly active users up to 751 million. That was up 11% year over year. Gross margin now 33.1% in the fourth quarter, up 83 basis points year over year. Again, these are things that are being embraced this morning by investors after what had been a significant decline. If you go back and take a look at the stock, like so many others, of course, broadly speaking, at least in overall, in terms of questioning their overall growth rate. Premium growth driven by subscriber gains as well, up 8% in terms of premium revenue. And you can see that stock's soaring, Mike.
Yeah. Now, I mean, obviously, there was a tremendous amount of people leaning negative. And I keep pointing out the way it's tracked Netflix in the one-year basis, even on the two-year basis. Take a look at Spotify versus Netflix 1 year. Everyone thinks Netflix is down because of the deal, and it is.
It is,
but
I think.
look at that.
Yes.
It's the same chart.
It is interesting.
And it's a similar type of business model, and I don't know if the concerns were, you know, you get to a certain scale of subscribers. There was a lot of issues with, or at least investor questions about Spotify's margins and if they could preserve it. They've actually outperformed on that measure, and their guidance on margins was better than
And I think that is one of the key reasons why it's getting the reaction.
Definitely some relief there. Yeah.
That's interesting. I wasn't aware of that, but look at that. Yeah, I mean, well, we'll get back to
it's
this.
Just, you know, a lot of times it's like if the same people own the similar stocks, you have a you know, kind of an echo in the reaction.
Sure. Yeah. You know a certain industry. If
you know it, but also one's going down. I need to cut my risk and all the rest.
Guidance on MAU was pretty good.
It was, and on premium subscribers.
You know, ongoing discussions about pricing, right?
Yeah.
And where the consumer's elasticity is.
I do think that's going to hover over it for a little while. Just how aggressive people have gotten on pricing for very various types of subscription services, and frankly, that's what the S&P Global stuff is about too, and FactSet and Broadridge and all these information services companies. Not that they don't have data that people need, but they've layered on so much more on top of it and called it a premium offering and kind of been aggressive on pricing. And frankly, that's the software story as well. So Salesforce and the rest. So I do think it is interesting. I'm not sure if it's a broad consumer read-through from Spotify, but it's certainly constructive. All else being.
Yeah, and to your point, obviously, so many of those software companies that are at risk potentially for those premium services with the next tool that's introduced by Anthropic. Anthropic, by the way, I'm hearing getting very close, guys, to closing that latest round, at least $20 billion, I think, in new capital being raised there. And then we're also waiting for headlines from OpenAI and see where the number ends up there, perhaps in excess of $100 billion. Still fascinating that Amazon is willing to invest as much as $50 billion in OpenAI.
Yeah.
I mean, there was a time,
Really
Mike,
is.
when that number, we would have been talking about nothing else.
I think it was a
$50 billion
headline
deal.
when OpenAI's private valuation got to 100. I mean, so they're going to invest 50 alongside whatever their stated valuation is going to be.
And again, not official. Keith Rooney yesterday talking about how they may close certain parts of this in stages, so not all at once. Keeping an eye on shares of Amazon, which are down now 10% for the year after those earnings on Friday.
And then, of
that
course,
CapEx
they're in
number.
the penalty box.
The chatter behind Alphabet's Century bond.
Right, so
in
all this
sterling.
capital flowing in a similar direction. Yeah, I mean, Alphabet, so they're raising, I guess the new number is 20 billion total.
Yeah.
Part of it in pound sterling, part of it in Swiss francs. So they're going to basically access the lowest cost of capital wherever they can. $20 billion is just like an adorably cute number for, the fact that, Google's a $4 trillion market cap. They have $80 billion in net cash. Even if getting rid of their private
Well, that's
debt.
how you borrow at 95 basis points above the risk-free rate.
Exactly.
Which is
And
where
then the
the spread
100-year
was.
thing is it's a quirky thing. You're essentially helping to solve a math problem for insurance companies that have these long duration liabilities. And so it's kind of a way of like saying, yeah, we think this guys will be around in 100 years, but if not, it's not our problem. Because right now, we've got to look with it for the portfolio.
You did post yesterday about Burry's comparison to Motorola in '97.
It's not invalid, but also FedEx did one in '97. I think Burlington Northern. So there are these companies that have 100-year maturities that do just fine, and the companies are still around.
And others like JCPenney.
But also JCPenney, which was, arguably, even at the time, I wonder if people thought that was a great bet. But again, I encourage people not to be like, I wouldn't tie up my money for 100 years in one. It's not really about that. It's how it sits inside an overall fixed income portfolio when you're trying to balance it against these, very long-term liabilities. And also, I mean, the other piece, Goldman's saying, what's their number? 160 billion in IPOs they think will come this year, which sounds like a good year. It's up, obviously, but they're talking about like 40, 50 billion for a SpaceX / XAI IPO. So they're going to float 3 or 4% of the company if they're going to pretend it's $1.25 trillion market cap.
Yeah.
That's like what Saudi Aramco did.
It's true.
And it's
That's
crazy.
The number of IPOs Goldman's looking at is 120,
right?
Which would be the best since 21.
Yeah, no, I mean it should open up and should be interesting. And I just think it's this funny game of like. $40 billion is a massive IPO,
and yet it's
a tiny
percentage of the
sliver
overall,
of what they're deciding the value of these things. We have to make that clear.
Yes, and by the way, it will, you'll have virtually no float, to your point, as well. Guys, I wanted to get to a story we brought at the top of the hour, of course. Paramount enhancing its offer for Warner Brothers Discovery this morning by, essentially shoring up the contract, tightening things, and addressing many of the concerns of that Warner Brothers Discovery Board of Directors. So that the $2.8 billion break fee is now a separate payment. They eliminate a potential $1.5 billion financing costs with the debt exchange, and on from there. I want to bring in Jerry Cardinal. He's the Redbird Capital's partner, founder, and CIO, and of course, importantly, a partner with Paramount in its continued bidding for Warner Brothers Discovery. Jerry, good to have you this morning. And let me just start with the bidding itself. You have enhanced your offer. You've added this ticking fee. I just noted some of the other key parts of it, but you did not increase the overall dollar value for what you're offering Warner Brothers shareholders. Why not?
Well, look, what did we do today? Well, all we did today is continue to reinforce and perfect our offer. This is our offer that we submitted back December 4th. that the board still really hasn't addressed from a value or certainty standpoint. What we've done is we've perfected it by taking off the table all of the, what I call more clerical items that they have been using to suggest that they're not going to engage with us. So we made it very clear that, we will fund the $2.8 billion breakup fee. If they terminate with Netflix, we will pay that immediately to Netflix. Take that off the table. That does not come out of what we're paying to Warner Brothers shareholders in our $30 a share all-cash offer. We will backstop the exchange offer that they need to execute by the end of the year. And if that fails, we will backstop paying the $1.5 billion fee that they owed to bondholders. So we've taken that off the table. They have a short-term $15 billion bridge loan that need.
Jerry, we seem to have lost Jerry's audio. Let's, well, we've got bells ringing.
That audio's working.
Maybe not a bad time to take a quick break here as they continue to ring the bell while we try and get Jerry set up again, of course, in terms of listening to him. He going through some of the keys, guys, in terms of what they have done here. But as I pointed out, it will be March 12th as of now that we will actually have the opportunity for Warner Brothers shareholders to vote on the Netflix transaction. You want to take a break now? And sorry, let's take a break quickly, see if we can get Jerry back on the audio side, and we'll come back right after this. right, welcome back. We're trying again here. Jerry Cardinal, of course, Redbird Capital Partners. Jerry, we heard many of the things you were raising in terms of your new enhanced bid, so to speak. So let me just follow up with a question, which is simply, what are you going to do if the board says no yet again, as they very well may, to what you've done today?
Yeah, look, what we've done today is given the board a clear pathway to engage with us. Under Delaware law, they have a fiduciary responsibility to deliver the highest value and certainty to their shareholders and or engage in conversations that could lead to a superior offer. So we have done everything to make that very easy for them. If they don't do that, we are in the position that we're in right now, which is, we've gone directly to shareholders and we're making our case to shareholders. Our deal is highly aligned with delivering the best value and certainty. That has never changed. $30 a share all cash for 100% of the company, you can't fudge that. The thing that is very instructive here, we've taken all these other elements off the table in terms of the break fee, the exchange offer, the bridge loan, but what still exists is the debt mechanism in the Netflix deal related to the spin out of Discovery Global. Now that, if you remember the old days, David, where you had these Pac-Man preferreds that would gobble up the equity in these deals. Yeah. Discovery Global is the Pac-Man to Warner Brothers shareholders' equity here. On the studio and streaming deal, they went all cash $27.75, but the reality is it's not all cash because you have to underwrite Discovery Global. Now what they're suggesting is that they put $17 billion of debt on that. That is over 4 times leverage. Versant, which is the ideal comp. You can say, everybody can say, don't look at Versant and everything else. It's the obvious comp. It is right there for everybody, and it's market tested. That debuted
I get it. But Jerry, they're going to come back, and I'm guessing here what the Warner Brothers board might say, and it's possible they'll say the value of that spin is as much as $2 a share, even with the debt load on it. And in part, they might say some of the parts, CNN worth so much more than a multiple of 3.5 times $600 million in EBITDA. TNT worth so much more than that. And so they can easily make an argument it's worth, let's call it $2 a share or more, and therefore it's equivalent, and they say, sorry guys, we're still not interested.
No, that's not how the math works, okay? They've already said in their most recent filing that, they could see $2 billion move over.
Yes,
so they've already acknowledged that it's over-levered, right? And so, the point is this, David. They cannot certify to Warner Brothers shareholders what the value of their deal is. They cannot. It is wholly predicated on where SpinCo ultimately trades, and the capitalization of that SpinCo is what will determine that. You have a comp that simply suggests that it's not going to trade at the levels that they're suggesting. Whatever recapitalization happens at SpinCo adversely affects the cash that goes to Warner Brothers shareholders on studio and streaming.
No, absolutely. And in fact, they did point out in the latest proxy, if you were to take all the debt off, it would value the Netflix deal at $21.23. Now, exactly. I don't believe in any way that is going to happen.
Let's not even go there. If you just do it where Versant is, it drops it to 23.
You have to, Jerry, you have to keep bringing up Versant. I mean, it's painful, man. It's the parent company. We're trying. 3.5 times is ridiculous. That was another argument that they could say.
I think the punchline on that, in that whole discussion that you just referenced, is that it's very hard for these kind of assets to trade independently, right? They should be part of a larger complex, which is why our deal for 100% of the company is really going to deliver the most value.
Jerry, I'm still not convinced you're going to get the audience you believe you will. I don't know, and we'll have to wait and see what Warner Brothers board says. But I could certainly imagine a case where they still say, no, thank you. March 12th now we know is a potential vote date, so it's about a month away. What happens between now and then? Why not raise your offer, or is this best and final? You bid 7 times and you're not going to bid any higher.
Look, it's impossible to talk about best and final when it's a soliloquy. We're only talking, they're not engaged. The board is not engaging with us. So thank God, there's rule of law and democracy in our country. We've gone directly to Warner Brothers shareholders, and we will continue to make the case to Warner Brothers shareholders. The North Star on this deal is none of this commentary. The North Star on this deal is delivering value and certainty to Warner Brothers shareholders. Our deal has not changed. We perfected it even further. Their deal, if they have an adverse regulatory process, every 6 months that goes on is another $1.30 a share of dilution to Warner Brothers shareholders. Our ticking fee, we've got so much certainty and conviction around our regulatory trajectory, that we're going to go the opposite way. We'll pay Warner Brothers shareholders if we don't get, you know, that approval in an expedited time frame like we believe we will. So,
right.
You know, it's very clear that at the end of the day, this is about Warner Brothers shareholders, and they will ultimately be the ones that make a decision on what delivers the best value.
And by the way, though, I can imagine a scenario under which if they don't think they're going to get the vote of their shareholders to approve the Netflix deal, they do go back to Netflix and say you're going to have to pay more, and Netflix does it. It's hard to imagine in some ways that Netflix would have come this far, Jerry, and not be willing to go up another $1 or $2. I don't know. And I wonder what you guys would do in that scenario.
Well, remember, under Delaware law, it's not just the value and certainty now, but the conversations and engagement that could lead to a superior offer. So with everything that we have done, there is absolutely no reason for the Warner Brothers board not to engage with us to determine and to satisfy their Revlon duties.
Right, and so you indicate what? That, I mean, does Larry Ellison actually have more money to put into this thing? By the way, I should point out you, Redbird, and Ellison have gone up in your equity contribution as a result of the $2.8 billion termination fee you're making very clear you're going to pay. So you're at some $43.6 billion. Is there more money behind that, or are you guys out?
You know, I keep saying it, you know, these numbers get thrown around, and I always point out to people, even on my side, that there's a B there, not an M. Right? This is the largest private equity raise in history, and I think it speaks for itself. So, you know, I'm still waiting for anybody to come back and say that our offer is inferior from a value or certainty standpoint. I'm still waiting for that. That has never been raised. What's been raised is taking a trust that's been around, you know, since 1988 and making it irrevocable versus revocable, asking for a personal guarantee from Larry. You know, paying the breakup fee. We've done all of that. Okay, so there's no more balls to hide. There's no more things to hide behind. There's no reason for the board not to engage with us to determine indeed what we're saying is true, that it's superior.
But if they choose not to, which again seems to be certainly a possibility given their previous concerns, you go into a vote. Do you feel like you have what you need to actually win that vote? Which, by the way, I shouldn't describe it that way. It's really simply having Warner Brothers shareholders say no to Netflix. It doesn't necessarily imply they're going to come back to you even and say, okay, we'll deal with you. But do you feel like you're in a position to win that argument now?
Well, let me ask you this question. If you're a Warner Brothers shareholder, what is the value of the Netflix deal? What's the answer to that question? Is it $27.75? Is it 21? Is it 23? There is a Pac-Man. There is a gobbling up of Warner Brothers shareholder equity here that SpinCo
and it's
enables.
an important point for you to be making. I've tried to make it because it's somewhat complex. That said, the more debt you take off of the global networks, the more you enhance its own value in the public markets. And I mean, you're just taking from one side and putting to another, but it's the value of the overall. So, can I make an argument with less debt it's going to be worth more?
Yeah, but Warner Brothers, at the end of the day, Warner Brothers shareholders care about the cash to them, and under the Netflix deal, it's just studio and streaming. It is a contained system, right? But right now, you know, even in their own proxy filing, their DCF on this declining set of assets, independently traded, is 72 cents. Okay, so somewhere in here, you remember when this whole thing started and people were saying it was $5 a share? Then it went down to $3 a share. Now it's down. Now there's a low end of 72 cents. Right now, based on where Versant's trading and based on the $17 billion of debt they have on it, there's negative equity value.
Yeah, it's negative equity.
So if you're a Warner Brothers shareholder, what is the value of the deal?
It's a good question. You continue to ask it. Finally, let me end though on antitrust. You guys have certified basically compliance, I think, with the second request. Is that so? The 10-day clock or whatever it is ticking now, conceivably on U.S. regulatory, correct?
Correct. It's an important milestone. Yesterday, we certified compliance with the DOJ's second request. That opens a 10-day period for them to complete their diligence. And you know, and once that's satisfied, then you have the pathway towards ultimate approval. And so it's a very important milestone. We've also, you know, received clearance from the foreign investment authorities in Germany. You know, so there's a progression here of just, you know, showing a pathway towards the things that we've said on the certainty front and the regulatory front.
All right. Well, if it doesn't work out, Versant is trading at less than 4 times free cash flow, Jerry. Just pointing it out there, you know. Right. To be continued. Certainly appreciate your taking time, Jerry. Thank you, Jerry Cardinal, of course, founder, CIO of Redbird.
You bet. Thanks, David.
Meantime, pretty nice open here. Most sectors are higher. Dow did get it to a record of almost 50,465, let's say. Maybe the only fly in the ointment this morning, Mike, is communication services. That's mostly Alphabet.
Yeah, Alphabet's giving back, some of the outperformance it's had for a little while. And, it's the broadening, it's the equal weight trade that is working. It's particularly rate sensitive, treasury yields down, things like housing related are strong today. I was also going to point out the Bitcoin decline. Now it's hovering around these levels. That chart looks a lot like software.
Yeah, we're going to get to what Michael Saylor said on Squawk this morning about Bitcoin. Strategies down about 3, and Bitcoin's close to the lowest levels of the week. When we come back, an exclusive with Coke's James Quincy on earnings and the consumer as he gets ready to pass the CEO baton.
Tuesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live, as always, from Post 9 of the New York Stock Exchange. Coming up this hour, 2 big earnings interviews you won't want to miss. We will speak exclusively with Coca-Cola CEO James Quincy as that stock dips after missing revenue estimates for the first time in 5 years, though it has recovered nicely. Plus, Marriott CEO Tony Capuano is with us as that stock jumps. The hotel name posting some weakness in North America, countered by strength in luxury and international. And we'll talk with Evercore's Julian Emanuel about Alphabet's 100-year bond offering and what he says that signals about the health of the overall market.
Been a busy morning for economic data. Getting some more right now. Let's get to Rick Santelli. Hey, Rick.
Hey, good morning, Carl and Dee. These are our November reads, so fourth quarter for business inventories. Expected to be up 0.2%, comes in a little light, up 0.1%. That would be the lightest business inventory build going back to August of last year when it was unchanged. We had back-to-back months of up 0.3, which was just revised. October now stands at up 0.2. The positive numbers, of course, are holding GDP. Any kind of negative inventory numbers would subtract for that. And we are all monitoring growth, of course, to try to bring down some of those deficit to GDP numbers. Sarah, back to you.
Okay, thank you, Rick. Let's get into all the earnings. Coca-Cola shares falling, but off the lows after reporting a modest growth outlook for the year ahead. The company missing revenue expectations for the first time in 5 years. Water, sports, coffee, and tea all outperforming the rest of the portfolio for the quarter. Let's bring in CEO James Quincy. His final earnings interview as CEO before Enrique Braun steps into the role on March 31st. I'm going to miss it, James. Thank you for joining us.
Yeah, no problem. You're welcome.
We'll talk about the succession in just a moment. Just first on the quarter, you had conditioned investors to do beats. We haven't seen a revenue miss like this in quite a while. What happened?
I think there were a couple of atypical things that happened in the fourth quarter around some of the business mix, the finished goods of our bottling businesses that caused a negative price mix in the fourth quarter. It was very atypical, and as I always encourage investors to take an average four-quarter view of that variable, because it produces some anomalous effects occasionally, which it did in the fourth quarter. But when you read through that, what you see is underlying strength in the revenue, 1% volume growth, which is relatively strong in consumer products these days, 4% pricing, so 5% revenue. We're confident we've got momentum going into 2026. So a weird anomaly, but underlying strong growth in the revenue and testament to everything that people are doing across the Coke system.
I think that on the organic revenue forecast, 4 to 5%, some were looking for at least 5%. So are you conservative? Is there something that's giving you a little bit of caution out there?
I think it's right at the beginning of the year, and I think we've taken a realistic and prudent approach to a number of markets out there, particularly some of the international markets, where we want to see conditions improve. And we need to do some things to execute better. We had a little bit of weakness in the back of last year in India, in China, and a couple of the ASEAN markets. We've got plans in place. We've got momentum. We've got a lot of things to do, and we're putting those in place and investing for growth. So we want to see those progress through 2026. And of course, in the short term, we've got to offset the tax increase in the Mexican business, which is an important business to us. So I think we've taken a realistic and very prudent approach to the guidance for 2026. But in the end, we're going to continue to invest for growth. If the growth is there, we will chase it and we will invest to get it. And I think what we just tried to reflect is a kind of a realistic view of what builds the outlook for 26.
How does North America look compared to the rest of the world right now?
Look, North America, the U.S. business had a good year in 2025. In fact, it closed the fourth quarter with 1% volume growth and good, strong revenue growth. Actually, the momentum was building in the back half of the year. So as we go into 26, we think the U.S. business is very well placed. I mean, there is a little bifurcation in the consumer behavior. Those at the higher end are spending on premium, but those at the lower end are looking for affordability and lower price points. But we have the ability with our beverage portfolio and our different packs and channels and price points to really be able to bridge and provide a full offer to everyone. So we think our U.S. business has momentum from 25, and we're encouraged. I think it'll be a strong year in 2026. Of course, with America 250 and the World Cup coming to the U.S., we think we'll have a good year this year in the U.S.
So you haven't seen any real change in consumer spending behavior? I'm asking, we got a weaker retail sales report. We're trying to figure out how the consumer's going into the year.
I think that there's been a little volatility through last year, and I'm sure we'll see that again. January looked a little weaker. Did February look a little stronger? I think there'll be some volatility. There's money coming back into the system, I think, with the April tax refunds. So yes, the bifurcation to some extent across the consumer spectrum will be there. But that just calls on us to deliver the options that work for each bit of the population with the money they got in their pockets. And we're confident we can do it in the U.S. In 2026.
What about these new state aid programs around foods, SNAP benefits that are preventing some from buying soft drinks? How much of an impact does that have? It's a movement that is definitely gaining steam.
Yeah, I think there's going to be a number of states moving on restricting what the SNAP can be spent on. In the end of the day, every consumer that's on SNAP has some SNAP credits and has some cash. And whether it's someone at that point of the spectrum or anyone with more money, at the end of the day, you've got to give them a reason to want to buy your beverages. So we're very focused on delivering choice of different types of beverages, different packages, and different price points. So with the money that they've got, that they can continue to enjoy the beverages that they love. And overall, we think that that'll make it a manageable situation for us in the US, and of course, overall for the total company.
But I mean, this movement, the MAHA movement, the dietary guidelines came out. We've talked a lot about the new food pyramid, but they explicitly warn here Americans for the first time against, we know, highly processed food, but also sugar-sweetened beverages such as soda, fruit drinks, and energy drinks.
Yeah, look, we're very much in favor of gold standard science and a balanced diet. And what we've been focused on at the Coca-Cola Company is really making sure we've got a total portfolio. We are a total beverage company. We have options for people all across the spectrum, whether it's categories from soft drinks, sports drinks, water, ready-to-drink teas, dairy, juice. We have options with sugar, without sugar, with caffeine, without caffeine, with protein, without protein. So if we can provide a full spectrum of choice, we believe we'll be able to do well with the consumers.
And what's working best right now? I mean, is it still the zero sugar Coca-Cola? I also asked because I know the president asked you to roll out the cane sugar Coca-Cola. So what's working out there?
Well, Coke's still working. I mean, Coke is the biggest brand. It's one of the most popular brands, if not the most popular brand, as a trademark with young consumers. What's growing? Coke Zero in the US grew in the fourth quarter in 2025. Diet Coke grew in the fourth quarter in 2025. As you said, we rolled out the cane sugar option, 12-ounce bottle in restaurants, 8-ounce bottle in retail stores. So we believe if we provide choice, we can get the growth with consumers. So you're seeing a lot of growth in the Coke trademark. And of course, we've continued to grow with Fairlife. We've continued to grow with things like sports drinks, where we've got Body Armor back to growth. And that's our focus.
Yeah, I mean, Fairlife, it's so great. It has the longest expiration date. It stays fresh for a really long time. So we buy it in my house. James, what's happening with marketing spend? I know you've been using AI more when it comes to generating ads. Does that make you increase your marketing spend or decrease? How are you thinking differently about it right now?
AI, as it relates to the marketing spend, allows us to potentially make the material, make the ads cheaper. Like, we can make them quicker. It costs us less per ad to make. The flip side of that is, with the advent of personalization and media programming and the ability to use AI to do media programming, potentially you can go to different places, and maybe you need more ads, so maybe they're cheaper to make, but you need more of them because you're trying to personalize them. In the end, that's the kind of the back office of marketing, the cost of making the ads. What we really want to see is how much of the money works in the marketplace. Whether we're spending it to show ads to people, whether we're doing outdoor advertising all the way to events. As we talked about, we've got America 250 this year. We've got the FIFA World Cup in the US, Mexico, and Canada. But our marketing spend is across that. So we're looking at the weight of that spend, and we've certainly been increasing that over the years, and we fully expect to increase the amount of working marketing spend we spend in 2026, even if we do end up saving on the back office in the cost about how much it costs to make them.
James, it's kind of an interesting conversation. As a marketer, I wonder whether you think, given some of the suspicion and backlash toward AI content, over time, will there be a premium on marketing content that is not AI? Will the consumer sort of reward that, or are the economics behind it simply too powerful?
I think that the jury is going to be an outbid. I think we might end up seeing the premium being on creative quality. What people are going to ultimately reject is kind of the trash AI stuff, where it's poorly done, or it's poorly imagined and there's no kind of creative delivery in the thing. In the end, the consumer wants the engagement with material that is creatively interesting. Sometimes that can be done with AI, sometimes it needs to be done in a completely different way, even an analog way. Sometimes it's not about the ad, it's about helping people get to the concert or the sports event. But in the end, they want to have an experience, whether it's seeing something or going on being present at something. So I think creative quality, which is, in the end will be driven by the humans, will be the great differentiator.
Speaking of creative content, well, how did you react to your iconic, beloved polar bear in the Pepsi ad at the Super Bowl cheating on you with a Pepsi at a Coldplay concert?
Well, it's great to be #1 that people use your iconography to try and help themselves. But of course, if anyone's spending on the cola category, as the market leader by far, we're the #1 beneficiary. So that's, I guess, in the end, good for us.
Finally, James, since this is your last quarter as CEO, I mean, how are you thinking about the transition to Enrique Braun? Why now, and what do you expect to be different under his leadership?
Look, Enrique's got the skills, he's got the experience, he's got the vim and the vigor to take us to the next chapter. At the end of the day, the day you announce you're leaving, it's always a day too early until it's a day too late. And I think now's a good time. And I think you should expect a mix of continuity, evolution, and some things that we're going to transform. It was said that the future belongs to the discontented. And Enrique wants to make this business better, a little bit better every single day. And I think that he's the right person to go ahead and lead it.
Well, we certainly hope we'll keep in touch with you, James. Thank you very much for joining us on the quarter.
Thank you. Great being here.
CEO of Coca-Cola, James Quincy.
Take a look at our roadmap for the rest of the hour. Coming up, Alphabet's rare century bond, what that signals about the health of the market. Evercore's Julian Emanuel will join us to talk about some of the big picture takeaways.
Plus, Paramount's out with what it's calling an enhanced offer this morning for Warner Brothers Discovery. We'll give you the details behind that.
And after the break, a first on CNBC interview with the CEO of Marriott, Tony Capuano. After the company posted a mixed quarter, including some red flags around North American spending. The stock, though, is surging. We'll talk about why. Squawk on the Street. We'll be right back.
Welcome back. More than 30 minutes into the trading session, here are 3 earnings movers we're watching. Spotify shares jumping after some strong numbers. Monthly active users grew 11 to more than 750 million. Its biggest quarterly user gain ever and above expectations. Similar story for SoftBank shares, gaining double digits after its telecom arm raised its full-year profit outlook. Analysts also pointing to its large stake in chip designer ARM as a tailwind. And watch some of these luxury names in the green today, led by Gucci owner Kering. Sales beat on the quarter despite some declines year on year, with the company forecasting a return to growth in 26. Shares up 11%.
Yeah, it was a lot less worse on the Gucci sales. Marriott, speaking of, shares spiking after the hotel giant beat on RevPAR, which is revenue per available rooms, the industry metric, and issued solid 2026 guidance, though it did miss on earnings expectations. Joining us now, first on CNBC, is Marriott CEO Tony Capuano. Tony, good morning. Welcome.
Hi, Sarah. Good to see you. Thanks for having me.
So I guess that, the street is sort of celebrating a lot in here. The RevPAR numbers, I think the pipeline, the loyalty. How do you describe the environment right now?
I think, to state the obvious, there are some economic headwinds, there's some uncertainty, but we continue to see the consumer prioritize spending on travel and experiences, and that really reveals itself in the results that we reported this morning. I heard Carl's comments a moment ago about the performance of some of the luxury groups, and I think luxury was a real highlight for us in the quarter and the year, with luxury RevPAR up globally over 6%.
What about in the U.S., where RevPAR actually declined slightly during the quarter? Is it government shutdown related? What's the story there?
Yeah, we mentioned this on the call. Had the government shutdown impact not happened, we would have been up about a point in the U.S. and Canada. I would say the U.S. business is sort of steady as she goes. We've guided to similar RevPAR volumes in 26, absent the impact of the government shutdown, which had fairly significant impact for about 43 days.
So is it a tale of two travelers now? Is it luxury versus everybody else?
Well, I mean, the K-shaped economy is certainly impacting the travel vertical. Thankfully, we've got about 10% of our global inventory and 10% of our global pipeline in the luxury tier, so we're seeing real benefit from that. But just 3 years ago, we started pushing into the mid-scale space, and we're seeing some real benefit from that more thrifty consumer as well.
Tony, there's been a lot of ink spilled about international inbound into the U.S. Negative last year. Disney referenced it the other day, looking for some headwinds at domestic parks. Are you seeing it? And if you are, like, what are the implications for things like the World Cup?
Yeah, thank you, Carl. It's an interesting question. We are seeing inbound international to the U.S. down, but if you look on a global basis, our cross-border travel across the entirety of the portfolio is ahead of where we were in 2019. This weekend, I had a chance to spend some time with the senior leadership of FIFA, and it was all anecdotal, but the data they shared about the volume of ticket requests and the bookings they've seen, I think bodes quite well for what we'll see through the World Cup.
What about business spending, Tony? What do you see in terms of sentiment and appetite for business travel, events, which makes up such a big part of the business?
Yeah, I think of the
You hit the idiot pile. Hello.
Those areas as well.
Yeah, talk to us about your thoughts. I mean, yesterday I was having a conversation because I did see a chart that a trader had pointed out to me around, how we're seeing, as you pointed out, the consumer staples, regional banks and industrials all at a record right now. Do you feel that any of this value rotation that we've seen in this market is getting a little bit too stretched, or are you comfortable with what you're seeing out there?
I'm back in the camp that I think this has legs. I really do. I think we have a period of time here. If you go back to the 1920s, when you see the market rotate the way we've seen, and after a period of outperformance by large cap for a period of time, you tend to see the small cap story go for about a decade. And we've only about a year into it right now. So I think we have a long run here for small caps. And within that, I think you're going to see some of the value side of the market do quite well. And that's,
yeah, you think, huh?
Obviously, as you mentioned, banks, obviously, that's going to be an area of interest. But it's also going to be these.
You're too late on the banks, buddy.
Some of the consumer areas that I think the market is, obviously quite worried about the consumer, the state of the consumer. But I think as you look here, you're at the beginning of what could be, with AI kind of as a force behind it all, a productivity super cycle. And that's really going to benefit, I think, a lot of actually companies and earnings, and therefore eventually the consumer.
Tesla.
Yeah, it's picks and shovels, isn't it? Really interesting chat, Francis. Thank you so much for joining us. We'll catch you next time. Francis Gannon there, Co-Chief Investment Officer at Royce Investment Partners. You're welcome. Coming up, we will get a closer look at the big picture with the team over at Charles Schwab.
F minus.
We'll be right back.
Golly. I get an A for calling out spy.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on Schwab.
Looks like the same setup yesterday. Double top.
How's it going?
First day, so.
Sometimes,
Next. Try it again.
you could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
We're back on Morning Trade Live. Spotify is rallying this morning after notching a fourth quarter earnings beat on the top and bottom lines. The audio streamer saw monthly active users rise 11% year over year, with premium subscribers rising 10%. Spotify's guidance for the upcoming quarter arrived largely in line with estimates, so we are seeing a very nice day for Spotify, up at 17.5% right now. Looking across the other content streaming companies today, shares in Netflix are higher. In fact, if you look at a chart between Netflix and Spotify, they've sort of been doing a similar-ish thing lately. Apple is on the line just to the downside, and SiriusXM is down 2.5% as we stand. All right, so we are seeing a little bit of a mixed picture, but mostly higher day for some of these content streaming players. Let's welcome back to Morning Trade Live and get to the big picture now, and welcome in Joe Mazzola, head trading derivatives strategist over at Charles Schwab. Okay, very good morning to you, Joe. So we've got some retail sales, a bit disappointing on the headline with a muted number over in December. Appetite for bonds this morning, we've got the 10-year at 414. I believe that's a one-month low. The DXY is pulling back, obviously. We've seen some regional currency strength. We know the story there. What does this mean as far as some of these GDP estimates in the Fed now?
Well, what's interesting is markets are pricing in maybe 3 quarter cuts in 2026. That might be a little bit aggressive. Remember, this is a little bit old data. It's December data. We're still kind of compiling everything that we need for January, so that'll take some time to get that out. I think what's interesting to me is just maybe the slowdown in the consumer, maybe some pessimism around job growth or lack thereof, right? And what drives purchasing, right? What drives purchasing of big ticket items? A lot of it has to do with feeling, the comfort and the safety and your ability to maintain your job or find another job out there. And while we're not seeing unemployment rates climb higher, we're kind of stuck in this mud, if you will, the sticky little mud where there's not a lot of growth, there's not a lot of firing, there's not a lot of hiring. It's just kind of stuck in the mud, like I said. So I think that's weighing on consumers a little bit, causing them to maybe pull back on some of their, bigger ticket items. And If you look at, where we did see the pullback was in clothing, it was in auto parts, so I think it all kind of trickles down. Now, where does that leave the Fed? I think that leaves the Fed in a little bit of a tricky position because, like I said, I think with markets pricing in 3 cuts, is the Fed now transitioning from slowing down what we consider at one point, or what they considered at one point, an overheated economy? And where's that inflection point, right? Where's that inflection point where they need to start stimulating growth because of a slowing job market? It's going to be hard for them to kind of pick that exact point. So I think, as anything, Sam, they're going to wait for more data to come out before they make that final determination.
Yeah, but for now, at least, we're seeing the 2s, 10s, and 30s all dipping this morning. Talk to us about the state of this rotation trade. Obviously, we've seen another record for the Dow this morning. The IGB is up, which is encouraging, particularly off the back of what we've seen in recent weeks. It looks like names like ServiceNow, Workday, AppLovin, all higher today, which I suppose is, as I said, what you want to see after the damage. But have you got any thoughts on what we're seeing as far as what's working, what's not working, and the state of this rotation trade that we've been talking about?
Yeah, before I got on the show, I kind of looked at the spread between performance in the chips versus the software, and that's the widest we've seen in multiple years. So part of it could be a catch-up trade. I think that makes sense. I think that there's oversold conditions in software. We're looking at the RSI, and on Friday that got to a point where the RSI was around 1415. We haven't seen levels like that since all the way back in 2002. So this is through the great financial crisis, through the pullback of 22 in the tech sector. It had just really gotten oversold. So I think that there's definitely some catch-up trade there. What I think is important, though, is to look at the fact that we haven't set any new all-time highs in the Mag 7 really since October. The fact we haven't set a high in the NASDAQ 100 since October, but we continue to do so. I think 13 of them in the equal weight index, excuse me. So, yeah, the rotation trade, it's real, Sam, and it continues. And I wonder at some point, and this is my own personal guess, is whether or not you can get a new all-time high overall in the S&P 500, not necessarily in the Dow, but in the S&P 500. If you don't have communication services, you don't have tech participating. We're seeing that come back a little bit over these last couple of days, but I think you need to see a bigger thrust there.
Yeah, Ben Emmons from FedWatch Advisors was out with a really interesting note this morning about sort of the short-term memory loss in these markets. And, what he was alluding to was how in recent weeks, borrowing was not acceptable. I mean, we've seen that in Oracle with some of the concerns around tapping the debt markets, that debt-to-equity ratio. But now, all of a sudden, you've got this headline around Alphabet Google with its reported $20 billion bond sale, selling sterling and the Swiss franc denominated bonds for the first time. So they're looking at a lower cost of capital. Then you had this story about Oracle last week looking for more money. And obviously the ratings agencies seem to be okay with that. So we saw a nice rally. Not to mention, when you look across the bond market, I mean, you've seen Japan having to come out and say, okay, we're going to be responsible and proactive with our fiscal spending this year, and then the yen strengthens. It doesn't weaken, which is the opposite of what the Takaichi trade is characterized by. What do you make of this shift as to how the market is thinking about debt right now, Joe? I don't know if you have any thoughts on that.
Oh gosh.
No, I do. Well, specifically, maybe not with the.
I can't take it. We got a symmetrical flag, a pennant flag on SPY. We got a triple top coming up. And there it goes. Now it's turned into an ascending triangle, more or less. But it's still a symmetrical flag. You got possible head and shoulders. You got a double top for sure. So this is going to find out. I think it just broke. You see them squeeze happening right when they get ready to. And that's an ascending triangle, so it could have more room to run. Coming down. Gosh. Yeah, is this the Weldering Corporation? No. Oh, it's not? No. Oh, I apologize, ma'am. No, it's all right. You have a good... You too. What the hell? Oh.
Please record your message after the tone. Press star to discard the recording, or press any digit to end the recording.
Yeah, this is Jim Howard with Always Clean. I'm waiting for somebody to meet me at the IRS this morning, and I was wondering if you could give me some idea when to meet up with him. I was up there for about an hour, and just so if you could call this number back, I'd appreciate it. And my name is Jim Howard. I'm waiting for some guy to come out and look at the lights in the men's restroom. 417-814-0672. Hymns down. That don't make sense. What, had a run yesterday? It sure did, didn't it? Somebody liked it down there at 17. Yeah, Chris, this is Jim. I spoke to you this morning. Is there any way you can find out when that guy's going to meet me out there? I'd really appreciate it if you could work that out. Have a good day. Oh, they were just talking about PLTR. Coin down 71. Walmart, a little overbought.
Morning movers.
Kroger.
To find out what's shaping early market action.
Kroger was a short.
Options Corner. Futures focus.
Because of the CEO, popping on the CEO, that's nothing. Spotify, after earnings, volume high. Amazon up, looking good on that. Tesla, it's up $3 since I've been here. We got Oracle, Mr. up 44 cents. AMD down 63. I don't know what kind of flag that is. Definitely a hard resistance on the 5 minute. I'm gonna go make some tea, get in the mood. Meta go. It's my money maker. What? Macy's. This is finally. Always clean this gym. May I help you?
Jeff, this is Chris. I'm sorry I haven't called you back.
Oh, that's all right.
I left your maybe going straight to another one.
Good deal. Is there a way you could find out when I can meet that guy or any kind of time?
I just asked, but I think I must have been on the phone. Because they said they had you on the list, but it wasn't this morning.
Oh, gosh. Thought it was today.
I'll make sure to tell them to call you.
Yeah, this is kind of important that we get that thing going at the IRS building in a way. But I thought it was today, huh?
Well, I'm wondering if you were thinking of mine. Because I had scheduled Ashley to come pick that
I don't know. She just told me that the electrician was going to be there on Tuesday morning. So that's what she probably assumed or thought. Okay. Yeah, we got to try to get that fixed as soon as possible. Okay, I appreciate it. Yeah. Yep. Damn it. Sucks. The HVAC guy showed up, and the electrician, they didn't have an appointment for him today. Chris Clark is the representative, but he's going to call me back or give them my number to meet up there, but I don't think they were scheduled to show up today. But he's not up. Reagan tells Soviet jokes, that ought to be a good one. Well, this morning I was supposed to meet the electrician, but they sent the HVAC man. They sent the HVAC man. I spoke to the plumber yesterday. He said that gas is coming up, come from a sewage pump. What's happened to America? Nothing ever stays the same. Everything going lame. Woke up this morning, took a trade on the SPY. Called a Darvis box. Called a Darvis box. Whoa! Now I'm in the mood. Damn. That sucks, man. Okay. Whew. We got a squeeze going on. Number 4 on top and number 3 on the bottom on the SPY. So this is going to be the final say if it wants to hold or break. And we do have a triple top. A little bit higher triple top. Symmetrical flag. Gosh. Okay, pennant flag on QQQ. Pennant flag, that's an ascending triangle on the SPX. That's bullish. And we bounced off of Head and Shoulders. Good morning, Livid Goose. Back down. It didn't want to break out. So I think we're going to come back down here. It's tightening up. But I think we're going to come back down here because it failed that 4th. But we're 4 here. We still have a possibility, but the possibility is a lot less now of it breaking out. A lot less. It needed to break out there if it was going to do it. So we could come down and do a double bottom. It'd be a good idea to take this trade maybe. And I'm going to take it a little bit higher. But that was a spot. It should have broke. It had to break out there. It didn't do it. We got a megaphone. That was a megaphone right there. Megaphone or Head and Shoulders. Well, it failed. Kind of like a diamond shape. We got that trend line going down right there. That brings you right to the 200. I'm just going to give my time. I'm just taking my time. I don't want to rush into this today because my head's not in it, for one. I just got to wait for the right trade. When it says, Jimmy, come get me. And we have this previous high right here, which was the orb. Let's go to the 5 minute. We had 3 white soldiers. 3 black crows with a spinning top. Yeah, just wait. Google's not doing what it needs to do. PLTR. I've got 140.84 support for it. Before I jump into it and go long. I'm waiting for a dead cat bounce. SPX is at the pivot point. At the shoulder line right here. So we got it. Well, no. We broke
What's up,
down
Jimmy
below
boy?
the shoulder line. Or did we? There's another shoulder line right there. So yeah, that could be it. Okay, prepare ye in the name of the Lord.
Got 5 minutes till hourly rollover.
What's that? What's that?
5 minutes till hourly rollover.
Oh. We just now hit a support here at the shoulder line.
Yeah, we're on 15 minute.
Good to hear from you.
Oh. I finally got these customers off the phone.
I've been dealing with that shit all this morning. Nothing's worked out.
I missed the move this morning. The 15-minute chart was clear as day. Came right off your 100 EMA.
Oh, God, come on, hurry up. I didn't even have this thing opened up yet to trade. Dummy. Come on, hurry up. They said they weren't scheduled to come out today. The HVAC guy came out, the salesman. Damn it. Now I missed my trade.
It could always dump in the last minute and a half.
Yeah. The 6990s. That was the right shoulder line. It can come back down again. We hit the VWAP too on the /ES on that pullback. That would have been a pretty good entry, I think, for just a scalp. On a 5 minute, but I don't think it matters. 5 minute, 1 minute, still going to hit it.
I deleted every time frame lower than 15 minutes on mine. I just can't trade the noise. Like, I'm so much more comfortable when I'm trading 15-minute candles.
Yeah. Well, that would have been a good one. I'm going to wait. I'm just not, I don't see the market moving much.
Might get a tweezer bottom here on the 15-minute.
We had a double bottom on the one off the VWAP. And I would have probably sold it there too, because that'd have been a triple, close to a triple top.
The funny thing about today is there's been no orders on the order book. Like, it's almost empty.
Yeah,
It started out that way. I've never seen that.
It seemed a little weird.
I think everybody's just scared of tomorrow, so everybody's just sitting still.
Makes me feel like we can come back and hit the bottom of that megaphone on the SPX, and I'll set an alert right above that orb. because that'll be a triple bottom too off that. So I got all kinds of indicators. Megaphone, triple bottom, orb, head and shoulders. That's where I'll sit that right there. Well, we hit it again. This is the second touch.
Yep, that's your tweezer bottom on the 15.
I don't know if I should just wait. I'm going to wait. Now we're below it.
Yeah, I would. I got orders at 69.80 and 69.75. Come back and touch that 100 EMA on the 15 again.
We do have 3 black crows there. AVGO's got a double bottom. Triple bottom, counting after hours. PLTR is coming down to 140.84. And we're stopping right now at a pivot point on PLTR. 142.23. Could get possible reversal on PLTR here.
Meta doesn't look good at all on the hourly.
No.
It just lost all of its moving averages, and it's about to flip the cloud red.
Yeah, there's still a lot of negativity on these shows. I had to turn them off. I couldn't take it anymore. They ask the same stupid questions every day. I mean, I can't handle that. I can handle the news, but I can't handle repeated news over and over. The same questions over and over and over.
And over?
And over.
All right, so if ES loses 60.75, it's going to be a freaking bloodbath. You're going all the way down, that's 69.60.
69.80 too. You got triple bottom.
Yeah, that's so you got your 100 EMA right above your 15-minute forward blow. So you got that 69.75 to 69.78 level
on the ES.
Yeah. It's trying to hold the cloud right now on the 15-minute.
reversed a little bit. That's a downward wedge. Come on now, you don't need to do that. Cup and handle. Then we had 3 black crows. So I don't know. It just doesn't look too Jimmy ready. AMD reversed on that bottom I called. And we got a fallen wedge on Meta. And Apple's about to hit the 200. And Nvidia didn't break the 200. And we got a symmetrical flag on Google. Mr. down 50-some cents. Got a message here. Activity insurance, reply yes to receive alerts. What? Oh, reply yes to receive alerts for account, billing, claims, and blah, blah, blah. Hey, baby, I love Puerto Ricans too. Them Mexican chicks ain't bad either. And then top it off with a Jamaican girl. But I doubt if I ever see a Bill Gates Russian chick. Lulu's up $8. Well, that's the big one today. And there's another one in here I saw just now. Love A firm's up 4. 401's my lucky employee number. I called this one out a little while back here. That's a good one right there. Nice breakout on a firm. Does that mean rocket? The government's gonna build 3 million houses or something. They're putting in legislation to build a bunch of houses. Let me see here. The government building, is it 1 million or 3 million? We've got a housing crisis, so that's probably why they're up. House passes bipartisan bill as Trump zeroes in on the bipartisan housing bill. Damn it, I should have bought that. I knew it yesterday. Oh yeah, rocket had its bounce. Got a symmetrical triple top right now, so it could pull back. It recovered pretty well on that sell-off. And then Friday it didn't do much. Didn't sell off much at all Friday. They probably knew about the bill. There's a triple bottom right there. And then I got a triple top breakout. Fallen wedge. And you got a yin-yang. Beautiful. I should have looked at that a little bit closer, and definitely should have.
Oh, ES is pushing down. Coming back to that 100 EMA on the 15.
Yep, there's a triple bottom right there. You almost hit.
See how if you're on the pit. See how it's been bouncing off that 100 EMA since pre-market. I never even used that line until you told me about it last week.
You like it, don't you?
It's pretty spot on today for the 15-minute.
Well, we're about ready to hit my support, so I'm going to give it a shot. $69.80s. And that's a risky, so don't. 440. Let me see if I can find a bigger chart. There it is. This is a head and shoulders too. It hit 430 just now. It's back to 440 here. I got one just to see if it breaks out the 9 here.
I want to see if it'll come to the bottom of the orb or either that 100 EMA for me on the 15 minute.
Yep.
Where is the Google Pop? The European Union approved Google's $32 billion acquisition of cybersecurity startup Wiz, a win for Alphabet's largest ever takeover, but no pop.
And then they'll sue him half a year later.
That was freaking 4 minutes ago. Where's the pop?
There's 510 on my call. 530. There it is, $100. You know I'm going to sell this thing and it's going to break to 21.
I know on the 15 minute it just reclaimed the cloud. See what it does in the next 3 minutes.
570. God, I want to sell it.
No, you do. Dude, I mean, watch the ES 15 minute. God, this thing looks strong. It just got cloud back. But you do what you want to do.
I got it on the 15 minute.
Oh, do you? You see it reclaiming the cloud?
Well, I don't have it on the cloud. I have it reclaiming the VWAP.
Oh, you don't have your gem set up on that chart.
Hitting that little squeeze, ain't it?
Yeah, if it holds the cloud with a big ass wick on the 15 minute on the bottom, I think I'm gonna go long too.
It's off the 200s EMA and SMA. Also, I'd have took it for that reason. I'd have took it for the triple bottom on the 15 minute. Oh, that's the 5. Shit. 5 minute looks pretty clean too. How are you? Long leg doji.
Yeah.
You have to adjust these trend lines.
That 15 minute candle has a big bottom.
570. And it's a lot tighter cloud on the 15 minute, lot tighter flag on the 15 minute.
30 seconds till rollover. Is it going to hold the cloud on the rollover?
We had 3 black crows this morning on the 15 with a hammer. Then you'd have got out at the double top, triple top, and waited for the pullback with a tweezer bottom on the 15-minute. Back in it here. We got a head and shoulders.
Some volatility.
Rinse and repeat.
Which one are you in, the 80 or the 85?
The 80 for my second time.
Got you.
440, and we're at 430. Still bearish as long as you stay under the 200 now and the 63. If it breaks out of that wall, today was patience. I waited.
What's that? What's that?
Wonder if I should cross the Mexican border line without my passport or my documentation. Wonder how that would go. I'd just pay off the cartel. I'm at 420. Randy? Do. Okay, I'm about ready to stop out of this thing. I'm at the shoulder line. Then we got the double bottom, so I just wait for that. Add one. If it dips below that, I'm out. What do I got this for? I got a damn alert down there. Oh, that's an alert. That's that alert for the orb. Now we're still holding support. We're at the 50 and some greens coming in. Now, why have they got numbers on here? These usually 0. Oh, it's SPX. Never mind. Three black crows with a long leg spinning top. It's on the 15-minute. Now I'm going to go to the 5. Back to 510 here. Oh, here we go. See this here right here? These two shoulder lines. Whoop. Let me see here. It's got an inverted hammer. On 5-minute. Yeah, I think we're going to come up here and break the 63. I got a double confirmation of that resistance line. And that's on the 1-minute. Oh, I might have a problem. I'll just have to have a grilled cheese sandwich today. I don't think I have anything. The resorts are nice down there. Let me take you to one. Get rid of the old man. Cold. It's going to get 75 degrees today, and this stock is down. It's got a fallen wedge. Back to 440 on my call here. I could have got out at 5. Now this is PLTR. Ooh, look at that dragonfly and inverted hammer right there. That could be a possible turnaround. Did anybody take the SPX? Do do do. $480. $5. Come on, baby.
Retail traders. I'm Washboardjim, technical analysis of a sneaky snake trade.
Okay, we're at resistance here to break 63 EMA. And we're just, when we broke the VWAP on the /ES, not really completely. Now see how that dipped right down $100 right there, that one candle. That was the 50 SMA and the 2063 and the 200. All tied up there together where it exited. Do, do, do. Here we're at 540. I'm up $100. And there's that resistance line on /ES. So that's an exit idea if you got in the trade. If we break it, it's going to be a big payday. Triple top. We got a triple top here, so make business decision. And we're squeezing, and we're above the moving averages. We have a whole body above the moving average, and it's a doji. That's on the 1 minute, so that's telling me it's still bullish. And we're about to hit the triple top. So make a business decision. There's 620. We can make a lot of money on this one if it breaks out. Let's stay with that 1 minute. $6. There's your. Okay, we're going to see if we hold this support. If we hold this support, we're going to break out. It's right here. We're above the resistance. $6. Say la ti da. That's twice. Now I'm gonna go make lunch. I got 3 good trades in today. Not a big day, but you know, just don't feel like a big day. Should I rinse and repeat it again? Or am I pushing my luck? If we stay a higher low, percent. I got this strategy down pretty good. Here we go again, right shoulder line, second time. I'm back in it at 340. $350. Could have got my 340. Got 3 black crows.
A new U.S. energy platform is evolving.
390. Oh. 420, baby. Now we're under all them moving averages again. That kind of sucks. It's 420. $450. We passed a few moving averages on that last candle. Oh, there we go. Break it. We're at a resistance right now. If you took this trade at 350, 360, you're up 490. It's 490 right now. Exit idea. I'm telling you. Pay attention. Trade number 4 is a success. For I'm Washboardjim, the founder of the Sneaky Snake trading strategy, where I talk about chart patterns, moving averages, and a supporter of anybody that wants to learn, including legal immigrants. How does he do it? I sit here and watch it. That's 4 in a row now.
Roll over in 2 minutes.
What's that?
Roll over in 2 minutes.
Roll over in 10 minutes.
2. Dos minutos.
Now you're starting to sound like Bad Bunny.
Oh, if you do that, I'll slap the shit out of you.
So I'm telling you, I listened to a song. It sounded like it.
Listen to shit. I turned the channel.
Woo! Oh, what was I thinking here? Funky distracted me.
I'm thinking that 15-minute candles all have big ass top wicks.
Huey in the News. Yeah, I remember that band. 420. YouTubers, I did it again. We're at a shoulder line. We're coming back down to another triple bottom. This has been such a pretty day. This time we'll hit 69.65. Oh, are you okay?
Yes, I'm just freaking indecisive right now.
I'm going to go into the kitchen and make my lunch. I'm going to take a little break because I've had success here and I don't want to ruin it. It's called overtrading. You get complacent. You always catch yourself getting complacent. That's what I like. That's what I learned from playing baseball as a pitcher. I was known to throw curveballs, so everybody would get up to bat would want to try to catch one of my curveballs. Then all of a sudden I'd throw in like a slider or a real slow pitch, and it'd throw them off every time, strike them out. Same with charting, trading stocks. can't do the same trade over and over and over again and expect to be 100% successful. You got to move around and change time frames like what Funky's doing. I go through all my time frames before I take a trade. And right now, here I am set up to get back in this trade at 3:30.
You just had a $2 million sweep on puts on NVIDIA.
Uh-oh.
Come through.
That's not good.
Yeah.
Well, let's see what we got here. $3.10. Triple bottom. Came right to my.
NVIDIA's going to come down. It's NVIDIA's looking bad. It's 15-minute EMA cloud is real mad.
You got a big put on NVIDIA. NVIDIA. Jim listens to bed, buddy. Well, what I do in my private time is none of your damn business.
She goes. Now she's breaking down.
We got a double bot. Oh, I'm gonna have to stop out of this. If it's on hold right here.
You got another one?
I got 310. This is my last support right here.
I'll just show you what I'm watching. That way you can see what I look at. I hope you might not.
If you want to pick up on a Puerto Rican chick, just tell her that you love Bad Bunny. That's it.
See how we're below the EMA cloud and we're below the moving average on the RSI?
Yep.
That kind of gives me more, it gives me a more clear direction than if I try to watch the 1 in 5 minute and just all the bouncing around and all the noise.
Okay. You got your /ES hitting the cloud again on the 1 minute. I got in at the triple bottom and we dipped to a double bottom. So anything below that body, I got to get out of it. Now we're squeezing between the 9 and the 21. And if I go over here to my Funky's cloud, we just broke the cloud on the /ES. I just now noticed I hit my. Did I put that? When did I put that in there? I don't remember. Oh, when I did the double bottom. I got it now. I just put it in. I was going to say if I hit that number, but that's not the case. I charted it for the double bottom. We got 3 white soldiers on the 1 minute. And we broke a triple top. Boom, baby. Ha ha, I got it. 4:30. Thank you very much. From Washboardjim. I'm the founder of the Sneaky Snake Trading Strategy, where I talk about getting out at 460 and buying it at 310. And again, the question was asked, how in the fuck does he do that? Chart patterns, moving averages, and not listening to Bad Bunny unless I'm in Puerto Rico. Oh, this could be a big payday. We got a triple top coming up. 69.73. But I'm out of it. $4.50 right now. Bum 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 bum. Me and a drum. 490. Scalper's Day. That's beautiful. Hey, Magnificent. You're easy and fast to grade me F minuses. So you're awful fast about giving me F minuses. $5.10, $200 contract. He'll give me a D for getting out too early. Watch. Okay. NVIDIA. For you people out in YouTube, when I call NVIDIA, that means NVIDIA. Me and Sam own that patent. $5.80. Are you freaking kidding me? $5.90. Hey, this is the President of the United States. I can't have you on the committee if you can't get out too early. I need someone that can stay in the stock a little longer. Look at that. How's he do it? So did your 15-minute tell you to take that trade? Funk? He's mad. I can tell.
Oh, no, I was muted. Nah, I was over at the other computer.
I see.
I never even saw this.
Oh, you didn't? I was going to ask you, did your 15-minute tell you to jump in that trade? Or was it killing you too?
It held the 63, yeah.
Okay.
Wick below it and then came back above it.
Yep.
And the moving average, the RSI reclaimed the moving average, which is why I'm kind of thinking about going long here, because my RSI is telling me that we're getting buyers in. See how it closes, but if it closes above that RSI moving average, I may go long.
Oh. Well, I'm gonna go prepare my lunch. I can't wait till I retire. I think I'm about done with work.
Yeah, I'm getting murdered today and yesterday and probably tomorrow.
I just getting too old for it.
I'm just gonna start swing trading, so I ain't gotta stay in front of this son of a bitch.
I'll always be in front of it. If I keep averaging 1,000 a day.
Oh, dude, if I was making 1,000 a day, I wouldn't be working the other job.
It's about my average plus. I'm done right now. 2 hours work, 2.5 hours work.
Yeah, you need to be done by 11:30.
Yep.
Now they're just gonna start playing head games with everybody.
I'm cleaning my bell. I've got something new I want to put on my washboard. Just got to figure out how to do it. I think I got an idea. That ain't plastic. Yeah, it's metal. Oh, there it is.
Yeah, they found buyers on it.
No, this ain't gonna work. I have to put it on top of my washboard. No. Right to resistance right there at 550. If that breaks, we'll go a lot higher. And I thought that news with India was pretty good news. We're definitely at a hard resistance right now. And I'm not in the trade, so should have held one, sold one and held one. I only had $620 in that trade.
It's live for you.
Yep. That would have been a good one. $500 would have been if I'd have held it. to that resistance line. Let me see where I got that from. Got it from the inverse head and shoulders. That triple bottom drop to the bottom of the megaphone. There's your 2-day megaphone. We hit the bottom of that megaphone right at open. That's on the 5-minute. I don't want to erase that shit. Then on the 1-day 5-minute, 5-day 1 minute. That's how I charted it up on the 5-day 1 minute. Then it bounced off the double bottom. And what's that candle? I think that's that head and shoulders.
Well, that was loud.
What's going on?
User in a squeeze about to fire.
I think we need to have a poll in here. And do the people like me saying Nvidia or Nvidia? We'll let the room be the final decision maker. Nvidia. I already got the first vote in. So we're at a very important resistance to break. If this breaks, I think we'll break the orb. Don't be shy and use other days' support and resistance levels. Don't be shy and not use the pre-market and after-hour support and resistance levels. There we go. Right to the orb. And I don't even want to look at the price at 640. How dare you? Nancy, would you do me a favor? I'll take 2 volumes and a shot of vodka. Don't forget to hit the like button, YouTube.
I missed Tesla. Oh my God.
Do. She's your beauty. Triple top break. Actually, it's an ascending triangle on Tesla. That's a strong bullish flag. Right there. 425.08. Yeah. Oh, what's this? Tesla? $500-mile semi.
I didn't even get to call it out. Damn it. I got in the QQQ 615s for 97.
That's nice. That truck. AMD's coming back to the bottom again. We got a double top on NVIDIA, and we got bottom on Apple, and Meta has broke the 200. EMA, SMA. So we got setups again. Apple and AMD. PLTR, is that my third support? Or let me see. That's 5-minute time frame. I'm going to look at the hour, and I don't think I can look at the hour on that one. Gosh, this looks pretty. PLTR. Pull down to a shoulder line on the neckline off the 63 on the 1 hour time frame. We got a head and shoulders also, all in this little area right here on the 1 hour time frame. This is PLTR. Now they still think this might. It's you know it's up a lot, but it's down a lot. So that means it's at a pivot point. Yeah, I like that right there. One more red candle. We got 3 black crows on the hour, so this could be a possible reversal. With a tweezer bottom. Yeah. Three black crows. That first crow hit the 200, 100 EMA, 200 EMA. Come on. What the fudge? I gotta get a new battery in here. Might be a good idea. Three black crows on an hour time frame. PLTR. Right about now. See that candle shrink a little bit right here? Ooh, February 20th. OTR. $13. The 145 strike. What the fudge? $149. This is a little risky. Might take all day for this one. PLTR calls, scalping or swing trade. Day trade. Yeah. PLTR calls, day trade or swing, February 13, strike at 145 at 149. Time done on the hour time frame. And I went my limit. So I don't want it to dip.
Oh my God. This market's putting me to sleep.
Uh-oh.
Oh, shit. Oh,
I can fix that.
I don't see any orders except for the ones down at 69.75. And that's bottom of the 15-minute orb. Like, that's it. That's all the orders are there that are on the book. Everything else is light blue. Crazy day.
Must document this historic
Even
moment.
cheddar flow is quiet today.
Get the all-new iPhone 17 Pro on us. Plus, switch to AT&T and we'll pay off your phone balance up to $800 per line.
I hate them frickin' commercials. They ruin everything.
I'm the man.
Qué lindo está ese nene de Titi, mira qué grande tú estás. Tú tienes muchas novias, ¿verdad? ¿Cuántas novias tú tienes?
Titi, yo tengo como 3 novias en la escuela.
¿Cómo es? Mira a ver, que te doy un chancletazo.
Ay, Titi me preguntó si tengo muchas novias. Muchas novias. Hoy tengo a una, mañana
Bad Bunny
otra,
rapper.
ey, pero no hay voz.
I'm literally gonna hurt you. Oh. Ooh, damn. Spot went crazy today. Oh, it was earnings. Got it. All right. I'm gonna go get some hot chicken and beer.
Ah! You're gonna miss out.
Nah, I want to see if it touches my 69.75 or 69.80 today. Ain't playing anything else. This looks like chop.
There we go. It's going to break out. /ES is breaking out, Funky. February the 10th. Oh, the calls are cheap. 69.85s. Are we going to break resistance? This chart's getting a little foggy. The chart's getting a little foggy, but I don't want to lose these major resistance lines. And I still ain't made lunch yet. What time is it? Oh gosh, it's 11:42. Let's clean the chart up. I can't keep looking at this anymore. Okay, this goes back to my day. PLTR is now at 162. I'm up. Oh yeah. Oh yeah. Damn, that looks nice. There we are, next resistance. Get ready to break. The 69.85s are now at 380. But I dare you. Please. You can do it. You can do it, Mr. Grinch. Come on. Right now, I get out of the trade with $100 contract. And PLTR is at 161. Sticker inch.
Man.
SPX at resistance. Oop.
Resistance, the man says.
Yep.
Mm-hmm. Yeah, I came back. My QQQ calls were up 40%, so I said, damn.
Oh, very good. Jimmy said it would run when you left. Don't doubt the Jimmy.
Yeah.
Now we're retesting support out of the breakout of the flag on the SPY. And we had it head and shoulders off the VWAP. And we bounced off the three black crows of the tweezer bottom on the hour on the SPX. And on the cloud of the 9 and 21, we bounced off the cloud, which is right on the pivot point in the cloud, right on the on the top breakout. It pulled back to a good spot right here. I just now noticed on the SPY. Do.
God dog.
IWM's breaking out too.
There's been $30 million in Tesla dark pool prints in the last hour.
How much?
30 million.
God.
Yeah, that's what I said.
Ah, man, not again.
The prints for it today are all red. I don't see any green.
AMD's at the 200. We did break out on the Meta that Jimmy called at the 200. Nvidia, we broke the 200. And we're at the 200 on Apple. And we did bounce up off the bottom. So they were all reversed. They all looked reversible there. AMD has to break the 200 before it becomes bullish. On the 1 minute, and on the 5, just 5 has to break the 50, and head and shoulders, triple top coming up. I'm gonna go get my cooking started. I'm out of that trade. Okay.
Ready.
Oh wow, oh wow. Washboardjim trade stocks at dawn. He's got his eye on the charts till the night is gone. Patterns dance like a wild old song. Breakouts rip and dips of gold. He's got the secrets the wise ones hold.
3 black holes in the morning light. Bull flags waving like they're gonna take flight.
Washboardjim, yeah, he knew it. All right. How does he do it? Yeah. How does he do it? Moving averages, they paint the tail up and down like a shipping gale. Catching the wind, he sets the sail. Green candles climb, the bears retreat. Jim's got rhythm, the markets beat.
3 black holes in the morning light. Bull flags waving like they're gonna take flight.
Washboardjim, yeah, he knew it. All right. How does he do it?
How does he do it? How in the hell does he do it? I'm not sure. 3 black crows, tweezer bottom on the hour time frame. That's how he does it. That's how he do it. That's how we do it.
Jim?
Yep.
Hi. Hey, can you tell me about the 63 moving average?
I can tell you everything you need to know about it. I'll start from the beginning. I was watching, I've traded for like 19 years, excuse me, and I was watching, turned on Schwab, and I started watching the guy on Schwab, and he mentioned the 63 EMA as a support level or a resistance level on multiple time frames. And he sounded fairly religious about using it. So I just started using it. I started looking at it and I put it on my charts. And I realized that on almost any time frame, basically the 1 minute and the 5 minute, even the 15 minute, they like to bounce off the 63. So we got, for example, we got the IWM right here. We hit the 200 EMA, but for many times we were bouncing off that 63 after we broke out from the 200, and it held respect off the 63 for for a good hour, 2 hour, hour and a half, and that's just one. So I started using them in different time frames as support levels and entry levels, and maybe even scalping it at that resistance level if I was under it and I wanted to scalp it. Like right here, first thing in the morning, when we had that dip, and we had them run up there, had 3 minutes to sell that thing. We end up hitting the 200, but there's that 63. There's it respecting that 63. Kind of respecting it right in here. So I just started using it. It's a fast price action. EMAs are fast action with the price movement. And the SMAs is a moving average on the daily close for about 20-day period. So I just started using the 63, and I've had a lot of success with it. And a lot of people that listened to me started using it, started realizing how how important it was. And so did I when I started using it.
Interesting. I do see how it bounces off it quite a bit.
Yeah.
It respects that 63 off it.
Even here, you could tell here, there's many examples. Whoop, I didn't want to clear that. Damn it. I don't have to yet. This thing moving slow today. I might reboot this computer here. So we hit rated open, kept bouncing up off that 63, then finally broke it. Then you came back and hit it again here. Then we had that big sell off below the 9 and the 21, and then they crossed over, and there's that 63 again, finding resistance. Now it's finding support, and that's on PLTR, that trade that I'm in right now for swing. Boeing. Let's see what Boeing says. I'm just picking up any idea here. So you got the 63 again. 63 there, and it's holding up to 63 all the way up through there. Then we finally are closing up on the 200 SMA and EMA. But so I just like using it.
Mm-hmm.
Did you put it on your chart?
Yeah, I'm gonna put it on my chart.
Let me show you the rest of my moving averages, and do a separate chart with all them on it, and one with the one that you use.
I'm using the 10, the 20, the 50, the 200. You know, when I use them, right now nowadays I just have like the 9 or the 10 on there, and that's it.
Yeah.
Because I'm just doing day trading and stuff. Just quick moves. But it's interesting how it bounces up that 63. I noticed that especially when it starts heading up, like once it starts respecting the 63, then it seems to trend up.
Yep. What the fudge? Some of the charts. Yeah, I gotta clean this up. This is too much.
This looks interesting.
Huh, I can't find my...
Can the 5 minute come off the 200s?
It's coming back to support.
Yeah, look at the ES. Look at the 5 minute. Look how the 200s are stacked on each other.
Yep. Might bounce off 69, 85, 48 and stay bullish.
It will be 3 black crows.
And that'll
off
be
the 200s.
Yep. So we got a quad bottom with 3 bodies and 1 wick, or 3 bodies and 2 wicks. 2 bodies and 2 wicks, if it depends on how this closes here. What time is it? Is it around your 12:09?
12:10, yeah.
So we can't use that. The 69.85. So I'm gonna, you know, I'm kind of pushing my luck now. 5 good trades, and but I'm gonna give this a shot.
Just make sure it holds those 200s.
Yeah.
Got 30 seconds till the rollover candle. Because if it pushes past them, I could get my 69.75 touch up and after all day.
At 130. Three black crows. Strike 69.85. At 130. And I'm gonna call this I'm gonna call it 3 black crows with a quad.
Jim, can you tell me about that TTM squeeze indicator on the left?
Yeah. Here, give me a second. Yeah, I traded a TTM squeeze for a very long time. And it's kind of tells you what trend you're in. You have the wave and the squeeze. You also have a an indicator that can tell you $120. I'll get more throw it in here in a second. You can set a squeeze alert on this. I've got my TTM set for the length at 20, NK at 1.5, NBB at 2, and then the alert line at 1. And I'll give you just 125.
And Jim, when you get the squeeze alert, what happens?
It'll tell you which direction the stock's going to go.
Oh.
I'm trying to figure out how I set that up. I can't remember how I set that up. It haven't been a long time.
Yeah.
Did you see my labels I built last night?
Yeah. I tried to load one of them up. I couldn't do it. Might have to have your help again. Well, come on, baby. It can come down to a triple bottom, too. If we don't hold this support level.
It can run down to those 200s on the 5 that I keep talking about.
Nancy, I wish you knew how to cook. You can't even fry a frickin' egg. All you do is give me ice cream. I need a Valium.
Do I want it? Yes, 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 I do. Took it.
He took it.
At my 200s.
He's going to start breathing hard here.
Yeah, I am.
Jim.
Yeah.
I notice you don't watch the VIX too often.
No, I don't.
And I was wondering about that. How come?
The 1 minute time frame more or less tells me. I don't know. I just never got. Here we go. No, we're at 90. I don't know. I think I rely too much on chart patterns. Man, SPY, we're at 85. Always clean as Jim. May I help you? What was that again, ma'am? Cook tupa halai hali hali? That's racist.
And don't forget male chauvinist.
Male chauvinist. Misogynist.
Oh, it's misogynist.
Yeah.
Is Trump speaking?
I don't know. But we're definitely at support here on the IWM.
I just saw a little headline flash. Trump said Iran can't have nuclear weapons.
Oh, that's probably it. I don't think they should have them. I'm still in this sucker. I'm not in live, thank God. We got a double bottom on the /ES. Yeah, I think I'm gonna have to take a loss on this one. Better add a bunch. Nothing there about it. Remember, I called a dead cat bounce too. Not today, but I mean coming up because of that sell-off we had. And that means that we come back and we approach the bottom that we had, maybe a little higher low, and that'll make it bullish. Yep. Israel Channel 12 on Trump. We will. Oh shit. Yeah, I'm in call. Bad mistake. We might reverse here though. I got him at 130. I'm gonna still hold on to him just in case, and should pick up a little more. But I'm not going to take that risk. In fact, I'm going to go into the kitchen, turn on my iron skillet, prepare a grilled cheese sandwich and cottage cheese. And I think that's all I got in there. Oh, I might have some soup. I'll have soup instead. Cottage cheese and a soup. Come on, baby. Come to Papa.
Get up. Get off your lazy ass, yes. Get back at them 200s now.
Got a headache.
Oh yeah, I'm green.
POTR drop too on me. No, I'll be right back. I really got to get something to eat. We'll get it fixed, get it going, be right back. We got a snake. We haven't broke out of the snake yet. So the only thing we got left is the double bottom. Damn. This thing ain't seeing no light. Oh, God. Always clean. This is Jim. May I help you?
Hi, Jim. This is Kyler with Trinity Electric. How you doing?
Oh, doing very good. Give me a second here.
Yeah, I'm just out front here.
Oh, you're at the building?
Yes, sir.
Okay, give me about 5 minutes and I'll be down there.
Okay, no problem. I'll be here.
Yes, sir. Thank you very much for showing up. It's the men's
Yes,
bathroom.
no problem.
It's a men's bathroom on the inside.
Okay, we'll take a look at it.
Okay, I'll be down there shortly.
Bye.
Bye. I was about ready to be stood. I was about ready to screw that up. I was going to say, what the fuck do you want?
Be no bueno.
I gotta leave. I'm stuck in this trade, so I'll sell it. Take a loss for the business. Instead of me. Maybe I'll just hold it. I think I'll just hold it. Fuck it. I might just add on, see if I can save some. Whoop. There goes my lunch, so I'll probably... I'm very stressed out, so forgive me. This bathroom thing's got me going. Okay, you're in charge. Hold the fort down.
Mm-hmm.
My jacket. It's in the car. I got my jacket.
Liv, are you still in here?
Pussy. Pussy.
Hello, you've reached Chris Clark, Business Development at Conley, a wall painter company. Sorry I missed your call. Please leave a name, number, and nature of your call so I can get back to you. I hope you have a great day.
Yeah, Chris, this is Jim again at the IRS building. She might want you to change the filters in the empty building, in the empty lot space next door to the IRS in the same building. So I'd give her a call, unless you already know that. But give me a call when you get a chance. Hello, this is Jim.
Jim, this is Chris. Sorry I missed you.
That's right. That spare space, I think she might include that into it too with the filters.
I was planning on it because she mentioned 13 total systems, and that would be the furnaces and the condensers that we saw.
Yeah.
So I just assumed deduct it over into the other side as well.
Yes, sir. Okay. I just wanted to let you know there's, and every time you need to get in there, you just have to give me a call, and I'll open the door for you.
Okay, I'll make sure to put that note on there.
Okay. But I didn't know if you knew that or not. I just wanted to run it around you.
All right, I appreciate you thinking of me.
Yes, sir.
All right, have a good evening.
Yep.
Bye-bye.
Bye. Fuck.
In today's world, a lot of things are pretty easy. Why not make getting your lab
Chevy trucks are as dependable as the Chevy people who drive them. They don't need permission to get going. They all have that little extra something. And maybe you got it too.
Okay, with the help of AI, the internet has just been absolutely blazing on this case. If you missed my video earlier, brand new suspect, video footage. Right now what you're about to see is another brand new piece of video footage that FBI Director Kash Patel just released moments ago. My earlier video will be in the pinned comment and in the show notes and description down below. If you missed it, I go in great detail on the photos and stuff, but I have a theory, y'all. And I'm not going to make any allegations. I'm not saying it's factual. In full transparency, I always do my due diligence. I always do qualitative and quantitative research. And this is just my own theory based on everything, especially this video and what I'm going to share with you. It's hard to even breathe right now. This is insanity, but I think this is really close. So check this out. Here is brand new eerie footage of the suspect walking up. I want you to notice the gait there. When I say gait, the way they're walking, they're slouched, head down, demeanor, posture. Now, one thing that is absolutely tantamount to this case is the fact that the last person who was known to see Nancy Guthrie alive was the son-in-law, Tommaso. It was earlier reported that Nancy was supposed to be going to some kind of church, right? That she was scheduled to attend an in-person church service. But what really happened is that Nancy regularly gathered with a small group of friends to watch a New York-based church service via live stream ever since, 2020 and the pandemic. The group would meet at one of the friends' homes and watch the service live from Savannah Guthrie's church in New York. So she did not arrive at her friend's house as expected to watch that live stream. And that's when the friend contacted Annie, Nancy's daughter, and Savannah Guthrie's sister, to report that Nancy had not shown up. The source emphasized that Nancy was expected to be at her friend's home that morning, not at a Tucson church, and said the circumstances surrounding her absence have been inaccurately described in some coverage. Okay. AI and the internet have been doing some number trying to find out who this masked, curated eyebrow, thick eyelash individual was. At first in my earlier video, I thought maybe it was a woman. Now I'm kind of second guessing that after doing some new digging and research. And I want you to notice something about this photo right here. The way this dude is standing and their gait, and why Tommaso is now somebody who really, really rings true as someone who could be in that mask right there. Could be that person, that individual that the Nest camera caught that FBI Patel released. So you'll notice this close-up right here. There's facial hair in the mask. You can see in the middle bottom of your screen, indicating that this individual had a pretty good amount of facial hair, whether a mustache, beard, or both. There's a quick kind of side-by-side of Tommaso, the son-in-law, and the masked suspect right there. Okay, this is where AI has come in right in that mask right there. Could be that video. I thought maybe it was a woman. Now I'm kind of second guessing that after doing some new digging and research. And I want you to notice something about this photo right here. The way this dude is standing and their gait, and why Tommaso is now somebody who really, really rings true as someone who could be in that mask right there. Could be that person, that individual that the Nest camera caught that FBI Patel released. So you'll notice this close-up right here. There's facial hair in the mask. You can see in the middle bottom of your screen, indicating that this individual had a pretty good amount of facial hair, whether a mustache, beard, or both. There's a quick kind of side-by-side of Tommaso, the son-in-law, and the masked suspect right there. Okay, this is where AI has come in right here. What you see on the screen right here is AI putting a mask on Dominic Aaron Lee Evans. Dominic Aaron Lee Evans is a longtime friend and former bandmate of Tommaso Cioni, Annie Guthrie's husband, Nancy Guthrie's son-in-law. That is very eerily similar, because if you look at the facial hair on the chin there, you look at the eyes and the eyebrows, that is eerie, extremely eerie, because, if you see this image right here of the suspect in the video that was released and this Evans character, you start to notice some very eerie similarities. Also, this photo that I put on the thumbnail. So we asked Grok AI to take the mask off, and that is what AI come up with, and it is really, really accurate as far as what the individual may look like. Again, AI technology is so advanced now, it's absolutely out of this world. It's doing all sorts of things in many, many different fields and many, many different industries. I have an AI assistant that helps me with my work and research. I mean, this is a really powerful side by side. I can't wait to get your comments on this, but let's get back to Evans. So Dominic is a Tucson musician and founding drummer of the indie post-punk band Early Black, formed in 2007 with, guess who? Tommaso, the son-in-law, who's on bass, who played bass and vocals, and another individual by the name of Walter Goncalves Jr., who played guitar and did vocals. The band was active for years, and sources say Dominic and Tommaso remain good friends to this day. Now check this insane evidence out. Public records in Pima County, Tucson show Dominic has a criminal history, including arrests for felony, burglary, robbery, embezzlement, and DUI. Now with the new Nest doorbell photo showing a masked intruder who many say bears a striking resemblance to Dominic, if you look at the eyes, eyebrows, and goatee in that previous image I just showed you, and his close friendship with the son-in-law giving potential access knowledge of the home. Is this just a coincidence? Or could this be an actual connection to Nancy's disappearance? I can't wait to get your thoughts on this one. Okay, before I show you Nancy Guthrie's post, I want you to look at the gait here. I want you to look at the way this individual is standing. And then I'm going to go back to the family photo. Okay, maybe this is reaching, but I want you to look at this. There is Tommaso right next to Nancy Guthrie in this family photo. The kids are blurred out for a good reason. But I want you to notice something about the way he's standing. Look at the way that he's standing. Look at his shoulders. Look at the way that he's kind of hunched over. I don't know, call me crazy, but is there some kind of, and why is he specifically standing next to Nancy? Does that indicate something about their relationship, the closeness of it?
Alright, so what's your favorite platform to video stream on? I'm gonna have to go with Super Live. It's a great platform to download where you can showcase your talent all across the world. Yo, but a TikTok video or something, bro? I'm talking about Super Live. You can either dance or sing.
Let's go back to that photo. Look at the way he's leaning.
So what's your favorite platform to video stream on? I'm gonna have to go with Super Live.
Uncertainty in his gait. And by the way that he got the vegetation and the plants to block the camera, I mean, this has got amateur hour all over it. I think people have maybe, perhaps, again, this isn't definitive, obviously. This is just my very own. I want to be very clear. I'm not implicating anybody. I'm not saying for sure, certain with any, molecule of certainty that it is Tommaso, but this is just a hunch, again, and I always trust my instincts and my intuition and my hunches, and I wouldn't be shocked if maybe even Tommaso broke down. I think this was such a freaking Walmart amateur hour, ransom note, burglary, robbery, abduction, kidnapping, straight out of a really bad movie, B movie, not even an A movie, not even a C movie, maybe a D movie plot, that I wouldn't be surprised if this guy just broke down and confessed. What do you think? Do you see any resemblance there at all? Okay, here's Savannah Guthrie just posted this on her Instagram with the photo that was released by Kash Patel saying, "We believe she is still alive. Bring her home. Anyone with information, please contact 1-800-CALL-FBI. That's 1-800-225-5324 or the Pima County Sheriff's Department, 520-351-4900. I think it's only a matter of time before we find out who this individual was. And again, I wouldn't be shocked if it was a family member, specifically this guy right here. I just would not be surprised. Again, there's another angle of the way that he's standing, the kind of composition of his frame, his chest, the silhouette of the head, the eyebrows, or maybe, and the mustache. I don't know, although his mustache looks a lot grayer there. I don't know, call me crazy. I think there's something to this. The President of the United States, President Trump, said recently in a post that he encourages any American across the country with any knowledge of this suspect to call the FBI. He says the prayers of the entire White House are with the Guthrie family. What do you guys think? Did I go too far? Let me know what you think in the comments down below. As this story develops, you know your boy Nez is going to keep you in the loop and give you the latest scoop. So make sure you tap the thumbs up if you love America, because we're trying to make Common Sense go viral. Subscribe and follow. Check out these videos. They're coming up right now on the screen. Check this one out. I just posted this one right now. Tap my face to subscribe and follow. Hit that bell icon and turn on all notifications so you never miss out. And as always, may God bless you and may God bless the USA and all who defend her. I'll see you soon.
Hey there. Need a hand? At Texas Instruments, we have a broad portfolio to accelerate your robotic systems development, so you can design more autonomous and compact humanoids and mobile robots, ones that safely and efficiently work with people and other robots. TI, helping you build the robots of tomorrow. Helpful robots, like me.
Cetaphil's new hydrating and firming skin activator lotion is here.
Thanks, Jack.